Mike Bellafiore, One Good Trade. Introduction. In 2008, as the U.S. financial system faced collapse, some traders were making tens of thousands of dollars per day. This resembled 1998, when young proprietary traders thrived despite lacking complex tools. Since then, the world of proprietary trading has evolved, driven by technology and the internet. This book offers a first look inside the closed world of proprietary trading. Over 12 years, I have studied markets, co-founded SMB Capital, and witnessed traders' successes and failures. Here, I share market lessons, success stories, and strategies for traders to grow. What you will learn: how to develop the skills of a successful trader, the importance of discipline and continuous improvement, how to select stocks and evaluate trades effectively, the necessity of adapting to market changes. You'll read about traders like Moneymaker, a former golfer who applies his concentration skills to trading. We'll analyze mistakes, mine and my students, and how they led to growth. The core concept of the book is One Good Trade, a structured approach based on 7 key principles that help traders stay efficient in any market condition. This book is for aspiring traders and those seeking professional growth. It provides strategies and insights to help you become an elite performer in the world of trading. Welcome to an exciting yet unforgiving market where success depends entirely on your decisions and perseverance. Key traders in this book. Meet the traders of SMB Capital, each with a unique nickname reflecting their style. Mike Bellafiore, Bella, author and SMB Capital co-founder. Steve Spencer, Mike's partner at SMB. G-Man, an experienced trader with a unique approach. Jay Toma, Roy Davis, Alexander James, key team members. Moneymaker, a former golfer who excels through focus. Franchise, Dr. Momentum, Z Mash, Buckshot, each with a distinct trading specialization. Chapter 1, the best in the business. What is proprietary trading? Proprietary trading is one of Wall Street's most hidden yet fascinating sectors. Unlike banks and hedge funds, prop firms don't manage clients' money or sell services. Their success depends solely on the trader's skill and decisions. The role of prop firms. Prop firms account for 50 to 70% of daily stock market trading volumes. These firms generate millions while contributing to brokers, clearing firms, and government taxes. The trading boom. Prop trading took off in the late 1990s during the internet boom. Initially, few firms hired fresh graduates, but today, hundreds offer opportunities. The culture of prop trading. Unlike traditional Wall Street employees, prop traders don't attend fancy parties. Their job is a relentless battle for profit. Mistakes are costly. Traders risk their own capital. Success is rewarded. Earnings are based on personal performance. The golden rule. We only make money on what we can hunt. No clients, no services, just skill and execution. Welcome to the world of prop trading. Prop firms operate solely for their traders. The firm itself is the client. Traders use firm capital or their own, trading stocks, options, and other instruments without handling external funds. Forget stereotypes. Big profits don't come from insider information. We rely on public news sources, and success comes from skill. Some days a trader might make $10,000 in 30 minutes. Other times, they might go a month without profits despite working 50-hour weeks. In 2002, I made nothing, but in other periods, I earned tens of thousands in minutes. In prop trading, you are your own client. You choose the market, instrument, trade size, and timing. It's both a freedom and a challenge. New traders undergo rigorous training before getting real trading accounts. Unlike big banks, where talented traders wait years for opportunities, at SMB Capital, you can gain experience within months. Why choose prop trading? No office politics. Your results determine your future. Unlimited earning potential. Your success is in your hands. Constant challenges. Every day is different. For example, Black Friday 2009 was one of the best days for day traders when Dubai's financial troubles crashed markets, creating massive profit opportunities. The reality of trading isn't for everyone. Only those willing to adapt, learn, and follow strict rules succeed. Mistakes are costly, and the market is unforgiving. Key traits of top traders. Successful traders like Franchise, Moneymaker, Dr. Momentum, G-Man, Z-Mash, and J-Toma share core qualities. Competitiveness, the drive to win and adapt. Focus, ability to concentrate on critical details. Professionalism, continuous skill development. Quick learning, essential for real-time decisions. Consistency, achieving stable results over time. Resilience, staying composed under pressure. Curiosity, a relentless desire to improve. These qualities make elite traders stand out. Success isn't just about knowledge and skills, it's about the right mindset. Prop trading is a competition with no room for complacency, but for those who embrace the challenge, the possibilities are limitless. Franchise. Competitive traders strive for more. In 2007, I met Franchise, a young, ambitious trader applying to SMB Capital. He was confident, hardworking, and already had trading experience. Despite earning $1,500 to $2,000 daily, impressive for a beginner, he wasn't satisfied. He wanted to improve. I advised him to focus on 3 key areas. 1. Avoid chasing quick trades. 2. Optimize position sizing. 3. Improve execution. Franchise embraced the challenge. He analyzed his trades, refined his strategy, and increased his earnings to $3,000 to $4,000 per day. His success came from discipline, self-review, and continuous learning. Trading, like life, has tough moments. The key is resilience, learning from mistakes, and pushing forward. Moneymaker. Stay focused. Moneymaker's story is one of discipline and endurance. Even during market slowdowns, he remained focused, profiting from small moves. His mindset mirrored that of a professional athlete: rigorous training, stress management, and unwavering concentration. His ability to adapt and thrive in tough conditions wasn't just talent, it was psychological preparation. Years of repetition under pressure built his exceptional focus. He sees success not as luck, but as the result of passion, dedication, and hard work. Moneymaker proves that trading success isn't about luck. It's about focus, discipline, and continuous improvement. Through an impulse. Absorb knowledge quickly. Impulse is an exceptional trader with a rare ability. He instantly absorbs knowledge and applies it in real time. He doesn't take notes or review materials. Everything he learns sticks immediately, giving him an edge in the fast-paced world of impulse trading. His rapid decision-making and risk-taking ability allow him to capitalize on sudden market moves. However, his aggressive style sometimes leads to excessive risk, making self-control crucial for long-term success. Arthur Impulse's story highlights how passion, quick learning, and adaptability create a top-tier trader. G-Man. From I quit to head trader. G-Man, now a lead trader and partner at SMB Capital, had a rough start. He made nothing for 6 months. Instead of quitting, he adapted, analyzed his trades, and refined his strategy. Developing tools like the Chop Tracker helped him reduce losses and focus on high-quality setups. He shifted from low-value scalps to more profitable trades, dramatically increasing his income. His journey proves that success comes from persistence, data-driven adjustments, and a refusal to give up. Z-Mash. Turn discipline into an advantage. Z-Mash's trading success isn't based on flashy strategies or luck. It's built on discipline, consistency, and a systematic approach. He reviews his trades, learns from mistakes, and strictly follows his rules. Unlike traders who give up after losses, Z-Mash adapts while maintaining his core principles. His commitment to structured trading ensures long-term profitability. His story proves that true success comes from discipline, self-reflection, and continuous improvement, not luck. Progress through a strong foundation. Success in trading isn't about quick wins or taking huge risks. It's about steady, disciplined progress. Professional traders build their skills step by step, ensuring each new level of risk is supported by experience and consistency. A trader earning $500 a day shouldn't immediately aim for $5,000 without first proving they can handle the increased risk. Many fail by rushing growth, underestimating the psychological pressure of larger losses. Building a positive base. A solid trading career is built on stable, consistent results. Traders must recognize their strengths and weaknesses, gradually scaling up risk and profit while maintaining control. True success comes from discipline and strategy, not sudden leaps. Yapo Hippie, the power of daily progress. Yapo Hippie embodies the idea that real trading success comes from long-term effort, self-reflection, and continuous learning. He records every trade, analyzes mistakes, and constantly refines his strategy. His key belief: even experienced traders must keep evolving. His approach proves that success is a result of patience and steady improvement, not luck or shortcuts. J. Toma, the practice of persistence. J. Toma's journey highlights the power of persistence and self-improvement. His key lessons: 1. Mental resilience, overcoming fear of losses and embracing continuous learning. 2. Small steps, big growth. Progress happens through daily improvements. 3. Discipline and practice, keeping a trade journal to refine strategies. 4. Learning from others, studying experienced traders. 5. Psychological training and managing emotions and biases, the key to trading success. Trading is a psychological game. Many traders hold on to losing positions due to ego, hoping to be right rather than making the best decision. The best traders accept market unpredictability and focus on minimizing losses. Success comes from practicing discipline, analyzing mistakes, and developing the ability to let go of bad trades. Like any skill, it takes time. But with patience and persistence, steady progress leads to real results. Chapter 2. One good trade. This chapter emphasizes the importance of a disciplined approach to trading rather than just chasing profits. A key idea is that a trade should not be judged solely by its outcome, profit or loss, but by whether it was executed with a sound strategy and proper risk management. A trade can be good even if it results in a loss, as long as it was well planned and followed the trader's rules. Traders often focus too much on results, reacting emotionally to missed opportunities. I closed too early, or the price moved against me. This mindset can lead to hesitation and poor decision-making. Instead, the one good trade principle teaches that what matters most is executing trades based on well-defined criteria, not emotional reactions. A bad trade. A bad trade is not necessarily an unprofitable one. It's a trade that ignores the trading plan. Many beginners believe a trade is bad just because they missed out on additional profit. However, if the trade was executed according to a well-thought-out plan, it was a good trade, regardless of what the market did afterward. The example of Bella and the trader highlights this principle. Success is not determined by capturing the full price movement, but by executing a trade based on a solid plan. If a trader exits a position because price momentum slows, they have followed their plan correctly, even if the price continues to rise afterward. However, if the plan itself was flawed, such as failing to account for market momentum, then the trader must analyze and improve it. The key takeaway is that trading success comes from consistently making well-planned decisions, not chasing every last bit of profit. New traders benefit from creating a structured trading plan, setting clear exit strategies, and maintaining discipline. This helps them avoid emotional decision-making and stay focused on long-term success. You are a trader, not an investor. A crucial lesson for traders is understanding that trading is a process, not just a result. The goal is not simply to be right, but to execute the right trades. Market conditions can be unpredictable, and even well-planned trades can result in losses. However, a disciplined trader follows their system rather than trying to predict every price move. The metaphor of basketball player Shane Battier illustrates this well. He couldn't completely stop Kobe Bryant from scoring, but he could make his shots more difficult. Similarly, traders can't control the market, but they can control their decisions. Traders must separate themselves from investors. Unlike investors who hold positions for long-term gains, traders capitalize on short-term market movements, managing risk efficiently. The focus should always be on executing disciplined trades, not holding on to positions in the hope of eventual gains. Rethinking failure. Many traders, especially beginners, overestimate the impact of failure. Losing trades can damage confidence and lead to hesitation, preventing traders from taking advantage of future opportunities. The example of G-Man highlights this issue. He followed his plan, but still took a loss. However, his mistake wasn't in the trade itself. It was in allowing that single loss to shake his confidence. Failure is simply part of the process. Every trader experiences losses, but those losses should be seen as learning opportunities rather than setbacks. The most successful traders are those who analyze their mistakes, improve their strategies, and continue executing disciplined trades without letting past failures dictate their future decisions. I just have a long position. This phrase underscores a fundamental truth in trading. Managing a position is just as important as opening it. Unlike passive investments, trading requires constant monitoring and active decision-making. A trade left unattended can quickly turn from profit to loss, especially in short-term trading, where price movements can be fast and unpredictable. A trader who fails to manage their position properly risks losing control, leading to unnecessary drawdowns. The key takeaway? Always stay engaged with your trades. Being present and ready to react allows you to capitalize on good opportunities and minimize potential losses. The core principles of SMB Capital. SMB Capital follows 7 essential principles that form the foundation of their trading philosophy. These principles can benefit any trader striving for consistency and long-term success. 1. Proper preparation. Successful traders start their day with thorough market analysis, identifying key levels, news catalysts, and potential trade setups. 2. Hard work. Trading requires continuous learning, practice, and adaptation to ever-changing market conditions. 3. Patience. The ability to wait for high-probability setups and avoid impulsive trades is crucial. 4. Detailed trade planning. Every trade should have a predefined entry, exit, and stop-loss level to avoid emotional decision-making. 5. Discipline. Sticking to a well-tested strategy prevents costly mistakes. Deviating from a plan often leads to unnecessary losses. 6. Information sharing. Discussing trades, strategies, and mistakes with other traders enhances learning and growth. 7. Trade reviews. Regularly analyzing past trades helps refine strategies and improve execution over time. At the core of SMB's philosophy is the idea of one good trade, a mindset where traders focus on executing each trade correctly rather than obsessing over daily P&L. This shift in perspective helps build consistency and confidence. Struggling with trading? Here's what to do. Many traders face difficult periods where results don't meet expectations. The biggest mistake? Judging your trading solely by short-term profits and losses. Instead, shift your focus to the process and execution. Evaluate process over outcome. A well-executed trade can still result in a loss, but that doesn't mean it was a bad trade. Stick to your plan and refine your edge. Maintain discipline in decision-making. If a trade no longer meets your criteria, exit it, no matter how much you want it to work. Separate emotions from trading. Emotional trading leads to impulsive decisions, revenge trading, and unnecessary risks. Think in terms of probability. No single trade defines your success. Look at your trading performance over weeks and months. Analyze mistakes objectively. Reviewing trades allows you to pinpoint errors and improve your execution. The power of preparation and hard work. As legendary coach John Wooden once said, failing to prepare is preparing to fail. In trading, preparation is everything. The best traders follow a structured morning routine that includes pre-market analysis, identifying key stocks, trends, and catalysts. Stock selection, choosing the most promising setups based on volume and volatility. Technical and fundamental review, marking key levels and understanding market sentiment. Trade planning, defining entry/exit points in risk management strategies. Mental preparation, getting into the right mindset to stay focused and disciplined. A great trade is never the result of luck. It's the result of consistent preparation, discipline, and execution. Patience in trading. Warren Buffett and other successful traders emphasize the importance of patience in trading. Buffett's analogy, standing with the bat ready without swinging at every pitch, perfectly illustrates this principle. A trader must always be prepared to act, but should not chase every market opportunity. Key takeaways. 1. Patience in decision-making. Positions should be taken at the best risk-reward ratio, not out of urgency. Professional traders avoid entering trades if they miss their ideal entry point. 2. Precision in execution. Successful traders wait for the best price. If strong support is at $30, they buy at $30, not $30 or $50, reducing unnecessary risk. 3. Loss minimization. Patience prevents premature exits and allows for larger positions, increasing profit potential. 4. Avoiding the second mistake. Missing an entry isn't costly, but entering late can be. Avoid turning one mistake into a bigger one. Trading isn't about chasing opportunities. It's a waiting game. Have you ever felt tempted to enter a trade too early? Mr. Missed Opportunity. Many traders obsess over missed trades, turning trading into a stressful experience. Mr. Missed Opportunity is the classic case, constantly dwelling on what could have been rather than focusing on what's ahead. But missed trades are simply part of the process. Not every missed opportunity would have been profitable. The real danger isn't missing trades, it's executing bad ones. Losing traders focus on what they could have made instead of perfecting their risk management. How do you deal with the frustration of missed trades? The importance of price. During a trade review, a new trader, a Wharton Business School graduate, kept making poor entries. Let's call him Wharton Jr. Even if the trade idea is correct, a bad entry price can turn a winning trade into a losing one. A difference of just 0.6 days or 0.7 per share can make a significant impact, especially for large positions. The best traders wait for their price instead of reacting impulsively. Do you have strategies to ensure better entries? A detailed trade plan. The best trader is a prepared trader. Evan Lazarus, co-owner of T3 Capital. At T3 Capital, new traders must instantly articulate their trading plan in a single sentence, like a business plan for a trade. 1. Exit strategy. Great traders know when to get out, even reversing their position if necessary. Unlike large funds that exit over weeks, prop traders act swiftly. 2. Predefined risk management. As Brian Shannon says, you must have a backup plan for every situation, and that plan must be in place before entering a trade. Discipline. Some say I can't close the position because I'll lose money selling the stock. But if the price is already lower than what you paid, selling doesn't mean a loss. The loss has already happened. William O'Neill, founder of Investors Business, daily trading is not magic. It's a set of professional skills and discipline. To be successful, it's not just about having a plan, but sticking to it despite market fluctuations. Lack of discipline leads to losses. A disciplined trader always follows their plan. If you decide to sell a stock when it drops below $30, do it without hesitation. Selling can be tough, but it frees you from a losing position. James Acula, Depori advises, selling is a way out. After selling, calmly reassess the situation and look for new opportunities to enter. Don't worry if the stock price goes up after you've sold it. Evaluate your trading the system based on long-term results, not just one trade. Sticking strictly to the plan, even if the price temporarily moves against you, is key to consistent success. As Jesse Livermore said, I don't care about a loss if it's already happened. Success comes from strict adherence to the plan and the ability to react quickly to market changes. Crazy Max. Working with young traders has shown that without discipline, success in the market is impossible. One of the most talented traders, Crazy Max, had exceptional intelligence and passion for trading. He thrived in volatile markets, but lost almost everything during calm periods. Despite his successes, his lack of discipline played a role in his failures. Max often broke rules, stayed up late playing video games instead of resting, and missed morning meetings. These are signs of poor discipline that also manifest in trading. If a trader can't arrive on time, it's difficult for them to avoid risky trades during the session. After Max left, I felt personally responsible. He trusted me and hoped I could help him become a successful trader, but it didn't happen. Private trading is tough, and many traders, despite their talents, can't handle the pressure. I lost not only a trader, but also a friend. Discipline is crucial to success. Max couldn't impose strict rules on his life. Trading demands such an approach, and only by adhering to these rules can you achieve consistent results. It's important to develop discipline through physical health because taking care of the body leads to a more disciplined mind. SMB Capital collaborates with T3 Capital, which supports a triathlon team for traders, helping maintain excellent physical shape, leading to improved trading results. Information exchange. Anyone's opinion is not as important as their information. In a good trading room, traders constantly exchange market information, which is the foundation of successful trading. This collective cooperation significantly boosts efficiency as 60 pairs of eyes see better than one. Roy Davis, training director at SMB Capital, emphasizes the importance of teamwork, where each trader contributes to the success of others. Earlier, the culture of intellectual exchange in trading is nearly non-existent, and each trader worked alone. However, exchanging meaningful factual information has now become the norm, helping traders earn more. For instance, when one trader noticed a break of an important support level in AIG stock, they immediately shared this with colleagues, bringing profit to everyone. It's essential for prop traders not only to share successful ideas, but also to discuss their trades, leading to better market understanding and higher profitability for all participants. Replaying important trades. Good prop traders always strive to improve the quality of their work, and one of the key methods is mentally replaying important trades. Many experienced traders, including Tom, have mastered this practice. When the market quiets down, it's a great time to reflect on your actions to learn lessons and improve future results. Key questions for self-criticism and trade analysis. Was there a moment when I could have added more volume? Was the sale premature? What caused the stock's rise? Was there a catalyst for the move? Did I take too much risk, or was I too cautious? By mentally replaying trades, traders can improve their actions, spot potential mistakes, and determine what can be changed in similar situations in the future. It's like reviewing a sports game to spot errors and improve technique. Additionally, it's important to actively exchange experiences with colleagues, discussing their views on the market and learning from them. Mutual discussion of trades and identifying reasons for success or failure helps traders develop faster. It's also useful to print trade data to analyze execution discipline, adherence to the plan, trading efficiency with specific stocks, and identify those that are more difficult to trade. The key is to develop the habit of analyzing important trades during the session to reinforce correct actions and learn from mistakes for future trades. One good trade by the moneymaker. The essence of successful trading is the continuous improvement of actions, adherence to basic principles, and a systematic approach. Every day should begin with making one good trade that aligns with pre-established trading principles. The trade example of the moneymaker with AIG stock on August 27, 2009, is a great example of how to approach trading with a clear plan and discipline. Key principles of the trade. 1. Proper preparation. The moneymaker studied the market, identified important levels, and tracked the stock's movement to prepare for the trade. 2. Support and resistance levels. The trader knew the key levels for action. Support at $40, resistance at $41.50 and $42.25. 3. Hard work and patience. The moneymaker waited for confirmation of a break at $41.50 before opening a long position. He showed discipline by closing part of the position at $41.70 or $42 and holding the remaining part. 4. Detailed plan. Every trade began with a clear plan. If successful, the trader planned to scalp part of the position and buy back the shares if bullish interest continued. If things went badly, he was ready to exit the position. 5. Discipline. Strictly following the plan is an example of disciplined trading. The moneymaker closed part of the position with profit, but kept the remaining part for further growth. 6. Information exchange. Opening trades and levels in the market is crucial for communication with other traders, which helps increase the team's profitability. 7. Replaying important trades. Analyzing every successful trade and mentally replaying strategies with adjustments based on previous experiences helps improve a trader's skills. Who gets into a proprietary trading firm? To get into a proprietary trading firm like SMB Capital or T3 Capital, you need to meet certain requirements. These firms look for traders who can combine market knowledge with self-discipline, analytical skills, and the ability to make data-driven decisions. Here are a few key factors that can influence your chances of getting hired. 1. Desire and willingness to learn. Training and mentorship programs in such firms are very intensive. Those who succeed continue to learn and grow in the field of trading, even if they already have experience. 2. Ability to work in a team. In good trading rooms, it's important to be able to share ideas, communicate with colleagues, and work together to increase profits. Intellectual teamwork is valued much higher than individual work. 3. Emotional resilience. A successful trader must be mentally strong, able to accept losses, and analyze them without letting emotions drive decisions. 4. Technical and analytical skills. The ability to analyze data, identify patterns, and make informed decisions based on market analysis and current events is essential for a successful trader. Traders who adhere to these principles and are committed to growth stand a good chance of securing a position in these firms. Chapter 3. Job fit. This chapter highlights the importance of job fit, a concept frequently used when hiring in proprietary trading firms, which can play a crucial role in a candidate's success. Angel Cuevas' story demonstrates perseverance and determination, but also points to several key aspects that determine a trader's success when applying to a trading firm. How job fit manifests. Despite Angel's persistence, he was unable to land a position at a trading firm, despite numerous attempts. Even his persistent emails, proposed meetings, and determination didn't lead to success. Angel kept sending resumes and receiving rejections, but he didn't give up. However, the key point to note is that his approach didn't align with the fundamental expectations and requirements of proprietary trading firms. These firms are looking not only for trading skills, but also for alignment with their internal paradigms, trading styles, and corporate culture. Each firm seeks individuals who can not only work within their system, but also bring profit with minimal risk. The hiring and testing process. Recruitment in such firms typically occurs through several stages to assess how well a candidate fits. 1. Resume screening. At this stage, it's important not only to have experience, but also to tailor the resume to the firm's specific needs. 2. Testing. Many firms conduct mathematical and analytical tests to check the candidate's ability to analyze and make decisions based on data. 3. Interviews. In interviews, candidates must demonstrate not just knowledge, but also personal qualities, communication skills, adaptability, and emotional resilience. 4. Second interview and meeting with traders. After a successful interview with specialists, the candidate must show the ability to work within a team, interact with other traders, and manage risks effectively. 5. Comparing candidates. Firms carefully compare candidates, reviewing their profiles, work histories, recommendations, and alignment with internal requirements. 6. Job offer. Only after all these steps, the firm decides whether to offer the job. Candidate requirements. Each company will look for a trader who not only demonstrates professional skills, but also fits their trading strategy. For example, some firms may prefer candidates with a background in mathematics or engineering, while others value experience in competitive sports or working in high uncertainty environments. It's also important to remember that trading skills are not the only criteria. Many successful traders, like Bruce Kovner, started from humble beginnings, sometimes working as taxi drivers or on night shifts, but their perseverance and ability to learn played a pivotal role in their success. The path to success for candidates. To land a job at a trading firm, candidates must 1. analyze and adapt their behavior. Assess whether their approach aligns with the style and needs of the firm. 2. Develop market-relevant skills. This includes not only knowledge of financial markets, but also emotional resilience, a willingness to learn, and the ability to work in a team. 3. Build strong relationships with colleagues. Communication skills, understanding trading dynamics, and teamwork are essential. Angel's question, who do proprietary trading firms hire, emphasizes that on the road to success, it's important not only to persist in your goal, but also to understand that it's necessary to meet the internal requirements of the company, not just possess technical skills. Unrealistic expectations. In this section, the author contrasts the reality of trading with the dreams of many ambitious newcomers hoping to get into proprietary trading firms. The examples show how many candidates try to convince employers of their uniqueness by offering effort, ambition, and dreams as their primary argument to gain a chance for success. However, in real life, proprietary trading firms are not just looking for motivation and hard work. The reality is that a candidate must not only want to be a successful trader, but also prove their ability to work in a highly competitive and high-pressure environment, meet the company's expectations, and demonstrate real skills, not empty promises. Analysis of common candidate mistakes. 1. I am proud. Emotional statements, emails like, I am ready to work tirelessly and want nothing but trading, or I will trade in any style, are examples of how ambitious but inexperienced candidates don't understand that trading requires not only motivation, but specific measurable skills. Success on demo accounts. Many candidates believe that success on demo accounts guarantees success in live trading. However, the real market often has much higher volatility and psychological pressure that's hard to replicate on a demo account. 3. False results. Some traders present fake success stories using fabricated income data. This highlights the importance of verifying information and not being swayed by illusory promises. 4. Reading trading books or watching CNBC. Reading all trading books or watching financial news on CNBC is certainly useful, but it doesn't make someone a true professional. This is surface-level knowledge, not backed by practical experience. 5. Dreams of luxury. Dreams of a luxurious life, personal brands, sports cars, and beautiful women are typical images that many trading newcomers build for themselves. However, these dreams often distract from what really matters for success in trading: analytical thinking, strict risk control, and the ability to learn, the importance of real job fit. The author stresses that not every persistent person can become a successful trader, and success requires much more than just the desire to work. Candidates need to meet the rigorous demands of the market and the company, including the ability to make the right decisions under stress, respond appropriately to risks, and demonstrate maturity in their strategies. Without these qualities, even the most persistent dreamers will remain outside successful trading firms. Transforming into one of the chosen few. Trading emphasizes the importance of not only skills but also personal qualities in achieving success in the market. Trading is a craft that requires constant refinement and discipline, as well as the willingness to work hard and diligently. Becoming a successful trader takes time, effort, and emotional stability. Teamwork, adaptability, and mental resilience also play a key role, distinguishing the best traders from the majority. It's important to understand that successful traders aren't born, they become so. Often this is possible through deep self-development and hard work, as well as the willingness to work within a disciplined, progress-oriented corporate culture, as is the case with SMB Capital. In such organizations, traders are given real opportunities for a fast start and growth, something that's often lacking in large institutions. Proprietary trading firms value not only diplomas and knowledge, but also the ability of candidates to adapt and work in high uncertainty and high-stress conditions. Unlike large banks, where newcomers may remain on the bench for a long time, these firms expect quick transitions to real trading. The focus is not so much on the amount of profit, but on the trader's progress, their ability to learn and improve. If a candidate is ready to work in an environment of intensive learning and development, they can become part of a team that unites the best qualities in trading. If you have similar goals in trading, it's important to gear up for a long journey of self-development, where every day is an opportunity to improve skills and reach a new level of market understanding. The hiring procedure. The hiring procedure at SMB Capital is detailed through sequential stages, emphasizing the quality of candidates and their ability to fit the company's specific culture. The focus is not only on professional skills, but also on personal qualities that align with the corporate culture. The process includes several key steps. 1. Resume screening. A large number of applications are received annually, but only a small fraction catch attention because the firm needs candidates whose qualities align with the firm's trading style. 2. Test. Candidates who pass the first stage are sent a test with questions they must answer. This helps filter out unsuitable candidates. 3. First interview. In this interview, the candidate's qualities and approach to trading are assessed. This is where it's determined whether the candidate is a good fit for further interaction with the firm. 4. Second interview and tradecast. Candidates who survive the first interview undergo a second stage where they observe traders in action. Tradecast. Afterward, they meet with the firm's partners and traders. 5. Candidate evaluation. All candidates are given numerical ratings on various criteria, including intellectual ability, emotional resilience, teamwork skills, and other personal qualities essential for a successful trader. 6. Job offer. Candidates who score the highest in the selection process are offered a job with the company. The author emphasizes the importance of aligning with the company's corporate culture and understanding that rejection doesn't mean failure in trading altogether. It more likely signifies a misalignment with the expectations of a specific firm. The whole process is designed to identify those who can not only trade but also fit into a team that shares the values and approaches of the firm. Resume review. At SMB Capital, the focus during resume review is on selecting candidates who not only meet professional requirements but also align with the company's corporate culture. The process highlights the importance of personal qualities and a philosophical approach to trading. Key points of this stage include: 1. Initial response. After receiving resumes, candidates are either thanked for their interest if their resumes don't grab attention, or sent a follow-up questionnaire asking about their motivation and skills. 2. Rejection and its consequences. A candidate was rejected despite having strong academic achievements and a background in football, primarily because his personal traits didn't fit the company's culture. The company places as much importance on cultural fit as on professional skills. 3. Handling rejection. Some candidates are puzzled by rejections, especially when their resumes seem impressive. However, SMB Capital values cultural compatibility over qualifications alone. 4. HR quality control. The company ensures that talented candidates are not overlooked by having senior partners review the HR department's work. 5. Philosophy of hiring. SMB Capital emphasizes that the hiring process is about philosophical alignment with the company's values, not just professional experience. Pre-screening test. The first stage involves answering 13 questions. If the responses are satisfactory, candidates are invited for an interview. Some of the questions include: 1. Is trading a top priority for you? 2. What is your favorite trading blog? 3. Do you have a personal trading account? If so, what were your last 3 trades and why? 4. Have you changed anything about yourself recently, or do you want to? And what is your most significant achievement? 6. Tell us about your last failure. How did you react? 7. How does your past demonstrate your competitiveness? 8. Are you willing to spend a year learning our system and trading methods to earn $1,000 or $4,000 a day? 9. Can you handle an 8-month training period? First interview. This stage is designed to identify the most motivated and suited candidates and to check if they are aware of the challenges of a trading career. The interview also uses a recruiting technique to gauge commitment. Some key questions are: 1. Have you traded before? Do you have a personal account? 2. What daily habits demonstrate your interest in financial markets? 3. What is your favorite trading blog? 4. What's the best trading book you've read? 5. Where do you see yourself in 5 years? 6. Describe a recent stressful situation and how you reacted. 7. What do you think would cause you to fail as a trader? Recruiting technique. The goal is to convince the candidate that trading is a tough profession that requires full commitment. Those who endure the pressure and continue to express interest in the role are seen as serious candidates. Afterward, the company discusses the advantages of the role, its training system, and culture. Tradecasts and next steps. Candidates who pass the first interview are invited to participate in tradecasts. This is an opportunity to observe and participate in trading sessions and see if they fit the company culture. Only those who align with the company's philosophy move on to the next phase. My favorite interview, Penny's story. This story highlights how passion, determination, and genuine interest in the profession can outweigh external shortcomings. Penny's sincere enthusiasm for trading and detailed knowledge of market strategies, despite language barriers and a less polished appearance, made him stand out as a strong candidate. Key takeaways from Penny's story. 1. Genuine passion. Penny's genuine love for trading was evident through his detailed discussions about support and resistance levels and using company blog material. 2. Preparation. Showing knowledge of the company's blog demonstrated his commitment and preparation for the role. 3. Attention-grabbing. Penny immediately captured attention with specific examples of his trades, showcasing his active involvement in the markets. 4. Determination. Despite his modest background, Penny's clear focus on becoming a trader shone through. The worst interview question asking, "How much do beginner traders make on average?" is a misguided question. Trading is highly individualistic, and success depends on the trader's personal skills, discipline, and emotional control, not on an average. Many beginners fail because they lack knowledge and preparation. Success is determined by the individual's commitment to learning, improving, and handling the challenges of trading. Trading is a personal journey. Comparing yourself to other traders is pointless. Trading requires individual growth, discipline, and focus on improving your skills, not on measuring yourself against others. Keep developing yourself and practicing, and success will follow. Can a firm identify the next great trader? Predicting a trader's success based on interviews or resumes is nearly impossible. Here are the key insights. 1. Talent is revealed through work, not interviews. No hiring process can fully determine if a candidate has the resilience and skill to succeed in trading. True potential only emerges through experience. 2. Actions speak louder than words. Many claim they'll work the hardest, but only a few maintain high effort over time. 3. Internships over interviews. Hands-on experience is the best way to assess motivation and adaptability. 4. Hidden talent. Some of the best traders don't stand out in interviews, but prove their worth through results. 5. Hard work is the key. The most successful traders put in long hours and relentless effort. 6. Performance under pressure. Quick thinking tests help assess decision-making in high-stress situations. 7. Structured selection methods. Systematic evaluation tools reduce hiring biases and improve accuracy. 8. Natural selection and training. Even with careful hiring, only those who prove themselves through performance succeed. Practical takeaways. Prove your work ethic with real examples, not just promises. Train for pressure situations and quick decision-making. Stay adaptable. Trading rewards those who continuously improve. If hiring, use structured assessments over gut feeling. The outsiders who made it. Outsider number 1, the psychopath. One of the firm's top traders had extreme emotional reactions, screaming in the office, yet consistently made huge profits. By 9 a.m., he had already earned $10,000. His success showed that raw results often outweigh personality fit. Outsider number 2, Thibault. Despite strong academics, Thibault struggled with job applications and failed many mental tests. He was rejected by major firms but got a chance with a smaller trading company. His early career was tough, low earnings, market struggles, but he persevered. Eventually, market conditions turned, and Thibault became a successful trader, now mentoring others in New Jersey. Outsider number 3, Trickster. Gifted in math and price analysis, Trickster lacked social awareness and disrupted the office. Initially, he was nearly fired, But after an honest apology, he was given a second chance. He transformed into a disciplined, supportive team member and became one of the firm's top traders. Final thought: success in trading isn't about perfect resumes or interviews. It's about resilience, adaptability, and relentless effort. The best traders often don't fit the mold, but prove their worth through performance. Pros and cons of hiring experienced traders. Hiring an experienced trader can be beneficial for a firm, but it comes with challenges. Many experienced traders are actually struggling ones looking for another opportunity. We follow the principle of not poaching traders from firms that have invested in them. However, sometimes traders genuinely need a change of environment, transitioning from one firm to another. I once left a firm due to persistent platform issues. Though it was hard to part with my colleagues, the instability made it necessary. Loyalty is important, but sometimes a change is required. Challenges of integrating experienced traders. Bringing in seasoned traders isn't always smooth. Some struggle to adapt to our principles. One trader, despite making the highest profits on his first day, refused to follow our methods and had to leave. Dom, an unstable trader. New traders can sometimes bring more issues than benefits. Dom, a massive trader in both stature and personality, joined us after a dispute with his former firm. He embraced our system but lost money for 30 consecutive days, something unheard of in our firm. His lack of concern over losses signaled an issue, ultimately leading to his departure. Billy Bucks, great trader, poor fit. Some firms prioritize results over culture, but we don't. Billy Bucks was a skilled trader but didn't align with our professional standards. His casual dress code and chronic tardiness clashed with our disciplined environment. Despite his talent, he wasn't the right fit for our team. The ungrateful trader. Hiring experienced traders stopped after a case of disloyalty. A trader, mentored by Steve, made impressive profits, but left for a better pay structure elsewhere. Without our support, he quickly lost everything. This was a lesson in the risks of firms engaging in aggressive talent poaching. Zmash, the golden standard. Zmash struggled at his previous firm, but thrived after undergoing our training. Once he adapted, his profits skyrocketed by 300%. His discipline and ability to integrate with our culture made him invaluable, proving that success depends not just on skills, but also on alignment with a firm's principles. The importance of the right training. Trader development has evolved. While shadowing a mentor was effective in the 90s, today's competitive environment requires structured training with real-time analysis, simulation tools, and direct mentorship. Don't force a fit. A trader will call A no, relentlessly push to join us despite not being qualified. He lacked discipline, played online games during trading hours, and ultimately cost the firm money. This highlights the importance of self-awareness. Forcing a company to hire you won't make you a good trader. Finding the right trading firm. As Alexander Elder states, trading isn't a zero-sum game. It's negative-sum due to costs. High commissions and profit-sharing structures can be detrimental. The key is finding a firm with ethical management willing to support traders through their learning curve. When seeking a trading job, be yourself. Develop your market passion, engage with firms, and focus on building long-term success. A strong foundation, discipline, and gradual progress are the keys to a sustainable trading career. Chapter 4. The Pyramid of Success. It's the first day of training at a trading firm in Lower Manhattan. A senior trader leads the new recruits into a classroom where a blank pyramid is displayed on a screen. The firm's leader, dressed casually yet confidently, asks a key question. What does it take to succeed in trading? The recruits must fill in the pyramid, identifying the most crucial elements of success. The trading world is flooded with information, books, blogs, financial media, but beginners often struggle to filter what truly matters. Many traders waste time on irrelevant details rather than focusing on profitability. As trading expert Alexander Elder points out, a bad mentor is one who thinks they know everything. Learning from experienced traders and focusing on essential skills is critical. Otherwise, the market itself will expose your mistakes. Success isn't about being unique. Many beginners believe they must create a unique strategy or make bold market predictions to succeed. However, trading isn't about forecasting economic trends or managing billion-dollar funds like Warren Buffett. Instead, day traders thrive by mastering practical skills. Established trading firms teach proven methods that work, and trying to reinvent the wheel too soon often leads to failure. The best approach for new traders? Find an experienced mentor, master fundamental skills, and develop creativity later. The market always changes. In 2008, shorting stocks on new daily lows, especially in banking and finance, was a winning strategy during the financial crisis. However, by 2009, this method stopped working. Traders who failed to adapt suffered losses, while those who adjusted began shorting at peaks after bounces instead of chasing breakdowns. The key lesson: strategies that worked in the past won't always work in the future. Successful traders don't blindly follow old patterns. They adapt, refine their approach, and evolve with the market. Adaptability is everything. Trading is not about rigidly applying a single strategy. It's about flexibility, learning, and constant evolution. Even when you've achieved success, you must stay ready to adjust, improve, and grow to keep up with an ever-changing market. T-Bone, a ticking time bomb. This story highlights the importance of humility and self-awareness in trading. T-Bone had a successful first day, but lacked the skills for long-term consistency. His overconfidence, fueled by luck rather than experience, led to his downfall. He believed his intuitive approach was the key to success, but the market proved otherwise. The lesson? Respect the learning process. In the first months or even years, new traders shouldn't assume they understand the market deeply. Mastery comes through practice, not arrogance. The best traders start with basic execution, develop technical skills, and only later refine their strategies. Confidence is good, but pride can be dangerous. Stay open to learning and adapting. T-Bone failed to do this, and his trading career ended quickly. Key takeaway: be patient, stay humble, and build strong fundamentals before trying to innovate. Surviving the learning process. Becoming a trader is a journey filled with failures and challenges, but these early struggles lay the foundation for future success. Stories of traders like G-Man and Steve show that initial setbacks can fuel long-term growth. The key is survival, staying in the game long enough to improve. Patience and steady progress are the real indicators of future success. Think of Tiger Woods. His greatness wasn't now instant. It was built through decades of discipline. Even after winning major titles and securing his legacy, he still follows an intense daily routine. 6:00 a.m. Strength training, 90 minutes. 9 to 11 a.m. Long-distance shots. 11:30 a.m., 12:30 a.m., 9-hole round. 3 and 4 short game practice. 5:36 to final drills. Trading is no different. It's a skill honed over time, not an instant art. The more time a trader spends learning and practicing, the greater their chances of success. Early on, focus on the basics. Trade small, concentrate on a single asset, manage risk, and aim for steady improvement. Mastery in trading, like in sports or the arts, takes years of discipline and perseverance. Success isn't luck. It's the result of thousands of hours of work. Key takeaway: don't rush. Focus on discipline, self-control, and daily improvement. True greatness takes time. Focus on daily progress. In trading, as in any field, success comes not just from results, but from the process. Expecting quick profits can lead to frustration, especially early on. Many traders struggle to detach from P&L numbers flashing on their screens, which can be distracting. However, true skill develops through refining the process, not chasing outcomes. A colleague of mine started as a weak trader, but transformed his approach by shifting his focus from profits to skill development. He studied, analyzed, sought mentorship, and worked on eliminating flaws in his trading. On the surface, his efforts seemed unremarkable, but this dedication to refining daily actions ultimately made him one of the best. Tip: hide your P&L from the screen. Instead, focus on making better decisions. As you refine your execution and decision-making, stronger results will follow naturally. Every trading session is an opportunity for growth. Treat each day as a chance to improve, and over time, these small gains will compound into major success. Ask meaningful questions. Modern prop trading often involves working remotely, limiting opportunities to learn from others in person. However, mentorship and community remain essential for success. Dr. Brett Steenbarger, a well-known trading psychologist, once said, "It takes a village to raise a trader." This means that progress requires a network of professionals and peers who can provide insights and guidance. But here's the key. Mentors and trading communities won't read your mind. If you don't ask questions, you won't get the answers you need. Trading is a step-by-step process. Each concept builds upon the next. Skipping foundational lessons makes future growth nearly impossible. A common mistake among new traders is trying to learn too many strategies at once. This leads to scattered focus and shallow understanding. Instead, master one concept at a time before moving on. In my trading lectures, I always emphasize active engagement. Asking questions deepens understanding and makes learning far more effective. Technology has made access to experts easier than ever. Platforms like Twitter, StockTwits, and trading blogs allow direct interaction with professionals. For instance, I once asked Corey Rosenblum, afraid to trade, about a market trend, while my colleague Steve reached out to Dr. Steenbarger for psychological advice. Both received valuable insights. Your progress depends on your level of engagement. If you don't understand something, ask. Even if it takes 100 questions, it's worth it. Never leave a lesson without clarity. Tip: ask questions. The more you ask, the faster you grow as a trader. Discuss trading. When traders gather, their conversations often revolve around the market. Use these moments wisely. Talk about trade setups, market conditions, entry triggers, support and resistance levels. Share your experiences and listen to insights from others. Trading knowledge grows exponentially when shared. Remember, giving value comes back to you. Sharing your observations encourages others to do the same, creating a mutually beneficial learning environment. How you spend your time matters. After a successful trade in QKM, my colleagues and I went to watch Avatar. On the subway ride, I overheard a group of traders, but instead of discussing market patterns, price action, or upcoming trades, they were gossiping about their peers' profits. Key lesson: productive discussions drive growth. Post-trading sessions are the best time to analyze trades, review levels, and exchange strategies. You might discover new patterns, fresh perspectives, or better techniques. Elite traders treat time as their most valuable resource. Use every opportunity to learn and improve. Talking about trading is a powerful tool for education and self-improvement. Tip: surround yourself with traders who discuss the market, not just their profits. Daily trading plan for consistency and growth. 1. Morning preparation. Wake up at the same time every day to establish a stable routine. Engage in light exercise to boost energy and focus. Have a nutritious breakfast to fuel your body and mind. Review market news, economic reports, key levels, and overnight developments. 2. Pre-market preparation. Analyze the previous day's trades. Identify what worked and what didn't. Develop a clear trading plan. Select instruments. Define entry, exit points, and set risk parameters. Spend a few minutes visualizing ideal trades and emotional stability. 3. Trading session. Execute trades strictly according to the plan, avoiding impulsive decisions. Maintain a trading journal in real time, logging entries, exits, reasoning, and emotions. Take short breaks to maintain concentration and avoid emotional fatigue. 4. Post-market review. Conduct a detailed trade review. Record mistakes, good decisions, and areas for improvement. Assess key market events of the day and their impact on your strategy. Engage in a relaxing activity like a walk, reading, or socializing to unwind. 5. Recovery and rest. Ensure quality sleep for mental and physical recovery. Limit screen time post-trading to reduce stress and improve focus. Pursue hobbies unrelated to trading to maintain emotional balance. How to accelerate learning, turning one day of experience into 10 during the trading session. 1. Keep a trade journal. Document every trade, instrument, entry/exit points, risk level, reasoning, result, and emotions. Pay special attention to mistakes and their causes. 2. Focus on one setup at a time. Choose a specific trade pattern, e.g. damage support breakouts, and refine its execution. Post-session analysis. 1. Deep trade review. Write a summary of key trades. Analyze what worked and what didn't. Review charts to identify pattern performance and trading signals. 2. Discussion with other traders. Share insights and trades with peers. Explore alternative approaches to improve execution. 3. Mental replay. Close your eyes and visualize the entire process. Entry, management, and exit. Imagine how you could have executed better. 4. Screen recording for self-review. Record your trading session and review your actions in real time. Identify moments of hesitation, mistakes, or optimal executions. 5. Group trade reviews. Join or organize post-session discussions to dissect trade setups and market conditions. Additional reinforcement techniques. Visualization. Before sleep, replay successful trades in your mind, focusing on confidence and precision. Trading simulators. Rehearse trade setups under different market conditions to enhance pattern recognition. What-if scenarios. Plan for market contingencies. What if the level doesn't break? How will liquidity shifts or news affect the trade? Weekly integration for continuous growth. Summarize lessons learned each week. What recurring mistakes need fixing? What new insights or skills were gained? Set clear improvement goals for the following week. Trading is a long-term skill. Focus on the process, not immediate profits, and success will follow. Bouncing back after a loss. No trader is immune to bad days. We all know that sinking feeling, loss, shame, frustration, but even the best traders have 10 to 20% of trading days ending in losses. It's a normal part of the game. Trading demands split-second decisions, leaving no room for hesitation. Mistakes are inevitable. I used to beat myself up over them. How could I be so stupid? Am I even a real trader? But over time, I realized mistakes are just stepping stones to success. Your approach to losses defines your career. Each mistake is a lesson. Every red day is an opportunity to improve. Stories of those who never quit. Let me tell you about a trader we called the Playmaker. One morning he was down 2,002 ton early in the session, but instead of quitting, he stuck to his plan. By the end of the day, he had recovered every dollar. His words still echo in my mind. The market is open until 4 p.m., isn't it? Then there's Lucky Print, a trader who lost nearly $100,000 in a single session, yet refused to give up. By the closing bell, he had clawed back $65,000, showing resilience that only the best possess. Even on a smaller scale, persistence pays off. A beginner trader started his session down 100 but stayed disciplined and finished the day up 200. The amount doesn't matter, the lesson does. He made one good trade, then another, and turned the day around. The mindset of a winning trader. Mental resilience is everything. Sports psychologist Dr. Ari Kiev often compared elite traders to top athletes. They stay focused, control fear and doubt, and concentrate only on the next move. Yesterday's failure doesn't matter. A trader must think like Mariano Rivera, the legendary baseball closer. If he blew a save today, tomorrow he won't even remember it. One good trade, then another. Every trading day is a fresh opportunity. Your success depends on your ability to let go of the past and reset for the next trade. Fixing mistakes for long-term growth. Insanity is doing the same thing over and over again and expecting different results. Albert Einstein. Mistakes are an inevitable part of trading, but how you handle them determines your trajectory. Here's how to systematically eliminate errors and improve decision-making. 1. Deep error analysis. Don't just note what went wrong, break down why it happened. Was the mistake due to poor market analysis, emotional bias, hesitation? Identify the root cause. 2. Trading model reinforcement. Focus on repeating successful patterns and eliminating the ones that consistently fail. Confidence grows when you reinforce good habits. 3. Learn from others' mistakes. Study losing trades, not just your own, but those of experienced traders. Join trading groups, watch trade recaps, and analyze case studies to broaden your perspective. 4. Error simulation. Train in simulated environment to recreate past mistakes and practice better responses. Use trading simulators to rehearse different market conditions and learn from them. Buffs accountability system. Keep a detailed trading journal that not only logs mistakes but also documents successful trades. Review your journal regularly to ensure you're sticking to your rules and refining your strategy. Fixing mistakes isn't a one-time effort. It's a continuous process. The best traders constantly refine their skills, stay patient, and remain detail-oriented. Success in trading comes from relentless self-improvement. Stay in the game, learn, adapt, and most importantly, keep making one good trade. Respecting the market. Your perspective on the importance of market respect and discipline in trading is crucial. Here are the key takeaways. 1. The market is the ultimate boss. Disrespecting the market, ignoring risks, deviating from a trading plan, or breaking rules leads to inevitable financial losses. 2. Fighting the market is a losing battle. Ignoring stop losses and doubling down on losing trades is a classic mistake. Many traders try to beat the market but end up breaking their own rules instead. 3. You're competing with elite players. Hedge funds, institutions, and professional traders have massive resources and expertise. Discipline and precision are your only weapons against them. 4. Trading without preparation is a recipe for failure. Trading is like a high-level sport. It requires focus, quick decisions, and strategic execution. Rushing in unprepared will only drain your account. 5. Markets are unpredictable. As Keynes said, markets can remain irrational longer than you can remain solvent. Instead of trying to predict every move, focus on surviving and managing risks. 6. One bad trade shouldn't end your career. Betting everything on a single idea is reckless. The market doesn't care how smart you are. Disrespecting its unpredictability can wipe you out. Success in trading requires humility, discipline, and a deep understanding that every decision has consequences. The market is always right, and there's no room for overconfidence. The hedge fund meltdown, Brian Hunter versus John Arnold. The story of Brian Hunter and John Arnold perfectly illustrates how aggressive trading on volatile markets can lead to unexpected destruction. 1. Hunter's rise at Amaranth Advisors. A star trader, Hunter made massive profits trading natural gas futures. His success gave him unchecked control, and no one questioned his strategy. 2. Overconfidence and risky bets. Hunter kept doubling down on his long positions in natural gas, despite its notorious volatility. But when prices collapsed from $15 to the $4, his trades turned catastrophic. 3. John Arnold took the opposite bet. At Centaurus Energy, John Arnold was on the other side of Hunter's trades. Instead of reckless buys, he played smart. While Hunter's fund lost billions, Arnold profited $1.5 billion by exploiting his opponent's overconfidence. 4. Amaranth's $10 billion disaster. Hunter's reckless trades wiped out $5.5 billion in days, triggering Federal Reserve intervention. J.P. Morgan, his broker, saw the collapse coming. When Hunter ran out of cash, they seized his positions at a fraction of their value. Later, when gas prices rebounded, J.P. Morgan walked away with the profits. 5. The lesson: risk management is everything. Even top traders can be crushed by overconfidence. If you don't have billions to back your positions, averaging down on losses is a dangerous game. SNDK stock. Collapse, a costly mistake. Let me share a tough trading day involving SanDisk, SSNDK. Intel and Micron announced new products that threaten SanDisk. SNDK gapped down at the open, but we failed to recognize the risk. Expecting a bounce, we kept buying every dip and got crushed. After 5 losses in a row, it was clear the bounce wasn't coming. By the close, SNDK had fallen to 46 to 50 cents. Months later, it rebounded by 30 points. But that didn't matter. Intraday traders can't afford to hold overnight. The lesson: never fight the trend. If the market tells you you're wrong, listen. Skip story. Skip's story highlights the importance of remembering that the market can stay irrational longer than your funds will last. Skip was an intellectual focused on theory and fundamental analysis. He predicted the fall of stocks like Yahoo, Broadcom, and Amazon, but these stocks kept rising while he suffered losses, shorting them. His mistake was ignoring the most crucial factor, price movement, which is vital for intraday traders. During a meeting, a young trader asked whether it was wise to double the position at a certain level. I explained that doubling down on losing positions doesn't work long term. While it might result in profits 85% of the time, the 15% of losing trades can wipe out the entire account. My advice? Forget this strategy, especially in a market with limited ranges. When prices move toward an exit level, it's better to play defense than to counterattack. Never guess and always be prepared for the unexpected. The goal is to survive and save energy for the next day. Respect the market, mastering basic trading models. In the beginning, mastering basic trading models is essential. You can't start with large positions until you know how to work with smaller ones. One approach is using logical if, but then scenarios. For example, I trade stocks based on support and resistance levels. If a stock is at a support level, like STI at $16, I open a long position if the level holds and close if it breaks. This method helps in decision-making and minimizes risks. When MCD stocks dropped to $60, I bought, but the support didn't hold, so I closed the position quickly. Later, when buyers appeared, I bought again. With V stocks, I waited for the price to drop after failing to break the $70 resistance before buying. Each trade requires logic, and every trade is an opportunity to test new scenarios. I keep track of these scenarios. They aren't complex mathematical formulas, but proven logical connections. Also, adapting your strategy to current market conditions is crucial. In a weak market, you should wait for volume increases, while in a bull market, you can enter right after signs of bullish pressure. In a limited range, counter-trend strategies work best. For a successful trader, adaptability is key, but beginners should focus on basic scenarios. These simple yet proven methods will guide you toward profitable trading. Learn quick order execution. Most proprietary traders work on electronic markets. We're not on the exchange floor or futures pits, and we don't need to call a broker. Everything happens through the keyboard. Speed in entering orders is crucial because the speed of input determines the opening price. Practice entering orders daily. Our young traders spend 15 minutes every day improving their keyboard speed. Speed and ease are key advantages, allowing traders to quickly switch between positions. As electronic trading becomes more prevalent, developing this skill is essential to staying competitive. Companies like the Vanguard Group Inc. may take weeks to close large positions, but with speed, you can exit the market in fractions of a second. This is a significant advantage in competing with larger players. Point and click. A trader using a mouse to enter orders illustrates how slow execution can be detrimental for an active intraday trader. During one trading day, Steve, another trader, and I were trading MON stock. The price was under a critical resistance level, and we were short. When the price broke that level, Steve and I quickly closed our positions and bought the stock. But our colleague was too slow. His actions were too delayed. He was so frustrated that he broke his keyboard. Although we all use the same strategy, fast traders profit while slow ones lose. Despite my age, I managed to execute trades faster than the young ones, and it's speed that makes me successful. Lack of speed is something you can't compensate for with anything else. Sharpening focus. Steve is incredibly smart and reminds me of Tiger Woods. He shaped himself and is always ready to find a counterstrike. Even if the morning doesn't go well, he sees it as an opportunity for recovery. Steve's mentor, a market veteran, said he had never met anyone who felt so comfortable in the trading room. Steve fights for every tick, no matter his health or fatigue. He can track multiple stocks simultaneously and never misses a move. The fall of 2008 was extremely intense. Dr. Impulse, a young trader, by the end of the day looked completely drained, even though he was only 23 with 6 months of experience. He was so focused that by the end of the day, he was physically, mentally, and emotionally exhausted. The market demands such concentration. Emotional control. Me. I noticed you sometimes struggle with controlling your emotions. Developmentally delayed. Yes, but I'm seeing some improvement. Me. Great, let's work on that. For the next 3 days, write down what triggers you and send me the list for discussion. Developmentally delayed. Today I told myself I wouldn't get upset, and the results were better. Me. It's not that simple. We need to work on developing qualities that help control emotions. It's normal for most intraday traders. Intraday traders experience more stress than long-term position traders. We trade frequently and make mistakes often. If a loss knocks you off track, it can affect your next trades. That's when you start trading with a sword in hand. Emotional states cloud clear thinking. You become frustrated or upset, leading to decisions you'd usually avoid. This can affect your actions as a trader and result in negative outcomes. A few days later, developmentally delayed sent me a list of things that upset him. Most points were trivial, like exiting the market with larger losses than expected. I suggested a visualization exercise. Find a quiet place. Take several deep breaths to calm yourself. Imagine not being able to exit a position at your desired price. Recall the last trade that upset you and think about what it could lead to. Remember that emotional distress can cause you to miss great trading opportunities. Then do some more breathing exercises. Repeat several times. I recommend reading Dr. Steinhardt's work to understand trading psychology. I often read his material and recommend Trader Feed for amazing insights. Emotional control is essential for unlocking your full trading potential. Most traders practice visualization daily. Overcoming emotional weaknesses takes time and effort, but you can develop psychological strength. Just like G-Man, who, after mastering his emotions, became the head trader and later a partner in the firm. Good news, Mike, this is truly tough. But as Teddy Roosevelt, the 26th president of the U.S., once said, nothing in the world is worth having or doing unless it means effort. The good news is that you can learn all of this. You have a chance at great achievement. Many intraday traders have succeeded in various markets. In 1999 and 2002, they earned impressive sums. Despite the market crash in 2008, which wiped out many, that year turned out to be the most successful for us intraday traders since 2000. I share Andy Kirshner's cautious approach when discussing that time. You have to be careful when talking about those events. Everyone except us had a tough time, and when everyone around you is losing money, you inevitably feel guilty. The reward for developing trading skills is the ability to profit in any conditions. We make money because we are doing the best thing in the world. Now let's move on to stories of traders who failed and explore the reasons for their failures. Ahead are some fascinating stories and valuable lessons. Chapter 5. Why Traders Fail. You're sitting at a bar with friends having a beer, and you can't take your eyes off the charming bartender. Confidently, you walk up to the counter and strike up a conversation with the young woman. After exchanging a few words, she asks the standard question. Moshoam, what do you do? With a smile, you easily reply, I'm a trader. She looks at you, adjusts her hair, and responds, oh, I see. At worst, the evening ends with an exchange of phone numbers and your friends watch as you capture the lady's attention. In our world, the percentage of those who leave the market is incredibly high. Traders leave for various reasons, and in this chapter, I will share my experiences with those who have walked away. Some should never have started, others couldn't overcome the challenges. These stories will help current traders avoid common mistakes. The reasons traders leave the market are as follows. Unwillingness to accept reality, refusal to close losing positions, the desire to always be right, a flawed training program, treating the market as investing rather than trading, and a lack of love for trading. The last reason seems especially important. Many people enter the market simply for the social prestige of the profession without any real passion for it. Trading demands incredible stamina, discipline, and the ability to withstand intense pressure. It's a profession for those who can handle the stress and push through. For everyone else, this chapter is for you. They don't listen to the market. Too many novice traders are overconfident in their knowledge of the market. If Jim Cramer, a TV host and former hedge fund manager, can throw tantrums on TV and be right 50% of the time, then why shouldn't I be successful? Here's an analogy from the world of sports. I love golf, but despite enjoying watching tournaments, that doesn't mean I'll become a professional in the sport. I often hear from people going through training, I wish I had listened to you earlier. I mention this to help you avoid the same mistakes. You're at a crossroads. You can spend 6 months of your trading career not listening to anyone and learning nothing, or you can act correctly from the very beginning. After 6 months, you will have the skills for successful trading that you can apply throughout your career. Or you'll become a disappointed trader with a disastrous account balance. Many start losing money early and never master the necessary skills. On the following pages, I'll share stories of traders who made mistakes that I hope you won't repeat. By avoiding them, you'll gain an advantage over most beginners. The key advice for new traders: be attentive listeners. If you're lucky enough to join one of the best trading companies, listen and learn. Don't deceive yourself. Even if you've read many books and analyzed charts, that doesn't make you an expert. You don't know what you need to know, and you might not even realize it. The market is your boss, and it punishes those who don't listen. In our company, those who are in the top 5 traders today were the best listeners. One of them, Dr. Impulse, impressed me by quoting a complex idea I had mentioned several months earlier. With such attention and memory, it's no surprise that he became an excellent trader. How to become the best listener lesson. 1 says, become the most attentive listener in your class. One of my favorite political talk shows is Hardball with Chris Matthews. In his book, Life is a Campaign, he accidentally gives an excellent piece of advice to new traders and single men. When Bill Clinton was a student at Oxford, he had a reputation as a ladies' man. One day a friend approached him, unable to win the heart of the woman of his dreams. Clinton asked him, have you ever thought that maybe you need to listen to women carefully? Clinton used this strategy in his studies to earn excellent grades. He was known for his ability to predict exam questions because he paid close attention to what concerned his professors. This skill helped him even in difficult situations. The parallel between trading and Clinton's victories is obvious. The market is our professor. Our teachers, experienced traders, are ready to share the knowledge they've accumulated over years of working. But it's important to understand that attention to every word and every lesson can be the key to your success. I don't expect you to be attentive for our benefit. On the contrary, it's essential for your success. We demand attention because its absence can lead to catastrophic consequences in the market. The market has strict rules that can only be understood through years of experience. Ignoring these rules risks losing everything. Traders who don't listen will never master their craft. Trent, a great guy, a bad listener, and an ex-trader. If you're still unsure about the importance of attentive listening, let me share a story about Trent, one of my favorite but sadly former traders. Trent was a wonderful person, easygoing and fun, and everyone liked him. But as unfortunate as it is, he became the first trader to fail at SMB Capital. One day on St. Patrick's Day, Trent, G-Man, and I went to a college basketball game at a bar on the Upper East Side. There, surrounded by beer and fans, Trent invited his girlfriend and her sister, former Miss Florida, who clearly had a thing for G-Man. After a fun evening and dinner, G-Man, without thinking, told Miss Florida that he already had a girlfriend, which immediately ruined his chances for her attention. Trent, of course, was shocked by this sabotage. But this isn't just about personal relationships. Trent's story is closely tied to his inability to listen and take advice. During a risk management meeting, we discussed the danger of trading stocks with already open short positions, specifically TZOU. I warned that such stocks could be extremely volatile, with unpredictable price swings that could lead to sharp losses. But Trent didn't listen. Just minutes after the meeting, his trading account lit up on the screen with a red warning. He had bought 800 shares of TZUO despite our recommendations. The price didn't go up, and that was his last trade. Eventually, he left the market, but fortunately, he now has a good job. The moral of this story is simple. If you want to succeed in trading, listen and learn from experienced traders. Pay attention to market signals. Don't ignore advice, and don't become like Trent, someone who missed crucial lessons and ended up with nothing. The Genius Boy. I want to share a typical story that you can hear from anyone who teaches at private trading firms. The place, names, and dates may change, but the outcome is always the same. Some very smart proprietary traders simply don't know how to listen. I've often encountered sharp young men in training classes who couldn't listen. They weren't helpless, but it was as if they didn't exist. Let's call one of these students the genius boy. He ignored advice from experienced traders, including mine, and failing to follow my recommendations had consequences. When I sense that a trader isn't listening, I sit down with them privately and speak honestly and harshly. I explain that if they don't follow the advice, they'll leave the market. Telling the truth is part of my job. The genius boy was intelligent and academically well prepared. He graduated from a prestigious school, scored 800 on the SAT, was an active athlete, and had played blackjack for a year. His success in that game remained a mystery. When a beginner starts working at a trading firm, they're usually paired with a mentor. The mentor watches all their trades, checks if they're executed correctly, and answers questions. The trader should develop skills and follow basic rules. For instance, one should never miss a price moving against their position or trade a large volume of stocks. If a trader breaks these principles, they get a warning. The genius boy failed to close a losing position on time and had to work on a demo account. This is the most humiliating punishment for a trader. Beginners start with small positions, like 100 shares. If the price moves against them, they must close the position to avoid significant losses. Unlike institutional traders, intraday traders can quickly exit the market, which gives them an advantage. The genius boy's mentor had forbidden him from losing more than 20 cents per share. When he didn't listen, I had a strict conversation with him. He continued to doubt, and despite my explanations, didn't close his position when the price broke through the support level. I explained that after a support level is broken, you can't hold the position as it violates basic trading principles. He should close the trade and look for new opportunities. The genius boy agreed but kept doubting. A few weeks later, Steve invited him to the office. I noticed that he was interrupting Steve again, which really irritated me. I reminded him that respect is crucial, especially in trading. If you don't respect your partner or the market, you can't expect success. A month later, his mentor asked me to talk to him again. The genius boy kept making the same mistakes, and his losses were mounting. He even sent Steve an email doubting our methods. This was extremely strange. 2 months of trading, no profit, and he was still questioning basic principles. Steve and I explained to him that such actions couldn't lead to success. We taught him principles based on experience, not theoretical reasoning, but he continued to claim that he didn't see the point of these methods. A few days later, the genius boy left the company. He admitted he didn't want to keep losing our money. It was disappointing because his talent could have led to success. But he didn't understand that intelligence alone isn't enough for success in trading. They don't like trading. I'm interviewing a young talent in the office. He looks me in the eyes and says, "I'll work harder and longer than anyone else in the trading room." I hear these words at almost every interview. "I'll work harder than anyone" is the phrase most often said by candidates for private trading firms. Maybe it would be even more pleasant to hear, "I'm ready to work for you for free," though that would contradict the law. But the reality of training shows that not everyone is capable of giving their all. This training process is like an athlete's preparation before the season, 6 to 8 hours of work per day, watching trade recordings, keeping a journal, preparing for sessions, and analyzing. Every day, students do 15-minute visualizations, and on weekends, they review recordings. While others relax, they continue to learn. Diligence is often rewarded, but not everyone succeeds. Some mentors get frustrated by the lack of diligence in students. I believe the reason is simple. These people don't love trading. Many don't understand what it means to be a trader. This is only realized through practice. At an interview, you can talk about the schedule, but it's impossible to convey the reality of trading. Training days from 8 in the morning until 6 in the evening exhaust most beginners. Many like the idea of being a trader. It seems prestigious, glamorous, and rich. They imagine themselves on magazine covers next to models by airplane steps. But this fantasy won't become a reality without hard work. Trading requires hard work. By evening, your eyes are tired, your muscles cramp, and your hands shake from strain. On Fridays, it feels like you've taken 4 exams in a row. Not everyone has the energy to return to trades on the weekends. This is only possible with a love for trading. If you're not ready to meet the market's demands, failure is inevitable. The butcher, a hardworking employee who never let trading get the best of him. The story of the butcher, a former player on a college basketball team, clearly demonstrates that success in trading is impossible without a passion for the craft. The butcher, a graduate of an art school, was calm and self-assured during his interview. He swore to dedicate all his energy to trading, citing his basketball achievements, where his hard work earned him a spot in the starting lineup. During his training, the butcher proved to be a diligent student. Despite the tough selection process, his effort inspired trust. However, when the group moved on to actual trading, his results were disappointing. In the first month, only one session ended with a positive balance. Soon he began to worry more about how he was perceived by mentors than about improving his trading skills. His approach to trading was superficial. He would leave the office before the trade review sessions, arrive later than other traders, didn't keep a trading journal, and spent time reading sports news. Even the advice of experienced traders went unheeded. In 2 months, he only managed to finish one day with a profit, and his loss limits were regularly exceeded. At Saturday meetings, I always urged traders to have courage, reminding them that without discipline and passion, success is impossible. The butcher clearly wasn't ready to pay the price for success in trading. Eventually, he admitted that trading wasn't for him and left. Later, I learned that the butcher found a different job where he excelled. His hard work and discipline, which had helped him in basketball, played a key role again. However, in trading, he didn't stand a chance because he didn't love it. Without passion for trading, even the best mentor can't help. Inability to liquidate losing positions. One of the key traits of a successful intraday trader is the ability to accept a series of small losses. Analyzing their work shows that losses of 7, 5, 3, or even 1 cent are common. The main difference between a good trader and others is that they rarely allow losses to exceed a significant threshold, like 50 cents per trade. As soon as they feel the market is moving in against their position, they immediately exit. One basic principle of trading is exit a stock whose price is moving against your position immediately. This rule is drilled into beginners' heads at the early stages of their training. Those who can't grasp it sooner or later face ruin. The market does not forgive those who hesitate to close losing positions. Before each trade, you need to create a clear exit plan in case the piece moves unfavorably. For example, in the spring of 2009, I was trading WFC stock. After a positive financial report was released, the stock opened with a strong gap upwards. However, the trend soon changed, and the price began to drop. At the $18.25 level, it became clear that the bulls couldn't break through the resistance caused by a large sell order. I opened a short position, setting a clear stop level. If the price rose to $18.30, I would exit the trade and reassess my strategy. The price never reached that level, and the position was successfully closed at 17 or 60 pesos after the market stabilized. This example shows how important it is to have an exit plan. Even if it hadn't worked, I was prepared to accept a loss at $18.30. The ability to maintain discipline in such situations separates successful traders from those who lose everything due to the inability to liquidate losing positions in time. The market always rewards discipline and is harsh on those who ignore it. Smiley returned to Hong Kong. Smiley was one of those people who never fade from memory. His face, always glowing with a constant smile, seemed to symbolize the optimism that charged the entire trading floor. Smiley loved trading and reminded everyone of the famous baseball player Ichiro Suzuki with his charisma. He especially enjoyed trading the Goog stock, but he had a major problem. He couldn't exit losing positions. The situation was complicated by the fact that at that time, our company allowed a lot of freedom when selecting stocks. The youth of the company led us to let beginners trade with high volatility, like Goog. Today, this is unthinkable. The training and control over new traders are much stricter. Smiley was incredibly charismatic and friendly. I remember one evening when we were celebrating another company's success. He, usually quiet, unexpectedly launched into a long monologue about his love for trading. Smiley revealed that he had previously worked in computer graphics in Hong Kong, creating special effects for films, and had even turned down a job on Mission Impossible 3 to fully dedicate himself to trading. However, his problem with exiting losing positions was evident. We discussed it with him many times, but each time the story repeated itself. Smiley would confidently say, "I'll exit at 385 DYs." But a few minutes later, when the price dropped to $383 or lower, he would hold the position, hoping for a reversal. His inability to act decisively and follow his trading plan jeopardized his success. We tried to help him in various ways. We trained him on visualization, reviewed his mistakes, set strict limits, but nothing worked. Smiley remained profitable thanks to his passion for Goog, but one bad trade often wiped out all his gains. I especially remember the moment when he, sitting tensely in front of his monitor, stared at the price feed, ready to hit the sell button at any moment. He looked like a missile defense officer waiting for the order, but never pressed the button. The only thing that could make him exit the position was the end of the trading session or a directive from senior traders. Over time, it became clear that trading wasn't his true calling. Now he's back in Hong Kong, working again in action film production, and, as always, continuing to smile. Smiley will always serve as a reminder to me of how important the ability to take losses is in trading, because without it, success is impossible. Unrealistic expectations. As a trader, you can't get worse than you are now. Although, to be fair, some never progress. In the past, prop trading flourished, and unsuccessful traders simply sought new funds for their accounts. Today, everything is different. To become a successful trader, time is required. Company administration influences the timeline, but instant success is unrealistic. Newcomers often wonder how quickly they can start earning. Some say it'll take 1 or 2 years, but for most, consistent profits begin after 6 to 8 months. Some achieve success in a year, while others make profits in the first month. Your reward for hard work and learning will be the skills that allow you to earn for many years. Compare this to the career of an NFL quarterback. Few succeed in their first few games. Most, even stars, needed years of training. Likewise, a trader needs perseverance, practice, and the ability to adapt to the market. Only real trading can provide these skills. Beginner traders are often ambitious, but they quickly face reality. Success requires time. Newbies learn gradually from trading based on support and resistance levels to more complex formations. Each step helps solidify key skills. Some expect immediate success and make mistakes. They increase their volumes, lose motivation, or act impulsively. This only worsens their situation. It's important to focus on the process and accept that learning will take 8 to 12 months. If you're not ready to sacrifice time and effort, trading may not be for you. The first 6 months are the foundation for a future career. For example, I lost $36,000 during this time, but those numbers are insignificant in the context of a long career. In a few years, they won't matter. Remember, the results of the first few months are preparation, not an indicator of your potential. Becoming a trader is one of life's toughest challenges. Approach it with respect. You've earned the right to work on yourself to discover how successful you can become as a trader. Hollywood, a cautionary tale. Hollywood's story is one of talent, ambition, and unrealistic expectations. It highlights that success in trading requires not only skill, but also discipline, patience, and commitment to the journey. Hollywood had all the qualities of a successful trader: intellect, talent, and charisma. However, inflated expectations and a desire for quick success led to his downfall. In the beginning, his results were impressive, especially amidst market turbulence. But the internal conflict between seeking recognition and being ready to endure the challenges of trading led him to leave the market. The story also illustrates the importance of environment for a trader's growth. Hollywood thrived in a competitive and motivating atmosphere, but the shift to remote work disrupted that dynamic. It shows that success in trading is not just about personal effort, but also about the right environment that supports and inspires you. Interestingly, Hollywood decided to return, proving that lessons learned from past mistakes can be the foundation for a new beginning. A return, however, must be backed by a change in approach, not just the desire to recapture past success. I want to be right. The money will come. Traders, like everyone else, often struggle to admit their mistakes. They form opinions about how a stock should behave, and when the price goes against their expectations, they insist that the situation will soon change and refuse to close losing positions. Successful intraday traders, however, act differently. They quickly exit losing stocks, emotionally detached, without needing to prove they were right. Consistently profitable traders understand that controlling results is impossible. Holding a losing position to prove your point is unprofessional. The goal of a trader is not to be right, but to make a profit. In top trading firms, new traders are taught to focus on quality trades. The mayor. When our company was young, we had a standout trader who could be called the mayor. He came to the office either in a stylish tracksuit or an Armani tuxedo. This should have raised some red flags. There was no dress code, but now we prohibit sportswear and business suits. Before joining SMB Capital, the mayor had successfully traded options. He had a good feel for the market, held trends until they reversed, and was fearless. In his first days, he made over $4,000 and made sure to share this with everyone in the office. His energy was inspiring, and we cheered for him. He had a child in Europe whom he supported, so his bragging seemed harmless. The mayor reminded me of my first boss, Richard Tulisano, known as King Richard. Like Richard, the mayor was a well-known figure and loved trading. Over time, the mayor asked for permission to trade from home. We agreed, but one day we noticed he was holding a losing position on PD stock. Steve tried to convince him to close it, but the mayor insisted on holding it. The next day, the market did open higher, and the mayor used this to express his dissatisfaction with Steve's recommendation. However, Steve explained that a better exit could have been made before the session ended. Despite the arguments, the mayor continued to trade successfully, but found himself in the same situation with PD stock again. This time, Steve gave him more freedom. However, the stock sharply dropped, and the mayor refused to close the position. Eventually, Steve closed it himself to stop the losses. This led to an angry letter from the mayor. For him, being right was more important than making money. He couldn't let the price be the deciding factor. The mayor no longer traded at our company. We lost a little money on him but got rid of the problem. The price of PD stock never went up. This story teaches us that in the market, it's crucial to yield to reality and follow the price, not your ego. Remember, you're a trader, not an investor. Sometimes I jokingly remind young traders, you're a trader, not an investor. It doesn't matter where the stocks will be in a few years. Personal preferences have no place in trading. I once proudly bought a basket of tech stocks for my personal account, Amazon, Intel, Microsoft, and others. At first they rose and I thought my strategy was perfect. Buy, hold, and wait. But eventually the stocks crashed and I was holding losing positions, often losing up to 80 or 90% of their value. I used margin and didn't limit my losses, which was a fatal mistake. When the market collapsed in the year 2000, I didn't look at my account statements. It was a common reaction back then. People avoided looking at their balances because it was too painful. I remember a conversation with a stranger we gave a ride to from the stadium. He asked, "Where should I invest?" I honestly replied that I'm a trader, not an investor, but my explanation didn't convince him. I then said something that now seems absurd. I'm young, I can afford big losses. That was unwise. I realized that the risk of investing exceeds that of trading because I hadn't been trained in investing. During the 2008 banking crisis, people called me for advice, but I told them I wasn't a long-term investment specialist. My thing was trading. Give me a platform, charts in the market, and I'll show results. I learned this lesson for life. I am a trader, not an investor. I hope this story helps you avoid making the same mistakes. Your success depends on discipline and the right approach to learning. Chapter 6: Live to trade every day. You're in your 30s at the peak of your career. You're married with 3 beautiful daughters. You own a private investment fund funded by a small share of your trading profits. You have several apartments in New York, commercial real estate across the country, and a membership to an exclusive golf club. You spent your honeymoon in Fiji, drive a Porsche, and your personal trading account is growing steadily. CNBC invites you for an interview, and young traders seek to learn from your experience. You wake up each morning, excited to do what you love. Trade. Who are you? You're J. Tom, a senior trader at a private trading firm. You're a seasoned professional who lives for trading. The phrase live to trade encapsulates the mindset of a true market veteran. If you're persistent, good times will come. The key is surviving the market. Not everyone can do it. In this chapter, you'll learn about common mistakes that new traders make: self-doubt, the urge to predict the market, behavior that leads to firing, and rushing into trades. Stories from experienced traders, including J. Tom, will help you avoid these pitfalls and eventually earn the title of a successful market veteran. J. Tom, from obscurity to CNBC. A young trader, not yet 24, lies on a psychologist's couch, lamenting, "I'm afraid to enter the market. I just lost 80% of my capital. I don't know what to do." Don't know what to do. Wipe your tears, clean up, and start earning. Such situations are common. Successful traders often go through painful periods, searching for ways to survive. Whether through psychoanalysis, yoga, special diets, or cutting out toxic relationships. When J. Tom started trading, he earned 10 to 30% of his profits. His goal was to build his own account where all profits would go to him. To do this, he needed to increase the company's account by 250 Ts. He then borrowed another 250 won at 12% annual interest. To reach his goal, J. Tom needed to trade millions, and he did. But the market showed its ruthless side. In the first 3 months, he lost nearly everything, over $200,000. He was left with about $50,000. This would have led most traders into depression. But J. Tom didn't give up. He turned to a renowned sports psychologist, worked on his emotional barriers, and overcame his fear of trading. The psychologist taught him techniques that J. Tom still uses today. He started keeping a journal, writing out plans for every trade, and focused on strategies that suited his style. The market is brutal. It hits you, knocks you down, and waits for you to get back up so it can knock you down again. The choice is yours. Leave or stay. If you survive, sooner or later, fantastic opportunities will come. J. Tom loves telling a story from when he first started. He studied alongside a graduate from Lafayette College, who one day told the manager, "It's impossible to make money in the market." This was in September 1988, just months before the internet boom. That year, J. Tom made over $1 million, while his colleague left for a family plastics business. Don't get obsessed with forecasting. In my 12 years of trading, I've learned to feel the price range where a stock will stay 98% of the time. When the price is reasonable, I hold back. But as a day trader, I capitalize on short-term market inefficiencies. If the price is too low, I close a short position or buy. If the market is overbought, I close a long position or sell short. Sometimes panic orders from large players can move the market dramatically. These actions are not always logical and sometimes disrupt the usual flow. One of my approaches is an exhaustion trade. I open a position expecting the price to revert to its fair level. I know the market like Tiger Woods knows his shots, but the problem arises when the capital of unskilled traders causes significant price movements. This can knock me out of a trade with a stop loss, even though the market soon returns to normal. These situations happen daily. To avoid losses, I act only when the market confirms my opinion. As Mark Douglas wrote in The Disciplined Trader, act only after receiving confirmation from the market. When the price reaches the exit level, I close the position without hesitation. The market doesn't care what I think about the fair price. Young traders often make the mistake of thinking trading is about predictions or that their actions can move the market. This misconception can be very costly. Grumbler. How forecasting hurts young traders. We had a trader called Grumbler who loved the markets but was obsessed with long-term forecasts. He constantly asked me what oil prices would be in 6 months. I always answered, "I have no idea." But that didn't stop him. Grumbler stubbornly spent time studying reports to predict the future instead of developing short-term trading skills. Prop trading requires the ability to analyze data objectively. For example, in August 2009, the negative sentiment toward AIG stock blinded traders. They ignored clear buy signals, convinced that the stock would fall. In the end, the price rose from $14 to $50, and many traders suffered losses. Grumbler left us without ever learning how to earn from trading. Meanwhile, we as day traders successfully took advantage of oil price fluctuations in 2007 and 2008 without worrying about where prices would be in 6 months. Trading is not about forecasting. It's about acting here and now, using the opportunities the market gives. The market doesn't care about your opinion. Day traders don't engage in forecasting. That's the job of hedge fund analysts. We focus on price movements during the session, and our goal is to make money today, not build long-term predictions. As I tell my colleagues, prices are determined by institutional clients, not by me, and no one calls me to ask where the market is heading. This is an important lesson every trader must learn. Many young traders make the mistake of trying to predict the future, which leads to losses. The example of Grumbler, who tried to predict oil prices 6 months in advance, illustrates this mistake. He became fixated on the idea of falling prices, which distracted him from analyzing the current market situation. As expert Barry Ritholtz said, when the problem becomes obvious, just exit the market. Don't get attached to positions. If something isn't working, close the trade and move your capital to another stock. Young traders often get tangled in forecasts, but for us, the key is to observe the market and respond to its movement. If the price confirms an uptrend, we open a long position. If it falls, we short sell. This is the philosophy of short-term trading. Our actions are not based on long-term forecasts because we profit from current movements, not from predicting the future. The key is adapting to the market and making decisions in its conditions. Once you master this philosophy and develop professional skills, you'll be able to profit from price movements without trying to predict where the price will go. You must believe. Trading is not just about strategies and analysis. It's about confidence and believing in your own abilities. When a novice trader faces their first setbacks, the market can bombard their mind with statistics that seem to prove their incompetence. This can easily shatter confidence and lead to self-doubt, making them question their skills and systems. However, belief is what helps you keep going even after failures. In the beginning, results might not be as expected. Without faith in your ability to succeed, it's easy to lose motivation and just go with the flow, ignoring the opportunities to improve your trading system and approach. Your belief in success helps maintain confidence, even when trades don't go as planned. The market will try to knock you out of position, and if you don't believe in yourself, you'll likely give in to fear, closing a profitable trade too early or failing to close a loss when necessary. A confident trader won't panic. They'll stick to the plan, even if initial results aren't what they hoped. If you can't envision yourself as a successful trader, you won't succeed. But if you have belief in yourself and are willing to work on improving, gaining experience, and adjusting your system, success will eventually become very real. Belief is the key to overcoming challenges as a trader, and without it, it's impossible to develop the necessary skills and discipline. She just didn't believe. The story of CDT demonstrates how crucial belief in yourself is for achieving success in trading. She was smart, talented, and showed great results in training and tests, but her lack of self-confidence became an obstacle. This uncertainty stemmed from her previous experience in banking, where she lost money due to a very complex market situation. Despite all her achievements, she didn't believe she could become a successful trader at our firm. Trading is a field where a large part of success depends not only on strategy and knowledge, but also on confidence in one's potential. Even experienced and talented traders face doubts, but their ability to continue acting despite those doubts is what defines their success. CDT showed that she was ready to work and develop, but when faced with a challenge, she couldn't overcome her inner insecurity. This case highlights the importance of support and confidence, which mentors and colleagues can provide. My job as a mentor was to help CDT believe in herself and continue working despite her doubts. Unfortunately, she couldn't fully overcome her fears and decided to leave, leaving behind a great opportunity for growth. This story also touches on an important issue for women in trading, where their presence is still limited. Female psychology, as one trader explained, sometimes doesn't align with the demands of the profession, such as high uncertainty and confrontation with one's mistakes. However, despite this, there are success stories of female traders who deserve more recognition and attention. CDT could have become one of the successful traders at our firm if she had been able to believe in herself. Without confidence, it's impossible to fully seize the opportunities that the market offers. Firing. In private trading firms, when newcomers don't meet the system standards, managers hold discussions with them. I often remind them that they must be more attentive and fully dedicate themselves to the job. Our firm offers a chance to correct behavior, clearly explaining the expectations. If no changes occur, we ask them to leave. This is not a place for beginners who need to learn from their mistakes for a long time. In trading, it's important to work quickly and effectively, and if a trader is not able to do this, they cannot stay. Every newcomer must be prepared to work on themselves and improve their skills. If they cannot meet our standards, we have to make the difficult decision to let them go. This helps maintain the high standards of our firm, where results matter from the very start. AI. If you're not developing skills, you're not trading. During the last training course, 2 traders were asked to leave before they even began real trading. One of them, AI, was clearly not ready. He was often late and showed no interest in learning. Despite being a successful mortgage broker in the past with good math results, he couldn't focus and ignored instructions. His demo account was in horrible condition, showing a lack of preparation and discipline. Several experienced traders expressed concern about his attitude toward work, so I decided to give him a chance by assigning a 1-week trial period. AI claimed that he would perform much better on a real account than on the demo, trying to justify himself by saying he had trouble focusing in school. However, his results didn't change, and despite all my attempts to convince him, his behavior didn't improve. I explained to AI that if he wasn't ready to dedicate himself to learning, he wouldn't be allowed to trade real money. We can't risk the firm's money with someone who doesn't show the necessary responsibility. After a week, it was clear that AI wasn't ready to continue. I told him it would be better for him to leave, and perhaps another company might be a better fit. In our firm, he couldn't work without full dedication. Trading is not a game. It's a game that requires continuous improvement and attention to detail. If a trader isn't willing to develop their skills, they won't last in our firm. Know-it-all, how to get fired on your first day. On the first day of training, 2 hours into it, a new trader, whom I called Know-it-all, asked to speak with me. He had been self-learning for several months, and we had met a year ago, but he wasn't ready back then. When he came back, it seemed like he was ready to work. We started with a simple but important exercise on quotes. However, Know-it-all immediately expressed dissatisfaction. He considered this exercise a waste of time. He was already confident in his abilities and didn't want to follow the program, stating that he always ignored quote changes. Instead of learning, he tried to undermine the foundations of the course. He wasn't willing to listen and started criticizing the program just a few hours after starting. I patiently explained that trading is a game of probabilities, and even experienced traders can't always predict the outcome accurately. But Know-it-all kept arguing, convinced that he already knew everything. After I involved my partner Steve, he laughed at Know-it-all's complaints and suggested he take a walk to think about whether he wanted to continue. I realized that spending more time with him would be a waste, so I asked Steve to get rid of Know-it-all. He came to us with complaints, but wasn't ready to learn, and we couldn't allow him to continue. Latecomer. I'm not a cafeteria manager. In January 2009, a graduate from New York University, whom we'll call Latecomer, joined our class. He was a marginal candidate who barely made it through the selection process, but his math skills were up to par. At that time, our firm was experiencing growth, and I thought I could extract everything needed from him, even though his behavior was calm and restrained. He genuinely loved trading, so we decided to give him a chance. From the very first day, Latecomer was late to class. By the 3rd day after repeating this, it became clear that he lacked responsibility. I explained to him that being late is absolutely unacceptable. It's not only disrespectful to those who are learning with you, but also to the market you're going to work with. Time matters, and being late shows that someone is not properly prepared for trading. I told him that such behavior was simply not acceptable in our field. A few days later, on the 6th day of training, he was late again. I called him to my office, and our floor manager, J-Man, was present. This was useful for J-Man, as he would also have to deal with similar issues in the future. I told Latecomer that if he kept behaving this way, he wouldn't be able to work in trading because being late is disrespecting the market. The market will always punish you for such an attitude. It will take your money, leaving you without profit. We gave Latecomer a second chance, but he was late again, and I didn't talk to him anymore. We really valued him as a person, and he was talented, but unfortunately, he couldn't make the most of his opportunity. His behavior cost him that chance, and in the end, I told him that it would be better for him to leave. We said goodbye, and I wished him luck despite his lost opportunity. Bolt, a short-distance sprint. One of the most talented traders I've worked with started too fast. Bolt, named after the legendary sprinter Usain Bolt, was obsessed with the markets. On his first day of real trading, he provided me with technical levels for 10 stocks. One experienced trader said, "He just started and he already knows everything?" Bolt was a Carnegie Mellon graduate, had worked at a top-tier bank, and was determined to become a trader. I immediately saw great potential in him. He was energetic, always smiling, and joyfully trading. On his first day, he made 250 trades, handling 50,000 shares with a maximum position of 100 shares. Steve asked him to reduce his activity, but the next day his trading volume grew to 60,000 shares. I called him into the conference room and said, "There's no point in continuing. You're not cut out to be a trader." He was shocked. How could he not succeed when he knew so much about the market in all the levels? I explained that the market sets the rules, and you need to start slowly, focusing on gradual improvement. But Bolt didn't listen and kept trading with the same enthusiasm. By the third day, his trading volume exceeded 65,000 shares, and he continued losing money. Despite our advice, he couldn't stop. In trading, it's not enough to just understand the levels. You need to distinguish good trades from mediocre ones. Bolt was trying too hard, hoping his ambition would make him a great trader. We liked his attitude, but in trading, progress is key, not the desire for instant success. Trading is a game of numbers and opportunities. We teach traders not to trade large volumes at first, but to focus on skill development. Bolt couldn't manage his desire for immediate results, and after 2 months, we decided to part ways. He couldn't focus on what truly mattered for success. Sadly, Bolt now walks the streets of New York, thinking he didn't become a successful intraday trader. He started wrong, choosing too fast a pace, and judges his trading based on mistakes he made before mastering the necessary skills. Bolt could have become a successful trader if he'd started with the right approach. Delta Donkey, go big or go home. Our hurried number 2, Delta Donkey, came to us already an experienced options trader. We thought we could work with him when he wanted to switch to stock trading. On his first day, he made over $1,500, but his actions were disastrous. He doubled down on losing positions, waiting for a rebound. He was lucky to close one position profitably, but that was more of a miracle than skill. Afterward, Steve and I invited him to the conference room and pointed out his fundamental mistakes. Delta Donkey was overconfident and claimed he always knew what he was doing. He didn't take our feedback seriously. On the next session, he lost a significant amount of money, exceeding his loss limit, and the company suffered substantial damage. I told him our collaboration was over. I sincerely hope he's making a living from some unsuccessful job because his arrogance and lack of market understanding made him an unsuitable candidate. Delta Donkey didn't realize that options trading and stock trading are two different things. He came in thinking he could apply the same methods without proper adaptation. His qualifications didn't allow him to trade stocks aggressively. As our trader playmaker says, go big or go home. You can only trade large volumes when you're confident, otherwise you should go home and not come back. Not everyone reaches the finish line. We've discussed examples of traders who ruin their careers with mistakes. But there's another scenario. You might just not be good enough. Some people simply aren't destined to succeed in trading, no matter how hard they try. I've encountered traders who, despite all their efforts, couldn't achieve success. They followed all the instructions and advice, but still failed. Becoming a successful prop trader is like entering an exclusive club. It's not easy to do. Unlike other reasons for failure, not succeeding here is acceptable. Most unsuccessful traders didn't put in enough effort. They rushed, didn't listen, or didn't learn. Almost all of them could have done better if they'd worked on their weaknesses. But some just didn't have the talent to make a living trading on the stock market. Name just not good enough. We worked with a trader whose confidence was as unshakable as that of Joe Namath, the former quarterback of the New York Jets, who predicted his team's improbable Super Bowl victory. It's hard to understand why we tried so hard to help him, even though all our hopes were in vain. He spent 6 months with us until the last illusions disappeared. Namath was an early bird, always the first to arrive at the office, and actively participated in all the trade review sessions. He continued working even after we imposed stricter trading volume limits. Occasionally, we'd receive disgruntled emails from him, but eventually he accepted our decisions. His unwavering confidence in his abilities was remarkable, despite his constant negative results. He was an arrogant young man, and personally, I didn't like him. Although Namath wasn't the hardest working trader, he did his job. Sometimes he managed to finish the day in profit, especially on strongly directional markets. On the firm's best days, he was among the most successful traders. However, despite this, his overall performance was unprofitable. He lost a considerable sum for us. He often ended our conversations with, "I know I'll be a good trader." Yet, despite his consistent losses, his confidence remained unshaken. He never became a consistent trader. After a tough December in 2008, when we had to let some people go, Namath was on the list of candidates for dismissal. He had traded with us for 18 months, but still couldn't become a profitable trader. When we said goodbye, I told him that the experience he gained with us wasn't wasted. Professional trading requires endurance and character, and his market experience, even though unsuccessful, would be valuable in the future. He had gained certain skills that could be useful if he chose to become a broker or portfolio manager. Namath agreed with me, but his belief in his abilities remained strong. Even his dismissal didn't make much of an impact on him. Perhaps that was for the best, because we simply weren't the right fit for each other. He still believes in himself and his potential to become a successful trader in the future, just not with our company. There's nothing shameful about not becoming a successful trader. What matters is not giving up if trading is your passion. Even unsuccessful experiences will provide valuable insight into yourself. And although failures are often attributed not only to a lack of ability, they can be an important step towards success. Chapter 7. Selecting stocks for trading. You are as good as the stocks you trade. Many novice traders don't fully understand what stocks in play are, don't know how to find them, and waste time wrongly assuming that the market doesn't offer trading opportunities. In this chapter, I will explain how to find stocks for day trading, why and how we work with them, and share stories to help you better understand their advantages. I'll repeat, you are as good as the stocks you trade. Even the best trader in the world won't make a dollar if the stocks they trade don't move or lack liquidity. A good example is a trader we started with. He earned $18 million in 1 year trading stocks priced under $5. But the following year, he lost $20 million because he couldn't adapt to changes in the market. For day traders, managing time and buying power effectively is crucial. Unlike major players in the market, we don't have $50 million accounts managed by major bank dealers, especially after the 2008 and 2009 financial crisis. That's why we need to be able to find stocks whose prices actively change to achieve acceptable results on our modest trading accounts. How to find the right stock. Traders often ask me this question. For example, recently I received this message from Chuck. "Hi, Mike. Thanks for your comments on StockTwits 4. They inspire me to take action. Great job. I have a question. I'm terrible at picking stocks to trade. I go over charts every night, but it's not helping. Can you give me any advice?" Best, Chuck. First, I'm not entirely sure I'm a source of inspiration. I'm not Lance Armstrong, who won 7 consecutive Tour de France after surviving cancer, but it's still nice to read such letters. Second, I get questions like this often. There are many ways to select stocks, but in the end, it's best to work with stocks in play. What are stocks in play? Stocks in play are those stocks that provide the best opportunities for successful trading. These stocks have specific characteristics that make them appealing for day trading. Here are the key features. Fresh news. Stocks with recently released important news or reports. Pre-market price changes. Stocks whose prices change by 3% before the market opens. High trading volume. Stocks with a trading volume exceeding 3 million shares. Price movement. Stocks that move more than 3 points per day. Intense order flow and clearly defined intraday support and resistance levels that allow for effective trading. I often get letters from traders facing issues because they're trading the wrong stocks. For example, in August 2009, I received hundreds of letters from struggling traders who wrote, "You got into the wrong stocks." In such cases, my reply is always, "You're trading the wrong stocks, buddy." Many traders, especially beginners, complain about poor results. The reason is usually the same. They're trading the wrong stocks. There are different methods for day trading, but they all come down to one thing. You need to trade stocks that offer the highest potential for success. If you're spending too much time away from the market and complaining about a lack of opportunities, chances are your stock selection system isn't effective. We trade stocks in play because they allow us to use capital efficiently, offer the best risk-reward ratio for day trades, provide an opportunity to increase trade size, enable us to consistently execute trading ideas following rules, help us fight against algorithmic trading programs, allow us to use all our trading skills, accelerate the development of young traders. Often, over the course of several years, traders encounter very few days when no stocks in play are available for trading. It's rare when the market is asleep and there are no active stocks to trade. Some firms trade baskets of stocks or focus on trading exchange-traded funds, ETFs. Others specialize in futures or specific sectors like oil or pharmaceuticals. However, for us, day traders with limited resources, it's the actively moving stocks that matter. I want to be in the real game, applying my trading skills. After 12 years of trading in the stock market, I still discover new active stocks that can generate profit. All you need to do is find stocks in play, and even when the entire market sleeps, there are always assets worth trading. What is a good intraday stock? A good intraday stock has several important characteristics. Risk-reward ratio. These stocks always have the potential for price movement throughout the day. For example, a trader might risk a few cents to make a profit of several dimes. The ideal risk-reward ratio is 1 to 5, where the potential reward is 5 times greater than the possible risk. Liquidity. This is crucial to easily buy and sell stocks. Without liquidity, even if the price moves in the right direction, the trader may face issues when closing the position. Price movement. A good stock should show noticeable movement during the day so the trader can enter and exit with a good result. Clear direction. It is important for a stock to have a trend or a clear price direction to minimize the risk of uncertainty. Quote, quality. This means the stock should allow positions to be opened at favorable prices and exited close to the day's highs or lows. Absence of high short interest. Stocks with a large amount of short positions can be too volatile and risky. A good example of an intraday stock is one with strong movements throughout the day, like WIN or FLS. These stocks provide clear trading opportunities with excellent risk-reward ratios. Why you should trade stocks in play. Steve and I didn't always trade these types of stocks. Back in 2003, after traditional methods of earning stopped working, we began trading stocks in play. At that time, we were trading at a private firm, E-Trade, and SMB Capital didn't exist yet. We noticed that the market still provided opportunities, but it was important to pick the right stocks. In the past, we focused on tech stocks, but after the dot-com bubble burst, everything changed. We started paying attention to any stocks with unexpected news and began working with those that were moving. We created a stock selection system that allowed us to make money in the market. This system later became the foundation of our firm. Trading stocks in play helped us return to profitable trading in the market. Effective capital management. Traders at private firms don't often work with large accounts, which may actually be a good thing to avoid the stress that can be dangerous at my age. An important aspect of trading is effective management of buying power. A typical beginner trader starts with $100,000, and with leverage, their buying power increases significantly. However, as profits grow, so do the risks. We typically close positions before the end of the session to minimize losses. A good intraday trader can manage capital up to $800,000, and successful traders earn millions. Many don't realize the effectiveness of managing buying power. We are not investors, but intraday traders, so return on investment, ROI, is not always the best measure of success. As G-Man explained, traders at private firms start each hour with a certain amount of buying power depending on their experience and skill. Any losses incurred in the previous month must be recouped before money is paid out. Traders often make the mistake of evaluating profitability solely by percentages because success is not determined only by short-term profits. The most important thing is continuous professional growth, successful adaptation to changing markets, and skill development. The process of improving expertise will inevitably lead to better results. Success in stock trading also depends on effectively using the opportunities provided by stocks in play, which allow traders to make money even with limited buying power, spending minimal time on trades. Opportunities here and now. In August 2009, Dr. Steinberger wrote in his blog about the limited opportunities for intraday traders. He predicted that opportunities for trading U.S. stocks might become quite limited. Our traders were closely following his posts, and before the market opened, I received several nervous emails. Some of the email authors seemed to be convinced that we were preparing to move to Hong Kong. However, this anxiety only highlighted the strength of the stocks we were trading. Dr. Steinberger's prediction turned out to be true. Many traders on Wall Street were indeed struggling. Even powerful, experienced traders were facing tough times. Everyone was in trouble except us. That month was challenging for those who relied on big moves and specialized in specific sectors or baskets of stocks when their prices stabilized. But we, along with those I had trained, did much better. August 2009 turned out to be our most successful month of the year. And all this thanks to stocks in play, the last week of August. Something to remember. August is traditionally considered a quiet month, but in 2009, things were different. I had advised using the end of August for rest, but reality turned out to be full of surprises. The stocks in play were in the spotlight, stocks with active price movements. Even on the quietest days, traders found opportunities, and the last week of August 2009 became one of the most eventful of the year. The primary stock of focus was AIG, which surprised everyone with its activity. In the last 20 minutes of Wednesday, a movement began that continued throughout Thursday and Friday, and then into the following week. Traders in our room made significant profits. Lessons of the week: preparedness for the unexpected. Even if previous years were quiet, the current situation can be an exception. The AIG story demonstrated the importance of flexibility and the ability to quickly change plans. Focus on stocks in play. One active stock is enough to make the day profitable. In this case, traders preferred AIG over less profitable ETFs. Quick decision-making. A fast reaction to market changes helped maximize profit. That week proved that patience, flexibility, and the ability to adapt are the key qualities in trading. Even when the market seems dead, one active stock can change the entire year. Load up. The phrase "load the boat" has long been a cult term among traders. It means taking a large position, confident that the stock will provide excellent returns. In my first year as a trader, we hunted for strong tech stock closes and loaded up. This approach requires decisiveness and understanding when aggression is justified. AIG, the perfect stock in play. In August 2009, AIG became the stock that offered the perfect risk-reward ratio. For several days, the stock traded within a narrow range between $40.80 and $41.50. Everything changed 20 minutes before the market closed when the price surged by more than 5 points. The next morning, the stock opened higher than the previous close, dipped briefly to $40, and then went up again. Each dip became smaller, showing the strength of the buyers. A resistance level formed at $41.50. Why loading up was the right move. Factors indicating AIG's potential. The price was rising on positive news. The trading volume was enormous. The level of short positions remained high. The stock showed strength, staying above the resistance level. When AIG broke above $41.50, I decided to load up. The bulls had won, and the risk-reward ratio became incredibly attractive. At that point, I saw it as a unique opportunity, and it paid off. This was a big win, big boost. Stability. I'll now pass the word to my partner, Steve, who will explain how trading stocks in play helps intraday traders achieve consistent results. SMB Capital specializes in finding and trading these stocks. Every morning, we identify the most active stocks. However, many traders underestimate the importance of this approach. A trader's ability to earn consistently depends on the number of profitable trading days. For professionals, this figure is between 80% and 90%. For our trader, G-Man, it's 95%. Three key factors for success: mastery of entry and exit skills, ability to determine the risk-reward ratio, trading the right stocks. Stocks in play. Stocks in play stand out for high liquidity, which reduces risks, increased volatility, creating more opportunities, clean price movement due to strong order flow. An example is the RIM stock in December 2008. We identified it as a stock in play. On that day, 19 out of 22 traders ended the session in the black. Although I started the day with losses, by the end of the trading session, my balance was positive, thanks to the many opportunities. There are periods when it's difficult to find suitable stocks. In such cases, we trade ETFs or stocks with strong momentum. However, the preference is always for stocks in play. Trading during earnings season. Steve often shares comments about stocks in play. During the earnings season, many such stocks appear daily, but it's crucial to focus on just 2 or 3 of them. This allows for more focus and better results than jumping from one stock to another unsuccessfully. Before the earnings season in April 2009, Steve traded the FAS ETF almost daily. As the reports approached, he reminded colleagues that it was important to switch to stocks with upcoming news. The order flow in these stocks increases, leading to higher liquidity, volatility, and identifiable patterns with a favorable risk-reward ratio. During 7 trading sessions in April, Steve found a new stock in play every day. Even on the worst day, he made $3,000. His success was not only due to skill, but also his ability to choose the right stocks. Among the stocks he traded during that period were RIM, AAPL, QCOM, AXP, GS, MS, and AMZN. For example, QCOM stock on earnings report day provided excellent trading opportunities. Even beginners could profit, knowing the key resistance level at $42.60 to $4,300. AMZN stock also showed strong movement. The breakout at the 83 resistance level was an obvious profit opportunity. Trading during earnings season requires the ability to quickly adapt, find key levels, and focus on a limited number of promising stocks. This is the key to consistent and successful trading. Mr. Discipline, a victim of the wrong choice. Among the traders I knew, Mr. Discipline was one of the most disciplined. He traded well in a trending market and knew how to squeeze the most out of rising stocks. For 2 years, I never saw him eat anything but salad. His strategy was to find growing stocks, open positions, and hold them until the trend ended. But everything changed when the mortgage crisis hit the market. At that time, most traders switched to stocks like CFC, MBI, and ABK, which showed huge intraday moves. We were opening both long and short positions dozens of times during the session, fully exploiting the volatility. However, Mr. Discipline kept following his old filters, avoiding these stocks. The days of intense trading were exhausting. Constant focus, sharp market moves, and high stakes completely drained us. Even a distraction like a bathroom break could cost thousands of dollars. But it was in these conditions that younger, less experienced traders began to outperform Mr. Discipline, who was increasingly facing losses. His reluctance to adapt became apparent. We discussed with him the need to switch to stocks in play, but he was adamantly against it. He was put off by their high volatility and, as he put it, chaos. Mr. Discipline cared more about being right than making money. The market doesn't care about your preferences. It demands flexibility and the ability to follow the flow. But Mr. Discipline remained stubborn. Instead of adapting, he continued trading with his old methods, which no longer delivered results. Mr. Discipline's loss was a heavy blow to our firm. He was an experienced trader, and his departure felt like a personal failure. But the market moved on, and his place was quickly taken by young, ambitious traders. They adapted to the new conditions, trading stocks in play with enthusiasm. This story teaches us that the market doesn't tolerate stagnation. For success, a trader must be flexible, willing to change with the market, and seize the opportunities it offers. Stubbornness and ignoring reality lead only to losses, no matter how good you were in the past. The favorite, the importance of choosing the right stock. The favorite is a prime example of how choosing the right assets to trade and being willing to adapt can change a trader's career. His story shows the importance of flexibility and the ability to focus on what truly works. Initially successful trading gold stocks, Favorite encountered serious difficulties when the momentum in these stocks faded. However, instead of looking for new opportunities, he stubbornly stuck to his old habits, which led to a string of losses. This situation reminded him of an important rule. The market is constantly changing, and a successful trader must be ready for change. The turning point in his story began with the realization of the importance of environment in mentorship. After Favorite found himself surrounded by strong momentum traders and received their support, he adopted their approach to asset selection. Slowly, he began to focus on stocks in play, those with high activity, liquidity, and clear trends. This transformation brought him success, and he returned to being one of the top traders in the company. His story teaches, be flexible. When a strategy stops working, don't be afraid to change tactics or assets. Listen to advice. Mentors in the right environment can help you see things differently and find solutions. Choose the right assets. Trading should focus on the most promising opportunities, not personal preferences. Favorite showed that even stubborn habits can be overcome if you find the right environment and are willing to adapt. Don't be afraid of algorithmic trading. In July 2008, I received a message from futures trader Carter, who was concerned about the impact of algorithms on intraday trading. Carter's worries were shared by other traders as well. Many believe that algorithms, or black boxes, would push intraday traders out of the market. One user even sent me a rude letter asking, "Why do you still use humans instead of computers?" I had heard similar complaints in 2000 when quotes were switched to the metric system, and again in 2006 when the hybrid market emerged. A few important points. Algorithms have made trading more complex, but it's still possible. Successful trading requires careful asset selection, especially stocks in play. Incorrect choices lead to losses. The failure rate of algorithms is higher than that of traders. Many algorithms are created by people with no trading experience and are doomed to fail. To beat algorithms, you need to understand how they work, which requires time and practice. For example, in 2008, algorithms that ignored the rule "don't buy weak stocks" failed while trading FNMA, LEH, and FRE stocks. These programs were soon discarded. Successful algorithms are created by professionals, but the market is too volatile for perfect programs. A well-prepared trader will always outperform an algorithm due to intuition and flexibility. Algorithms often exploit traders' weaknesses. For example, a program may open short positions against buyers, driving the price down. However, if real volume supports the move, algorithms won't be able to hold back the rise. It's important to choose stocks in play that are supported by institutional investors. Complaints about the unfairness of algorithms are pointless. Traders must adapt, find ways to exploit the weaknesses of algorithms, trade against them, and seek out advantages. At the start of my career, market makers were the main players who also complicated our lives. Despite this, we found ways to profit. Obstacles and unfairness will always exist, but it's up to the trader whether they stay in the game. Algorithms are a part of progress. Technology has given us access to markets and new tools for trading. Instead of complaining, we need to learn how to operate in the new environment. Speeding up the learning process. Trading stocks in play is an excellent way to accelerate the learning process for new traders. The main problem for beginners is lack of experience, and the more market patterns you observe, the faster you progress. The experience of trading in high volatility conditions is particularly valuable. For instance, in the fall of 2008, when the volatility index, VIX, peaked, traders who began their careers during that time quickly learned many market patterns. Stocks with active price movement provide the opportunity to observe more patterns in a single day, which significantly accelerates learning. It's like a basketball player who takes 250 shots per training session instead of just 50. Trading one volatile stock a day can give the experience equivalent to several regular sessions. Professional mastery decides everything. In the trading room, you'll often hear me say, "This stock is no good. I won't be able to show my full skill with it." Although it may sound like a joke, the point is very serious. My professionalism allows me to trade effectively both long and short, which was rare in the past. Short sales were practically unused in the late 90s. My trading journal contains hundreds of variations of setups that I've studied and refined, enough material to fill a book. If a stock is showing active movement, I can trade it using various patterns and tape reading techniques. This gives me a competitive advantage, whether I'm going long or short, and regardless of the position duration, from a few minutes to an entire day. But if a stock is dead and lacks movement, even my skill will be useless. As my colleague Jay Tom says, these dead stocks won't pay for my Porsche and house in the Hamptons. How to find stocks in play. Stocks become active when there's fresh news about them, whether positive or negative. The most interesting news includes earnings growth, increased sales volumes, or the strengthening of a company's market position. My morning preparation starts with analyzing stocks that have moved by at least 3% before the market opens. Stocks that showed activity the previous day can also remain in play. Special attention is given to securities trading near important support and resistance levels. It's important to ask yourself, what would a hedge fund manager do with this stock? If the stock is potentially interesting to large players, it becomes an excellent candidate for trading. Good pre-session preparation allows you to focus on one stock throughout the day, extracting the maximum from it. This can include both long and short positions, active trades lasting milliseconds, or holding a position until the market closes. The session preparation starts before the market opens. Identify key support and resistance levels. Analyze news and charts. Review metrics like average daily volume, short interest level, and price range fluctuations. Filters and tools. On a quiet market, we use filters such as data from Trade Ideas Limited. This tool helps quickly find suitable stocks. Thanks to our collaboration with them, we can instantly set up filters for specific scenarios, ensuring we don't miss profitable opportunities. Idea table and briefings. Every trader fills out the idea table before the session opens, where they list the most promising stocks for trading. During the morning meeting at 8:30, key options are discussed, and the ideas author presents information on daily volumes, levels, news, and pre-session activity. Additionally, a meeting is held at midday, 12:30, to analyze how the situation is developing. If new active stocks appear during the day, this information is immediately shared with traders. If an alert goes off on the platform, e.g., when a stock hits a key level, the news is instantly announced in the trading room. However, experienced traders know that focusing on one or two key stocks throughout the day yields the best results. A trader's success directly depends on the quality of the stocks they select. For beginners, an essential skill is learning how to properly read the tape. This topic will be explored in the next chapter. Chapter 8. Tape Reading. Myths about tape reading. Many traders believe that success comes from charts and indicators. Common misconceptions include, everything is visible on the chart. Tape reading doesn't make real money. It's outdated. Only scalpers use it. In reality, tape reading enhances risk-reward ratios, helps predict price movement, and reveals market participants' intention. What is tape reading? Tape reading is the skill of interpreting order flow and real-time buyer-seller interactions. Similar to Level 2 data, it shows executed trades and key price levels. It helps identify market dominance, buyers or sellers, and anticipate price direction. In 70% of cases, tape reading gives an edge in predicting price movement. Personal experience. Early in my career, I watched my friend Steve Spencer become a top trader by mastering tape reading. He made hundreds of thousands monthly, relying only on order flow, no charts or news. During the dot-com boom, 1998-2000, top traders used tape reading as their primary tool. We ignored CNBC and charts, trading solely based on the tape. Lessons from practice. Many new traders neglect tape reading. One trainee relied on trailing stops instead of learning to read order flow. I explained that a successful intraday trader must recognize weakness in an asset by analyzing its orders. Tape reading is as crucial to traders as a driver is to a golfer. Ignoring it is like a basketball player refusing to practice free throws. What the best traders say. Top traders acknowledge the power of tape reading. Steve Cohen, Amen, SA Capital. Everything I do today is based on my early tape reading experience. Jesse Livermore. The market is a battlefield, and the tape is your telescope. In 7 out of 10 cases, it can be trusted. Linda Raschke. Tracking price behavior gives you a crucial edge. Paul Tudor Jones. I am a slave to the tape, and I'm proud of it. Conclusion. Tape reading is an essential art for understanding true market intentions. It reveals supply and demand dynamics, making it a critical skill for intraday trading success. Develop it and gain the edge every trader seeks. How to read the tape. What is tape reading? Tape reading is the real-time observation of order flow and price movement. It helps traders understand how large market participants interact with supply and demand and identify key price levels. Key aspects of tape reading, order flow in the order book. The tape displays buy and sell orders at various price levels, showing market depth. This helps traders assess support, resistance, and potential price movements. Speed and volume. Monitoring the speed at which orders are executed is crucial. Fast execution may indicate interest from major players. Large volumes often signal significant market moves. What to look for on the tape. Changes in supply and demand. The appearance or disappearance of orders can hint at potential price shifts. Support and resistance levels. Large orders at key prices can act as barriers to price movement. Market reaction to news. Important events instantly impact the tape, requiring quick interpretation. Why is tape reading difficult? Tape reading is complex due to the rapid flow of data and constant market changes. It requires focus, practice, and a deep understanding of market behavior. How to learn tape reading practice. The best way to master tape reading is by observing the market consistently. Experience refines intuition. Courses and training, educational materials, including video tutorials and lectures, provide structured learning. Mentorship. A mentor can offer guidance, share insights, and accelerate the learning process. Trading platforms and tools. Utilizing platforms like Level 2 data helps visualize order flow effectively. Predictive value of tape reading. By analyzing where orders are concentrated and how quickly the market reacts, traders can anticipate potential price reversals or continuations. Conclusion. Tape reading is a skill that requires time and dedication. Regular practice, studying key concepts, and learning to interpret order flow are essential. Success doesn't come overnight, but with effort, traders can gain a significant edge in the market. The tape is talking to you. During a trading review session with our June 2009 interns, we analyzed the stock's movement. As I watched the tape, I called out, "Buy." "Bella, why didn't you buy here?" Intern, "I wasn't sure about the move." Classmate, "Bella, why was this a buy?" Bella, "The stock is strong. It's in an uptrend with further potential. The market is also bullish. In this setup, you buy pullbacks. The buy signal was clear." Classmate, "What signal?" Bella, "They stopped hitting the bids. Buyers absorbed all offers at 95, 90, and 85 cents, while the bid held at 83 cents. That's our buy. Rewind the tape." I pointed out the key price action at 83 cents. We fast-forwarded. Within 3 minutes, the stock jumped 50 cents. It was like watching a quarterback read the defense before making a play. I didn't invent that buy signal. I didn't even know much about the stock, but I've spent years mastering tape reading, spotting high-probability trades with solid risk-reward ratios. These setups, we take them every day. Apple stock. Long live Steve Jobs. In late 2008, rumors swirled about Steve Jobs' health. By January 2009, Apple confirmed his medical leave until June. Trading halted, giving me time to strategize. When trading resumed, Apple opened at $78, 7 points lower. The tape showed sellers holding that level. That was my short signal. As price dropped to $76.50, a NASDAQ seller disappeared, signaling potential support. Later, resistance formed at $80.25. Tape reading let me profit both ways, shorting weakness and riding the bounce. It's like a conversation with the market, where each signal tells you when to enter and exit. Nail. Think like a trader. Tape reading isn't easy, but it reveals patterns that lead to winning trades. On the last day of his internship, Nail spotted Sina down 19% after weak earnings. He expected a bounce at $28.50. I challenged him. What if it doesn't? What if it breaks? A trader must prepare for all scenarios. Bias can be dangerous. I once shorted AMZN, expecting it to hit $85, but ignored the tape signals. When I finally adjusted my trade, I turned a losing position into a winner. A similar lesson came with HGSI. Initially, I hesitated to buy, but the tape told a different story. I listened and profited. Flexibility is key. Back to Nail. When Sina broke $28.50, we shorted. The stock dropped, locking in gains. He proved he had what it takes. Reading the tape, adapting, and making smart decisions. That's what separates traders from gamblers. I have a dream. It's not as grand as Martin Luther King Jr.'s, but it's mine. A dream about tape reading. One day I hope a trader, maybe even a rookie like Nail, will say, "Thanks for teaching me to read the tape. I sold just in time and avoided a 5-point loss." But that rarely happens. Traders constantly complain about selling too early. Almost daily I hear, "I closed too soon," tormented by the fear of missed profits. But no one ever brags about a well-timed exit that saved them points. It reminds me of a joke by Orny Adams. 9 times out of 10, I turn around to check out an attractive woman. 10 times out of 10, she doesn't look back. Maybe, just maybe, one day a trader will thank me. Ah, dreams. Dodging disaster. Here's how G-Man avoided a 20-point loss, though he never thanked me for it. In July 2009, after FSLR's earnings report, the stock spiked from 170 to 187, then pulled back to 180s before surging to 190. This made buying the dip tempting. G-Man planned to enter at 180 fair dog. Steve and I agreed it looked solid. But at 187, a heavy seller appeared. Steve hesitated, but G-Man, full of youthful confidence, jumped in awe. When bids at 185 vanished, the stock nosedived to 180. G-Man desperately tried to exit at 184.75. No buyers. Then 184.75, still no takers. The tape was screaming, "Sell now." He finally bailed at 181, narrowly escaping a disaster. The tape told the truth. The seller at 185.25 signaled trouble. When price failed to recover and buy orders disappeared, G-Man saw the writing on the wall. He minimized losses and later re-entered at $166, riding it up 5 points to end the day green. That's mental flexibility, battling high-frequency trading. In summer 2009, the debate over high-frequency trading, HFT, heated up. The blog Zero Hedge exposed how firms using supercomputers gained unfair market advantages, sparking congressional attention. Senator Chuck Schumer led the charge to ban flash orders, an early win for retail traders. HFT makes tape reading harder, but not impossible. At least, not for me. After finishing this book, I'll write an article for SFO magazine, diving deeper into HFT's impact. These algorithms are designed to take the other side of our trades, forcing us out. I once analyzed a bot I called the Buy at New Low program. G-Man described its creator as a PhD nerd with no clue about real trading. Still, every algorithm has a weakness. If you read the tape, you can beat them at their own game. Algorithmic programs destined to fail. Some algorithmic trading strategies are fundamentally flawed and will eventually disappear. Take the Buy New Low program. It activates when a stock hits a new intraday low, expecting short sellers to jump in. The program bets on a bounce due to low volume, forcing shorts to cover. However, this strategy never works below key technical levels and won't survive long-term. To quants, you won't succeed by blindly buying new lows. When institutional orders flood the market with millions of shares, they crush prices despite algorithmic attempts to prop them up. Many firms have collapsed trying to buy weak stocks at intraday lows. Short-term trading is still viable, but you must learn to work with algos, not fight them. Unlike quants, experienced traders respect risk and market structure. Mathematical genius alone won't save you. Markets demand adaptability. This article sparked heated debates in the trading community, which was my intention. Despite frustration with these programs, we adapt and continue trading. High-frequency trading and AMZN. On July 24, 2009, I faced high-frequency trading, HFT, in AMZN at $80.60. The stock was entirely controlled by HFT, making price direction unpredictable. My short-term trades, both long and short, resulted in losses. Instead of fighting HFT, I waited for clear tape signals. Eventually, strong sell orders emerged, and I successfully shorted at $85.90. HFT complicates trading, but it's not unbeatable. Certain patterns and timeframes should be avoided, like AMZN's erratic action at $86.60. If HFT disrupts your strategy, step aside. Don't let them take your money. Regulatory changes may come, but for now, traders must adapt. Key takeaways from tape reading. There is only one side to the stock market, and it is not the bull side or the bear side, but the right side. Jesse Livermore. Tape reading reveals the balance of buyers and sellers at key price levels. We watch order flow, look for strong bids or offers, and identify large, unusual volumes that form critical intraday levels. Understanding these dynamics is essential for navigating today's markets. Strong bid and key intraday levels. Strong bid. A strong bid occurs when significantly more shares are purchased at the bid than expected, typically 5 to 10 times the usual amount. For example, if a stock usually drops after 5,000 shares are sold at the bid, but instead 50,000 shares are being bought at the same price without a decline, that signals a strong bid. This often indicates a large institutional order. Why is someone aggressively buying at the bid? Likely they need to accumulate a large position. While not a guaranteed signal, a strong bid increases the likelihood of a major buyer in the market. When spotted, traders often take long positions. Key intraday level. One of the most important indicators for trade decisions is detecting high-volume price levels. When an unusually large order, sharpen, e.g. 5,000 shares, causes price movement, or when 250,000 shares exchange hands at a single price, that price becomes a key level. Trading strategy based on key levels. If price holds above the level with strong buying, enter a long position. If price stays below the level with dominant selling, take a short position. Unlike quick scalps, these positions may last several hours, allowing the market to resolve the battle between buyers and sellers. Once the level is broken, price seeks a new equilibrium, making patience crucial. Tape reading versus charts. Tape reading focuses on real-time order flow, identifying price levels where large trades occur before they reflect on a chart. Buy when a strong bid appears in an uptrend, as long as the price isn't near resistance. Sell when a strong offer appears in a downtrend, avoiding trades near support. Caution with media and institutional influence. The stock market often has a bullish bias, driven by institutions and funds aiming to attract capital. Financial media reinforces this sentiment. Unlike long-term investors, traders operate on shorter time frames, typically hours, not years. Successful traders don't follow media narratives but focus on real-time opportunities in the order flow, rather than reacting to institutional trends. Mastering new trading techniques. RIM trade analysis. Intraday trade on RIM, April 2009. This example highlights how tape reading and order flow analysis help identify false signals and react correctly to price movements. Market context. Friday, April 3rd, 2009. RIM stock rose by 20% by midday. Key support level, $58.50. The lowest price, $58.31. Resistance at $60. Despite price dips below $58.50, large buyers defended the level. By session close, RIM failed to hold above $60, but the sentiment remained bullish. Monday, April 6, 2009. Market open. The market opened bearish and RIM began falling. The opening price was below $58.50 and $58.31 broke down. After breaking this level, I entered a short position. Signs of a false breakdown. At $58.25 and $58.20, large buyers appeared. The sell-off slowed significantly. Weak stocks dropped quickly after breaking support, but RIM didn't. Tape reading showed a strong bid and aggressive buying at $58.20. Reversing the trade. Recognizing the false breakdown, I closed the short and entered a long position. The intraday bottom at $58.20 confirmed buyer strength. Key decision-making factors. Buyer strength. High volume at $58.20 indicated demand was greater than supply. Market sentiment. The bullish Friday session suggested strong interest in RIM. Order flow awareness. Tape showed sellers weakening while big players bought aggressively. Flexible thinking. Instead of blindly believing in a breakdown, I adapted to the market and went long. Trade outcome. Closed the long at $60, resistance. After a strong breakout above $60, re-entered long and exited at $62.75. Took one final long position before market close. Key takeaways. Tape reading wins. Order flow analysis exposed a false breakdown and gave an early long signal. No bias in trading. Always consider multiple scenarios instead of blindly expecting a trend continuation. Context matters. Market sentiment and stock popularity influence price behavior. Respect technical levels, but verify with tape. Support and resistance are useful, but their true strength is confirmed through order flow and volume dynamics. When to load up and still have limited risk. Proper tape reading not only helps to identify trading signals that are invisible on charts, but also allows traders to determine the right moment to significantly increase their positions while maintaining minimal risk. The moment of truth. AIG stock example. Summer 2009. August 2009 offered excellent trading opportunities, especially in AIG stock, which gained popularity among traders due to its high volatility and liquidity. One such day demonstrates how tape reading helped increase position size while managing risk. Market situation, morning fake breakouts. After the market opened, AIG dropped to the 25 level and traded within a tight range of $24.80 to $25.10. Price repeatedly broke through support and resistance levels, but these breakouts were false. These false traps could have shaken traders out of the market, but patience was key, waiting for the right moment. I waited for the tape to give a clear signal. AIG broke through the intraday resistance level and started rising on high volume, reaching 25.75s. The price then consolidated, forming a bullish signal. Bullish tape signals, slow retracements. After a rapid rise, the price only retraced slightly. Each dip was met with significant buy orders. Consistent bid above key level. Buyers dominated at 25.75, gradually pushing prices higher. Aggressive buying. Any of my buy orders were quickly outbid, signaling strong demand. Decision to load up. Once it became clear that the 25.75 level was holding, I took a large position. My stop order was placed just below that level, limiting potential losses. Trade outcome. AIG began to rise and soon reached $29. Tape reading allowed me to increase my position at a low-risk point and capture a large move. From the entry point, the position remained profitable, and I avoided floating losses. Conclusions. Tape reading not only helps in finding entry points, but also in managing risk. The tape confirmed that the 25.75 level was holding, allowing me to add to my position with a tight stop order. Patience is key to success. Instead of rushing to trade during false breakouts, I waited for a clear signal. Flexibility in decision-making. Tape analysis and its signals allowed me to minimize risk by avoiding premature actions. Tape reading is an art that gives traders an edge in decision-making. This approach allowed me to open a large profitable position while maintaining control over risk. The romance with charts. One of my interns, working at a neighboring firm, was obsessed with charts, believing they were the absolute truth. However, he couldn't read the tape or understand the market. His trading was more like gambling. Trading is about using models with a mathematical edge. Without this, success is impossible. Why can't we just rely on charts? One day I received an email asking about my actions when trading USO stock at the 32-hour level. The author wanted to know why I stayed in the position despite a temporary breakdown of the level. My answer, I opened a long position because the $32 level was a key support level. However, I didn't exit the trade when it broke the level because I didn't see aggressive selling on the tape. I used short stop orders and planned to exit only if the buyer's price dropped below $31.95. Often after a false breakout, a rally follows, and I wanted to avoid premature exits. Tape reading provides more information than charts. It's easier to work with than studying charts. Every successful trader I know first learned to read the tape and only uses charts as a supplementary tool. Charts are an art, not a science. Jim Mann, an experienced trader, analyzed BBT chart, noting a bullish pattern. He entered the market at $26.50, having spotted large purchases on the tape. This allowed him to calculate the risk-reward optimally. Many beginners are enchanted by charts but miss crucial information from the tape. One of my trader friends worked for a year without learning to read the tape and eventually left the market because his strategies were ineffective. Tape reading is more important than charts. Tape provides real-time information about market participants' sentiment. It helps identify strong bids, avoid false breakouts, and pinpoint entry levels with precision. Charts are useful for analysis, but they require a lot of time to study. Beginners should not rely solely on technical analysis. Even successful chartists first learn to understand the tape. In our company, I always emphasize, all the best traders learn to work with the tape. If you want to be successful, the choice is yours. How I read the tape. Many old school traders started with tape reading before moving to charts. However, even now, they still use their tape reading skills without realizing how much it helps. For example, they close losing positions when they notice strange movements on the tape or get better entry prices than younger traders due to their experience. I always exit a trade if what I see on the tape raises doubts. By observing the quotes and the seller's price reduction, I can predict whether the support level will hold. Sometimes my decisions are intuitive, and I can't always explain what I noticed. It's all about years of tape observation, which developed this skill. In our company, we invite interns to the trading floor to watch video recordings of trade analyses. One day, an IT manager from Goldman Sachs attended such a session. During the discussion of trades, I pointed out potential buys and sells. After the session, he approached me. Conversation with the IT manager. IT manager. Mike, were you trading BBT stock that day? Bella. No. IT manager. Then how did you know where the price was going? Bella. I read it on the tape. IT manager. But you were constantly right. Bella. I just feel the stock well. IT manager. Incredible. How do you do it? If you're a trader who hasn't mastered tape reading yet, your early career was probably tough. But don't despair. Print out your trade history, shred it, and start fresh. Relying solely on charts at the beginning of your career is like trading with one hand. You're missing the most important skill, reading the tape. Trading offers endless opportunities for improvement. Experienced traders know all the nuances of tape reading and use little secrets to improve their results. In the next chapter, we'll discuss a technique I call earning points. Chapter 9, Maximizing Profit. Some prop traders are satisfied with stable checks of decent amounts every month. But for me, that's not enough, and neither is it for the traders in my company. There's always a way to squeeze more out of a trade by applying basic quantitative methods. I call this earning points. Quantitative methods help maximize the profit-loss ratio. For example, a professional golfer might say, my shot is good, but I'm not always happy with the results. I don't have that problem. Since my shots aren't perfect, I focus on achieving maximum efficiency in every trade. Just like in basketball, commentators highlight those who simply throw the ball and those who consistently make the basket. A trader can make good trades throughout the month, but not extract the maximum possible profit from them. How's your performance? To learn how to extract the most from every trade, you need to master a few key things. Imagine you're working alongside a trader with the same skill level and the same abilities, trading the same stocks. Yet by the end of the month, their profit-loss ratio is much higher than yours. Economists call this situation ceteris paribus, all other things being equal. Let's discuss how to maximize your performance. It's time to figure out how to more precisely and efficiently sink the ball in the hole in the trading field. Setting daily loss limits. First things first, set a maximum daily loss limit. On good days, you might not lose any money at all, but most traders work 48 to 50 weeks a year, 5 days a week. Do you think you'll be able to close every trading session in the positive? As a trader with more than 10 years of experience, I'll be blunt. No, he's kidding. Trading is like sports. The result is evaluated by the outcome. The principle win or leave applies here too. Remember the commercial with Michael Jordan, where he talks about his failures? I've missed over 9,000 shots, lost over 300 games, and had 26 game-winning shots that I missed. I've failed over and over in my life, and that's why I succeed. Just like Jordan had bad days, you will have losing sessions. Do you know why coaches pull players off the court when they're having a bad game? Because sometimes they do less harm sitting on the bench. If you're trading below your level, you're harming not just yourself, but also the company providing you access to trading. That's why you need a loss control system. The first step, set a daily loss limit of half of your average net profit for the day after commissions. For example, if you make $1,000 a day, your loss limit should be $500. With experience, you can adjust the limit based on half of your profit from your last successful day. Even experienced traders must follow this rule. When I started, I considered myself a stable trader. But in the fall of 2008, constant price reversals led to massive losses. If your trading platform allows you to set daily loss limits, consider yourself lucky. At SMB Capital, we use the Lightspeed platform, and it saved me from serious problems. One day during a difficult trading session, my platform refused to accept new orders. Bella, is anyone having problems placing orders? Steve, no. Jim, man, everything's fine. Bella, what the, why can't I place an order? Brawler, maybe you've hit your loss limit. Bella, I don't even know what mine is. It turned out I had indeed reached the limit. It saved me from significant losses that could have occurred if my orders had been executed. Steve sometimes exceeds his loss limits, but we have a system of code words. When I call him Mr. Spencer, he knows it's time to close all positions. This saves him thousands of dollars each month. Even the best traders must adhere to loss limits. And this goes for you too. Features of trading at different times of day. For successful trading, it's important to account for the unique characteristics of each period of the trading session: opening, midday, and closing. This approach is supported by Dr. Steinberger's methodology, which emphasizes that each part of the trading day requires a specific strategy. Opening of the session. For me, the opening session is the most profitable period. This time window is when most of my significant profits are made, and my trading statistics confirm this. This stage lasts about an hour. During this time, I actively enter the market and try to increase volumes at the first suitable opportunity. The volatility at the beginning of the session is high, creating favorable conditions for executing profitable trades. Midday session. In the middle of the trading day, market activity decreases and price movements become more subdued. I use this time to reduce trading activity, entering the market less frequently, and paying close attention to stop orders to minimize risks. I only open trades when the risk-reward ratio is particularly attractive. My approach during this period becomes more selective and conservative. Closing of the session. Towards the end of the trading day, activity picks up again, and price movements become more directional. During this period, I focus on stocks that clearly show upward or downward trends. I gradually increase volumes, but even towards the end of the session, they don't reach the levels seen in the morning. Conclusion. Breaking down the trading session into phases helps me optimize my trading. In the morning hours, I focus on aggressive entries and volumes. During midday, I focus on capital protection and selective trades. And by evening, I work with directional movements. A statistical approach allows me to make the most of my strengths during each time period. Dangers of the midday session. The midday session, from 11 a.m. to 3 p.m., is the most challenging and unfavorable period for trading. Market activity decreases, volumes drop, and liquidity becomes thinner. Even a small order can cause a sharp price move, making forecasting difficult. Reasons for the unfavorable nature of the midday session. Low liquidity leads to unpredictable movements. Market activity decreases, making it harder to find good trades. Unexpected news can create chaos in the market. Recommendations for trading. During midday, focus and watch the market carefully. Reduce trade volumes to minimize losses. Open positions only at strong support or resistance levels. Quickly lock in profits and don't double down on losing positions. Tighten stop losses to reduce potential losses. Avoid excessive trading. Sometimes it's better to skip a trade. Gather information for trades before the close. Productive actions during the midday session. Look for trade ideas and analyze the market. Set alerts at key levels. Discuss ideas with other traders and test the best models. Danger of overtrading. Excessive trading during the midday session leads to losses and the erosion of profits made in the morning. To be successful, you must focus on the most favorable time periods and avoid unnecessary trades during weaker periods. Conclusion. The ability to avoid losses during unsuccessful periods is a crucial skill. The money you save is also considered profit. Stability. In every company, there are traders who have earned huge sums of money. Their names are well known, especially among beginners. New traders often overestimate these successes and try to emulate these seven-figure earners. They build success theories and convince themselves, I need to learn to endure pain. However, the truth is that most successful trades move in your favor from the start. Inexperienced traders often have the bad habit of holding on to losing positions, thinking it makes them stronger. In reality, this behavior only increases losses. Common sense and discipline are the keys to stability. First steps. In the summer of 2009, Mark Sperling, one of the greatest intraday traders, joined us from T3 Capital. Many people want to be like Mark due to his impressive annual returns. In a conversation with young traders, he emphasized the importance of patience. Greatness takes time. This process cannot be rushed or bypassed. At the beginning of his career, Mark stepped out of his comfort zone every day, honing his skills. His progress was slow but steady. Over time, he mastered his craft, making money every day. Novice traders often make the mistake of thinking that by losing $5,000, they will learn to earn that amount. But to consistently take $5,000 from the market, you first need to learn to make $500, then $800. Losses only teach you about losses. Some beginner traders underestimate making $700 in 17 out of 20 trading days in a month. That's already $11,900. With 3 days of losses of $500 in all, the total profit would be $10,400, an excellent result for a novice. Yet many aim for the illusory $10,000 a day, forgetting their skill level. I often see a young trader making profit for several days, but then one bad day wipes out all their progress. If you can turn such days from highly negative to neutral, your earnings will grow significantly. For example, G-Man finishes with a profit in 17 out of 20 trading days. I use the same approach. Novices should aim for this figure. Ask yourself, how much can you earn to be in the positive in 17 days? Achieve this result, and the next month will start with a better balance. Remember the words of Bill Murray and What About Bob? Baby steps, baby steps. Success comes step by step. Proper volumes. There's a myth that big money can only be made by trading large volumes. In reality, with a good risk-reward ratio, you can earn with smaller volumes, especially when trading stocks in play. Trading active stocks can yield consistent profits. Says. However, entering the market with a large volume on such stocks can lead to significant losses. Increase your volumes gradually as your balance and skills grow. Does increasing risk change your trading approach? A young trader asked me, Mike, if I increase my trade volume, for example, from 2,000 shares of AAPL to 7,500, how will this affect your adherence to the established rules? Under what conditions does your trading style change due to the high level of risk? When deciding on trade volume, I first determine the loss level at which I'll exit the position. It's crucial to know how much you're risking when entering the market. For instance, I can exit a position with minimal loss at a volume of 1,000 shares, but doing so with a 5,000 share volume in AAPL becomes more difficult. Key principles for increasing volume. The risk-reward ratio must be at least 1:5. If adding volume violates this rule, I'll pass on the trade. When the price moves favorably, it's easier to lock in profits with 1,000 shares than with 5,000. Increasing volume requires a high level of skill and strict risk management. Always remember that risk control is the key to successful trading. Franchise. Finding your volume. This conversation took place between me and Franchise in the fall of 2009. Bella, what happened today? Franchise. I'm working on doubling my volume. I can't figure out how to do it with some setups. Bella, I like that, but you won't be able to double your volume on all setups. In this case, you need to act selectively. The problem is that exiting such positions on some setups won't allow you to maintain the same risk-reward ratio. In 2008, we had an intern who asked one of the traders why we didn't enter every trade with 100,000 shares. Alan Farley put it well, experienced traders control risk, while inexperienced traders chase profit. The intern didn't last long. The fact of trading large volumes of shares does not, by itself, prove that you can manage large lots. Attempting to trade large volumes will only show that you can't handle the added risks. Volumes should be increased gradually and selectively. Approach this with understanding. You can't jump from trading 1,000 shares to 5,000 immediately. Remember, you can't pretend to be the trader you're not yet. Even Steve Cohen couldn't move markets with his volumes on his first day of work. Many of my readers have the bad habit of entering the market with large volumes and losing money. My inbox is filled with emails about such mistakes. Traders are discouraged by the results, often due to making unjustified trading decisions. Choosing the right share volume is an art that can be learned and will greatly improve your results. When increasing volumes, a significant obstacle is the psychological aspect. Jonell Straff from West Virginia University described the sunk cost fallacy in his article. A mental state where the likelihood of making a wrong decision increases with higher investment volumes. When a position is profitable, there's a temptation to close it prematurely. Franchise shared that he struggles with this flaw. All traders must overcome this barrier when they begin to increase their volumes. Visualization exercises can be helpful. 5 minutes a day is enough to create a mental picture, recognize mistakes, and understand the reasons for fear. In a few months, you'll be able to overcome this barrier. Ari Kiev compares this situation to skiing when you lose your balance but still maintain control. Why comparisons can be harmful. Comparing yourself to other traders is a losing game. While competition is natural, constantly measuring your success against others only distracts from your own progress. Success on Wall Street, or in any business, comes from competitive advantages, not from imitating others. Just look at Lehman Brothers and Merrill Lynch, which collapsed while trying to mimic Goldman Sachs. Ask yourself, are you truly in the same league as the trader you compare yourself to? Sitting next to someone in a trading firm doesn't mean you share the same potential. Even with similar training and strategies, results vary. Maybe they miss trades you catch. Maybe they struggle with holding positions you ride to profit. Your business is your own. Focus on running it, not on someone else's performance. The right mindset. Steve, you're becoming our best trader. Yapo Hippie, really? Steve, haven't you noticed? Yapo Hippie, I try not to pay attention to how others trade. As Steve once told me, before founding SMB Capital, he had no clue how others traded, and he didn't care. Why should he? Your only concern should be avoiding reckless traders who risk firm capital. Beyond that, focus on yourself. The greatest traders often stand alone because at the moment, it's lonely. Stay mentally agile. What if you have a strong market bias, but price moves against you? Can you still make money? Absolutely, but only if you're mentally flexible. This happens to me and Steve at least once a week. Pre-market, we gather data and form a thesis. But if an expected sell-off turns into a rally, we adapt and find ways to profit. This is trading, not investing. Some call it adaptability. I call it a preference for making money over being right. Many traders struggle to admit mistakes or flip their positions quickly. But as Jesse Livermore said, there is only one side of the market, the right side. Find it. Trading both ways. On a Friday in June 2009, our MBS was active. We profited from its rise as it approached a key resistance level at $17.80. Historically, after breaking this level, the stock tended to drop. That Friday and the following Monday, this level became our reference point, allowing us to profit on both the long and short sides. Day trading isn't just about identifying levels. It's about knowing which ones will hold and which will break. Using technical analysis, tape reading, and short-term fundamentals, we determined that $17.80 wouldn't break because sellers became more aggressive near the level. A double top formed. The long-term chart confirmed strong resistance. Buyers hesitated above $17.75. No news justified a breakout. I closed my long while Steve shorted and profited 50 cents on the pullback. By Monday, tape readings signaled a potential breakout. Buying pressure increased. When the bid held at $17.80, we went long. When it stabilized at $17.85, we added more. The stock rallied a full point. This trade wasn't just about charts. We combined tape reading and news analysis for a broader perspective. Successful trading isn't about guessing price direction. It's about being able to trade both ways. How do I make money today? On October 13, 2008, Steve picked MS as the stock of the day, expecting an early dip followed by a rally. On Friday, he shorted it, targeting a drop to $18. On Monday, he switched to buying, just like our top trader, G-Man. We teach traders to be flexible and trade intraday trends. In the past, I learned without charts or real-time news, just by observing price action. Today, if I lost my charts and news feed, I'd still trade profitably. If a stock rises, I buy. If it falls, I sell. Success isn't about predicting price movements. It's about reacting to them. For example, Friday, shorted MS at $18, covered at $17.50. Monday, bought at $18.71, sold at $19.21. New traders must abandon the illusion of predicting price moves. Instead, observe a stock's strength and trade accordingly. If it's strong, buy. If it's weak, sell. Your job is to execute one good trade, not make forecasts. Flexibility is key. Never cling to opinions when the market shifts. The only question that matters each day, how do I make money today? This is trading. In summer 2009, our trainee Kristen asked Steve to post a trade idea on Twitter. He planned to short AAPL below $138 with a tight stop at $138.15. The stock tested the level, failed to break higher, and dropped. Steve risked 15 cents to make $1. 15 minutes later, he flipped long at $138.10. Noticing strong buying, the stock climbed to $138.50, where he exited. Seeing continued strength, he bought again. By the close, AAPL reached $139.75. Final result, Steve lost 15 cents on 1,600 shares, but made about $1.50 on 2,000 shares. The key to trading is flexibility. Adapt quickly, trade both ways, and capitalize on whatever the market gives you. Amen. Corner in trading. In golf, Amen and corner at Augusta National is where the Masters' most thrilling moments unfold. In trading, my Amen corner was the 1825 level on WFC stock. A break below signaled short opportunities, while strength above suggested a long entry. As a day trader, I don't care about Wells Fargo's fundamentals. I react to price action. When WFC fell to $19, I shorted. Breaking $18.50, I added. Heavy selling at $18.25, more shorts. But once bids vanished below $17.50, the pattern changed. A sudden hold at $17.60 signaled an exit. Later, as WFC reclaimed 18, I shorted again, but quickly exited when buyers stepped in. After it broke resistance at $18.25, I flipped long, adding on dips. That day reinforced the need for flexibility. Sell weakness, buy strength. Brian Shannon's book is a must-read on trend following, which aligned perfectly with my WFC trades. Persistence pays off. Consistently profitable traders don't dwell on losses. They adapt. A young trader got stopped out of OSK at $18.67, then watched it rally back to $19. When asked if he re-entered, he admitted, "No, I was shaken out." A skilled trader accepts losses but re-enters when conditions realign. In this case, a second entry could have yielded $2,000 in profit against a $250 loss. Sometimes multiple failed attempts are needed before catching the real move. That's trading. Profits take time. Timing matters more than price. Jesse Livermore said, "It's not about buying at the lowest price, but at the right moment." I focus on high probability setups with strong trends and clean entries. If a trade doesn't behave as expected, I cut it fast. But when momentum builds, I scale up on catalysts like a strong bid absorbing sell pressure or high volume signaling a shift. Identifying these factors maximizes gains while controlling risk. Planning what-if scenarios. Every trade needs predefined scenarios. I map out key reactions to support resistance, breakouts, and reversals. For example, in MOS, I planned to exit if $48 support failed, but when it stabilized at $47.95, I went long and profited from the reversal. New traders often make emotional on-the-fly decisions, a critical mistake in fast-moving markets. Pre-planned if-then strategies eliminate hesitation and keep risk in check. Warren Buffett said, "Risk comes from not knowing what you're doing. Having a game plan minimizes risk and builds confidence." Roy Davis, head of remote training at SMB Capital. Roy Davis, head of SMB Capital's remote training division, emphasizes the importance of if-then scenarios for new traders. He believes trading without a clear action plan is a mistake. Scenarios should be pre-approved by mentors and trading floor managers and regularly updated. If-then scenarios in trading. Examples of structured trading plans. If the $30 bid holds after a retest, go long and hold. If the $30 bid weakens and volume declines, exit the position. If the $30 bid remains strong but the ask price rises, sell. If the $30 level breaks, close the trade. If the $30 bid is large, wait for a confirmation signal before selling. Pre-planning ensures traders react quickly and with confidence in any situation. Know your best setups. At SMB University, I stress the importance of recognizing your best trade setups. The more you focus on what works, the greater your success rate. Many traders don't identify their strengths, limiting their potential. For example, I never trade outside my best setups. I wait for the perfect trade, ensuring every decision is based on proven patterns, not emotions. Reviewing results confirms I'm playing to my strengths, even in less profitable months. Example, AMGN broke 30 files resistance, so I bought 3 lots. I sold 2 lots when the stock stalled, keeping 1 for a potential breakout. Even with some losses, I followed my trusted strategy, which is what matters. The goal? Execute high-probability setups consistently. 1,000 well-planned trades a month can lead to incredible results. How to end bad trading days. Every trader has losing days, but they shouldn't last. A trader at SMB Capital once asked for my advice after a rough session. I laughed, remembering my own worst trading days. At times, I thought I was finished, until I realized failure was just part of the process. It pushes you to improve. One trader recovered by focusing only on his best setups and reducing size. Soon, he was profitable again. If losses persist, cut size further to prevent deeper drawdowns. Some years have only a few great trading months, with long stretches of struggle in between. Adapting to market conditions and avoiding past mistakes is key. Confidence rebuilds when you lean into your strengths, even with smaller trades at first. Experienced traders make small adjustments and return to profitability. The market always presents new opportunities. Your job is to be ready. The cheetah and the trader. On January 15, 2009, a young trader told me he had lost his October profits and was struggling, just like many others. While I heard countless stories like his, I was having one of my most consistent months because I stuck to my system. Another trader, Joe P., rebounded by listing only the setups he excelled at. I praised his focus, trading weak stocks with good risk-reward. Keeping things simple is crucial. Confidence is everything in trading. When you doubt yourself, go back to fundamentals. Strong traders adjust and keep moving forward. Those who can't, they end up in another profession. To recover, list your winning setups and reduce size until confidence returns. J. Tom once sent me a quote. "The cheetah is the fastest animal, yet it hunts only weak or injured prey. A professional trader must do the same. Be the cheetah. Stay patient. Strike only when the opportunity is right. Failures are part of learning. Stick to proven strategies, avoid reckless trading, and always aim to end your sessions in the green." When I started, I was 36,000 down after 6 months. But 11 years later, I'm still here. Because, like a cheetah, I never gave up. Part 4. The Trader's Mind. Chapter 10. Trader Training. At the 2008 International Traders Expo in New York, a well-dressed gentleman asked me if the advantage of working in a proprietary trading firm was the purchasing power we provide. I briefly responded, "We do offer substantial margin, but the real value lies in shared trading ideas and mentorship from experienced traders." This chapter is dedicated to that gentleman and the essential aspects of trader training. The role of video review and trade analysis. Like athletes reviewing game footage, traders benefit from analyzing their trades through recorded screen sessions. At SMB Capital, we conduct 3 types of trade reviews: for partners, experienced traders, and beginners. During these sessions, we highlight critical moments such as the presence of large players, aggressive mistakes, or poor risk-reward trades. The goal is to encourage independent thinking and adaptability to market changes. Trade review is a crucial element in developing consistency and long-term success. Case study, improving order execution. One of our traders, Grand, was an optimistic and stylish professional deeply engaged in the markets. However, despite a successful autumn, his trading suffered in December 2008 due to excessive use of sweep orders, leading to unnecessary losses. Sweep orders allow for quick execution, but often at unfavorable prices. For instance, instead of buying at $7,500, he ended up paying $75.07 and selling at $74.93, losing money on execution slippage. Over 3 trades, he lost $170 due to poor execution. Given his monthly volume of over 2 million shares, saving even 1 cent per trade could yield an additional $20,000. After switching entirely to limit orders, his efficiency and profitability improved dramatically. His case demonstrates how meticulous trade analysis and execution discipline are essential for success. Case study, choosing the right trade size. Franchise, a determined trader and former Olympic-level swimmer, struggled with position sizing. He took large positions, 2,400 shares, on low-probability trades, 50% success rate with 1 risk-reward, while using smaller positions, 800 shares, on high-probability setups, 70% success rate, 1.5 risk-reward. This led to volatile performance, where he excelled some days but hit loss limits by 10:15 a.m. on others. We advise franchise to scale up only when the probability and reward justified it. He immediately applied these principles, refining his trade size strategy. Within months, he became one of our fastest improving traders, participating in trade reviews even on weekends when others relaxed. His success underscored a fundamental truth in trading: consistency and dedication separate top performers from the rest. Key takeaways. Video analysis enhances self-awareness and trade execution. Small execution inefficiencies can lead to significant losses over time. Proper position sizing aligns with risk, reward, and probability. Success in trading requires constant adaptation and discipline. Trading rewards those who are willing to put in the effort. Both Grant and Franchise demonstrated that growth comes from analyzing mistakes and making systematic improvements. The same applies to every trader seeking long-term success. And not just them. I also record my trades on video to analyze algorithmic programs, find places to add volume, and improve position holding. This helps work on the weaknesses in trading. Watching the recordings makes trading clearer. Emotions are absent, the risk of losing money is zero, and the market seems slow and predictable. Where in live trading there's chaos and uncertainty, the recordings often reveal clear trends and patterns that are missed during live trades. Such analyses teach how to add volume during strong moves and hold positions longer. They also help compensate for lack of experience and speed up learning. Just like basketball players improve shooting accuracy with practice, traders succeed through regular analysis. All it takes is a bit of time and discipline. Methods of mental preparation from leading psychologists. I'm familiar with the works of specialists like Ari Kiev, Dr. Breg Steinbrocker, Dr. Doug, and Mark Douglas, who emphasize the importance of a trader's internal preparation. For example, Kiev argued that traders must be both controlled and uncontrollable to succeed, like a downhill skier confidently descending at high speed. In our company, we focus heavily on psychological training. We teach techniques to maintain calm and focus, including walking and visualization. Once, our lead trader, G-Man, announced his resignation, which shocked Steve and me. Steve noticed that G-Man often had emotional breakdowns and suggested he work on controlling his emotions. In the past, traders were known to throw keyboards and curse, but such emotions are destructive to trading. Trading is stressful, especially day trading. One mistake can wipe out months of work. A good trader always walks a fine line, but constant stress requires self-work. We advise traders to take breaks to calm down and teach them visualization techniques to increase stress resilience. One of our traders learned to control his emotions with visualization, which helped him avoid large losses. Visualization programs the mind to stay calm in critical moments. Women, as it turns out, tend to master these techniques faster, so we encourage them to attend interviews more often. It's important to overcome weaknesses, such as the desire to prove one's point or the inability to exit a market at the right time. Visualization techniques help improve these weaknesses and enhance trading results. Mentorship. A good mentor can be key to your trading career. At the start of my career, I encountered markets that were easier to trade. For example, in the NASDAQ, there was a strong upward trend, and simply buying high-tech stocks was enough to succeed. This was simpler than today's more volatile market with algorithmic trading. It's tough for young traders to cope with today's market fluctuations, so mentorship is crucial. When volatility disappeared in 2009, which had helped traders in 2008, I tried to inspire the guys. I reassured them that despite the difficulty, opportunities still existed and the market could still be beaten. My confidence rubbed off on them, and they soon started performing better. The importance of a mentor in such a situation is hard to overestimate, as support and confidence can inspire success. G-Man. After G-Man overcame his resignation attempt, he became one of the main mentors for younger traders. His approach and strict discipline greatly helped newcomers understand the importance of making the right decisions in the market. One mentoring example from G-Man involved a situation in a declining market. When a new trader tried to joke and buy in a falling market, G-Man quickly reacted. The market is not bullish. He prohibited opening long positions, explaining that there was no reason to. As it turned out, the market continued to fall, and those who listened avoided losses. Another example with MS stock. When the market was weak and traders tried to buy stocks, G-Man warned them of a potential drop below $23. Those who followed his advice locked in profits when the stock continued to fall. G-Man not only helped them avoid losses, but also helped them make money. There's also the case with LVS stock. When one trader closed their position too early, G-Man criticized them and suggested not to fear pain and to hold the position longer. This advice taught the trader how to withstand tough moments in the market and avoid premature exits. A good mentor like G-Man gives clear instructions, helps understand important levels, and warns about potential reversals. In our trading room, we always have quick meetings, discuss strategies, and prepare traders mentally. We teach concentration, discipline, and self-confidence, and regularly remind them, make one good trade, then another, and keep going until you succeed. Dr. Impulse. Dr. Impulse was one of those traders who had a remarkable start to his career. In the fall of 2008, his momentum-based trading was incredibly successful. He skillfully shorted stocks like Goldman Sachs after they had already dropped by 10 points, making profits from falling prices. His aggressive trading style during the crisis, when banks were on the brink of bankruptcy, became his trademark. At that moment, he was in his element, successfully trading bank stocks like GS, MS, MER, and LEH. However, as winter 2008 arrived and the market stabilized, Dr. Impulse started to show less successful results. He had made enough money to feel financially secure, but his trading no longer brought in the same results. He began underperforming, and it became obvious. Steve and I offered our help. I explained that these moments happen to every trader and that it's not a reason to give up. I emphasized that failures are simply part of the learning process. I told him that it was important to adapt his strategy to the changing market conditions. His skills for trading in a rising market were good, but he needed to understand when to act aggressively and when to exercise caution. Dr. Impulse carefully listened to the advice and began to analyze his actions. We pointed out several trades where he was overly aggressive, which, in early 2009, proved to be unwise. He decided to adjust his strategy and try the FAS index fund, which rewarded his aggressiveness. With these changes, his performance began to improve, and Dr. Impulse started making profits again. This experience became a lesson for him. He understood the importance of adaptation and being open to change. The moral of this story is that success in trading is impossible without the ability to listen to mentors and adjust strategies in response to new challenges. Dr. Impulse's example shows how important it is to be receptive to advice and make timely adjustments to one's trading to continue achieving success. Conversations with beginners. I love discussing trading with beginners. A few days after they start trading, I gather them and ask how they're doing. One beginner was impressed with their self-critical analysis. I need to work on support and resistance levels, close positions with small losses, and make small profits. Another said, I need to react faster to good opportunities. I explained that it's important not to judge trading by profit or loss, but to focus on skill development and gaining experience. After a few months, I noticed those who are ready to take their trading to the next level. For example, IKA from the June 2008 group, who was making no more than $700 a day. I told him that you can make 1 in 500 a day. A few days later, his profit rose to $1,900. Later, I told him that a 5,000 day would be a great result, and eventually he achieved 4,000 a day. The key is helping traders realize their potential. My partner, Steve, is a great example of true mentorship. He fights for every tick and never gives up. Former trader BLUY, noted, experienced traders help beginners assess the market correctly. Knowledge and experience don't exist in a vacuum. Interacting with more experienced colleagues helps beginners grow and develop in trading. Learning from traders in the trading room. Interaction with colleagues plays a vital role in a trader's development. One of our young traders, KWY, stood out with his approach to learning. He actively involves more experienced traders in discussions, such as those regarding the FED situation, which promotes experience exchange. KWY is not afraid to initiate these conversations, helping him significantly improve his results. His desire for knowledge and eagerness to learn from more experienced colleagues helped him double his profits and transition from a good trader to an excellent one. KWY shows how important it is to be open to learning from others and to actively seek information. This drive could lead him to the top in trading. KWY, the role of communication with traders. KWY shares his thoughts on how communication with other traders helped him in his development. He started with simple questions to more experienced colleagues like Steve, Mike, and G-Man, to understand the basics of trading. As his experience grew, interactions with colleagues from his class became an important learning source, as senior traders may not always have time to focus on beginners. He actively exchanged experiences with traders from previous cohorts, asking how they dealt with challenges like trading large volumes of stocks and staying focused. Communicating with successful traders like DOV and Moneymaker helped him understand how to make big money. KWY didn't want to simply replicate others' actions. He aimed to improve and used communication as a stimulus for refinement. He emphasizes that while it's not a competition, constant mutual motivation and comparing oneself to the best traders are essential parts of the growth and development process in the trading room. TBW, the importance of adaptation and communication. TBW shares his experience of learning how to adapt to the market and use strategies that apply at different times. He explains that what became important for him was the ability to ask the right questions. For example, after noticing the success of other traders in energy stocks, he became curious about how and why the price of those stocks changed. He understood that only those who worked with those stocks could provide the answers. And he learned to adapt to market changes through communication with colleagues. He notes that the market is constantly changing, and you need to be flexible to stay successful. Mentors and communication with colleagues become key tools in this process. Adapting to the market and understanding which strategies work can only be achieved through this continuous exchange of knowledge and experience. J. Tom's advice for a beginner. One beginner, reflecting on his experience, explained how he used advice from more experienced traders to improve his trading decisions. He gave an example of trading FCX stock, where he planned to buy at around $29.50, but couldn't do so due to a high spread. When the price rose to $30, he hesitated to enter the market with a large position, but still bought a few shares. After the session ended, he spoke with J. Tom, who gave him valuable advice. J. Tom said that if the beginner intended to buy the stock before $29.50, he should have taken the risk and bought at least 100 shares to be in the market. Furthermore, if the trader was expecting a strong bullish move above $30, he should have kept more shares for the main position and not close them too early. This advice helped the beginner in a future trade with QQM stock. G-Man. The role of discussions and learning and trading. Discussions and strategies. G-Man shares how a conversation with colleagues on the roof of the Metro Hotel helped him realize the importance of flexibility in trading. He and several other traders discussed approaches to trading a phase E and concluded that, in momentum trades, he could afford to be more aggressive. However, his colleagues also understood that sometimes patience is key, and instead of reacting to every market movement, it's better to wait for pullbacks or rallies. This experience clearly demonstrates how exchanging ideas can help traders improve their trading. Learning through example. G-Man also shares an important moment from his practice when a young trader explaining about his strategy to another may have more impact than an experienced trader. He explains that a novice grasps an explanation with examples more deeply than a theoretical description with multiple scenarios. This also highlights the importance of communication among colleagues, especially between experienced and beginner traders. The importance of attending video review sessions. G-Man emphasizes the importance of participating in regular video review sessions, particularly for young traders. He tells a story about several successful traders who missed an important session, justifying their absence with fatigue or other commitments. G-Man explained to them that attending discussions not only helps improve their skills, but also enriches the team with new ideas. He used the 10-10-10 concept, proposed by Susie Welch, to show the consequences of their absence. In the short term, they might enjoy their freedom, but in the long term, missing such sessions would lead to a decline in the quality of their trading. G-Man is convinced that interaction between senior and junior traders is crucial for the overall success of the team. It creates a foundation for continuous knowledge and idea exchange, allowing each trader to improve and achieve better results. Scorsese. Mark is a trader who responds calmly to market changes and can profit from fast movements. He remains composed even in difficult situations, and this helps him in trading. New traders can learn from Mark to be momentum traders and react quickly to market signals. Z is a trader known for his calmness and patience. He can wait a long time for the right moment to trade and doesn't rush. If a trade doesn't go as planned, he calmly closes it. Z teaches the importance of patience and respect for technical levels. Andrew is a trader who prefers to work slowly, with a style similar to swing trading. He doesn't react to every signal, but looks at long-term trends. Andrew teaches discipline and restraint, although sometimes his emotions take over. Playmaker is a trader focused on large moves with high volumes. He's willing to take risks for quick profits. Playmaker teaches how to capture big opportunities, but such a strategy requires experience and fast reactions. Steve is a trader who works with liquid stocks and focuses on stable positions. He analyzes technical levels and volumes, helping him build a reliable trading process. Steve teaches discipline and attention to detail. New traders often learn from each other, absorbing the experience of their more seasoned colleagues. With experience, they begin to find their own approach to trading, and exchanging ideas helps them master the market faster. Oh yes, we have deep pockets. A few years ago, Steve and I decided to change the payment system for traders, offering them better conditions in hopes of reducing company expenses. It was a risky move, but it paid off. The cost of the business dropped by 10%, and the company became profitable thanks to improved trader performance. A private trading firm requires serious investments in infrastructure, technology, and resources, giving it advantages over individual traders. Traders working in such firms have access to better equipment and more purchasing power, allowing them to trade more efficiently. The essence of the idea is that as the company improves, traders' payouts become more generous. Unlike individual traders, the firm can provide far more resources and financial flexibility. For traders, this is an opportunity to trade larger volumes and, in case of success, share the profits. Private firms can withstand larger losses, such as a loss of $25,000 or $30,000, which would be catastrophic for an individual trader. In a firm, such losses are compensated by the successes of other traders. This approach helps minimize risks and allows beginners to learn without the fear of losing everything. However, not all traders stay with the company. If a trader doesn't show improvement, and they are asked to leave, even if they are losing money. We are willing to invest in training traders, but if the results don't meet expectations, we won't continue working with them. After all, the most important thing for the company is stable success in the development of traders. Applying trading rules. Sometimes the most useful thing for a young trader might be the answer no. No, you can't leave early. No, your loss limit won't be increased. No, you won't trade larger volumes. No, you can't skip the meeting. One day, when our trading room faced significant losses in the middle of the day, a meeting was called. I suggested that traders develop a set of rules to minimize losses and improve the situation. Some protested against the limitations, but they were quickly silenced by J. Tom, who reminded them that they were trading other people's money. This reminder worked, and soon a set of rules was developed, including a loss limit. No more than 30% loss from initial profits. If a trader exceeds the limit, their purchasing power is reduced. One of the first violators was a trader who tried to avoid punishment by coming up with excuses, like an urgent matter. However, the punishment was still applied. We don't make exceptions and strictly monitor compliance with the rules. Unlike independent traders who can justify violations by trading with their own money. In a private trading firm, punishments have real consequences. For example, if a trader is late for the opening of trading, they won't be able to participate in the morning session, as preparation is crucial for success. We track compliance with the rules and don't make concessions. Ushushka, applying the loss limit. One of our successful traders, Ushushka, faced a problem when, after a long period of success, he started losing money. He specialized in day trading RIM and AAPL stocks. But when his trading turned sour, we reduced his loss limit so he could focus on the basics and regain his confidence. The main goal was to limit trading volumes and rebuild his confidence. However, Ushushka consistently exceeded his loss limit, and every time it happened, Steve insisted that he stay in the office and observe the trades of other traders. This was part of the disciplinary process aimed at improving his trading. If a trader exceeds the limit, they must watch the market instead of going home. Occasionally, he was placed on a demo account, which made him unhappy. Ushushka tried to dispute the necessity of the loss limits, believing they limited his abilities. However, Steve explained that these measures helped avoid larger losses. The loss limit protected him from significant losses, and despite the temporary inconvenience, in the long term, it saved him from losing large sums. After several weeks of continuing to exceed the limit, Ushushka finally realized that the rules were necessary for his protection and development. He understood that the loss limit was the no he needed to avoid even bigger problems. This is an example of how discipline and adherence to rules can serve as a long-term benefit for a trader, even if they seem limiting at first. Joking in the trading room. In a good trading room, there's always an exchange of trading ideas. When you're trading, all you see is what's on your monitor. 60 pairs of eyes are much more productive than just one. We teach traders to exchange information quickly. The atmosphere in the room is always full of noise, but you should only react to the sounds that help you make money. Working in a trading room can be fun. It's much more enjoyable to trade with others than alone. It can drive you crazy being on your own, but I've had the experience of calm solo trading, and I enjoyed the opportunity to take a bit of a break during the sessions. Lighthearted teasing helps to spice up the daily grind. Trader Uncle B explains how exchanging ideas helps in the work. He often shares his trading preferences with other traders. The experience of others also helps him make the right decisions. When they trade together, everyone wins. One trader, wanting to be like Franchise, shares how he benefited from trading a stock recommended by Franchise. He saw the signal, opened the position, and made a quick profit. Without exchanging ideas, he would have missed this opportunity. Communication in the trading room is very different from the corporate atmosphere. There are no filters and no one wears a strict dress code. A trader's work is evaluated daily, and the criteria for evaluation are profit or loss. Trader ALG frequently jokes and creates a friendly atmosphere. He knows how to tease but never harms anyone. In the trading room, people often joke about themselves and each other, which helps relieve tension. Sometimes funny situations happen, like when J. Tom didn't hear a question live, and the whole team laughed at his hesitation. Sometimes jokes go too far, but the main thing is respect and support. In the trading room, you can always laugh and be yourself, but it's important to remember that everything is judged by trading results, not personal likes or dislikes. These moments make the atmosphere in the room unique, and communication between traders helps not only with learning, but also with boosting morale. Building trader statistics. Every successful trader knows their best trading setups. In the early stages, it's important to learn how to evaluate your actions. At SMB Capital, we use a deal tracking system, Chop Tracker, to analyze our trades. Young traders need to know what percentage of trades in a given setup is profitable. The question is, if you repeat the same trade 1,000 times, how many will be successful? We look for setups with a risk-reward ratio of 1 to 5, where more than 60% of the trades are profitable. For example, are you better at momentum trades than pullback trades? If so, focus on momentum setups. One of the firm's traders often trades stocks of gold mining companies. When they're active, his results are good, but from time to time, these stocks fall off the radar. So his overall performance doesn't always justify focusing solely on gold stocks. Recently, I praised him for a trade on a momentum stock that wasn't related to gold stocks and recommended he use his strengths and not limit himself to just one sector. One of our traders, G-Man, loves quantitative analysis. He developed a deal tracking system that helps identify the most successful stocks and the optimal time to trade. Every day, traders receive a printout with the statistics, which helps them make the necessary adjustments. For instance, we found out that many traders perform poorly during the middle of the session. This information made us change our approach, increase trade volume in the morning, and minimize it during the midday. Recently, the statistics showed that one of the most talented traders in the company has a habit of opening trades in the middle of the session, which doesn't yield good results. He continued doing this despite the failures. After discussion, we developed an action plan. Reduce trade volume in the middle of the day and look for more appropriate setups during that time. This trader was talented, but his approach needed adjustment. If he can follow the new rules, his results will improve. Personally, I tend to win more in the mornings, especially with momentum trades. It's important not just to memorize setups, but to understand what works for you. Once you identify successful setups, you can increase trade volume and hold positions longer. Stock 5 at the open, where I want to be. On April 30th, 2009, Stock V showed excellent movement once again. After the opening, the price quickly surged, and within 15 minutes, I made 3 points. This setup repeats itself, and every trader should master it. I often hear, this stock is scary. I missed the move. I don't like trading at the open. These are just excuses for missed opportunities. Trading stock buying at the open is not scary. After a strong close the day before, the price confidently moved up. The first ticks raised the price above $64. The bids never dropped below $67.50. This is a momentum trade that should be executed at the open. Later, the market pulled back, but I'm not interested in the company's fate, only the visible pattern. This setup, easy money. During one of our training sessions, a trader admitted, "Mo, I crush stocks at the open." It's really gratifying when a trader unlocks their potential and starts using profitable setups. Secret Project X, finding the most advanced methods of training traders. One day, sitting on the couch, I had the idea to create a method for training traders. Just like athletes perfect their game through training, traders can enhance their skills. That's how Secret Project X was born. The project required significant resources and effort, but G-Man turned it into a revolutionary training tool. The name Secret Project X reflects its uniqueness and power, changing the game's rules. The essence of the project is to allow our traders to practice. We record data on active stocks and create a simulator where traders can hone their trading skills. For example, working with Stock V. In the past, many were afraid to trade it. Now, with the simulator, they can safely practice before stepping into the real market. The brilliance of Project X lies in its ability to provide intensive training. Private trading firms value original teaching methods, and our project gives traders the skills and confidence they need. If you want to become a successful trader, training in a private firm is the path to success. We'll help you learn to work with the right tools, avoid traps in the market, and tell you when to adjust your strategy. Our goal is to bring you to a professional level, always ready for new heights. Chapter 11, The Best Teacher. New traders often think that the best way to learn is to simply copy the actions of successful traders. However, the key is to find the right teacher, not just mimic the actions of the best. In trading, there are many people who may be great traders, but even better mentors. Sometimes successful traders may not have striking personality traits, but can become excellent lecturers and mentors. This is the essence of teaching. For example, my friend who runs training sessions at one of the private companies wasn't the best trader, but he taught many successful traders. When I started trading, many people wanted to be close to successful traders to learn. However, it's important to understand that just because someone has great results, it doesn't necessarily mean they will be a good mentor. Many great coaches in history weren't outstanding athletes themselves. Phil Jackson, despite his minor career as a player, became one of the greatest NBA coaches. Bill Belichick, with no experience in professional football, became a legendary NFL coach. Pat Riley and other famous coaches also weren't great players, but they became exceptional mentors. This shows that great coaches were often not great players, but became successful due to their passion for teaching and helping others grow. Dr. Breg Standbarger, one of the best trading teachers, explained that great coaches are those who understand the game and have a passion for teaching. They don't just teach, but aim to develop their students. To be an excellent mentor, one needs to possess traits such as obsession with finding the best teaching methods, high motivation and communication skills, ability to understand the individual traits of each trader, firmness when needed, and belief in their students. Thus, finding the right mentor and understanding a trader's struggles can greatly improve the quality of their trading. The eternal dissatisfaction. Good traders are always striving for perfection and continually refining their skills. This process doesn't end with reaching certain goals. Even successful strategies and methods require review and improvement. The training program, developed at SMB Capital, is constantly updated and refined. New tools are added, such as webinars, educational videos with profitable trade commentary, and ambitious projects like the Secret Project X. A trader who aims to be good is always working on themselves. They review their trades, search for better strategies, and improve risk management. The road to success requires much effort, as creating effective educational programs, videos, and trade model descriptions all demand constant time and labor. An interesting moment came when a trader asked, "Bella, in what area are you most competitive?" This question made Bella reflect on his role. He feels comfortable among traders and calm, like a coach during tense matches. Calmness is a crucial part of a mentor's work, and it leaves an impression on students. However, for Bella, the greatest challenge is creating and developing the best intraday trading training program and ensuring the company's growth and success. Being the best trader on Wall Street is no longer his goal. He's focused on helping his students achieve that. This trading floor manager, Mordovorot, although a disciplined trader, humorously pokes fun at the constant changes and improvements in the training program. For him, like for Bella, it's important that training is a living process, and each version of the program becomes better than the last. The Secret Project X, which has invested significant resources and effort, is another step toward improving trader education and ensuring their success. High motivation. For a great trader, motivation to create an effective educational program may seem non-obvious. A person earning millions of dollars is unlikely to be distracted by helping beginners master the basics of the profession. However, at SMB Capital, the approach is different. Here, ambition goes beyond personal success. Filling the trading floor with 150 successful traders is a goal that brings not only financial rewards but also a deep sense of fulfillment. Bella views creating the firm and the training program as a challenge that allows him to unlock his abilities on a new level. His business partner, Steve, recognized as one of the best intraday traders on the stock market, initially approached the idea with some skepticism. The first proposal to create a trading company made Steve laugh, immediately calculating possible losses. His reaction was understandable. For a successful trader, mentoring might seem like an unnecessary risk and responsibility. However, Bella saw enormous potential in this project. For him, creating the company was a way to move forward because trading alone was no longer enough. Bella began working on the project alone, gradually involving Steve in the process. Despite initial doubts, Steve became involved, and there was no time left for objections. Over time, both partners realized that creating an outstanding training program and managing a successful firm was worth all the effort and sacrifices. Even if weekends had to be spent on tasks that ordinary traders don't engage with, it became part of their journey. For Bella and Steve, their joint venture turned into something more than just a business. It became their mission, capable of inspiring others and laying the foundation for future generations of successful traders. Clear communication. A good teacher always possesses excellent communication skills, unlike many outstanding traders who often struggle to explain their methods coherently. For example, the best trader at our firm, a former Russian chess champion, had a complex accent and communication difficulties, which hindered his ability to convey his knowledge effectively. When SMB Capital was considering opening an office in India, we discussed the structure of the new branch. During the meeting, I explained that for the office to succeed, we would need not just a successful trader, but someone capable of teaching, mentoring, managing, and developing a team. Finding a specialist with these skills was extremely difficult, so we proposed a business model where SMB Capital would take on the key role in training and administration. However, the entrepreneurs deemed this plan too costly. Recently, I had lunch with an outstanding trader who, despite his communication skills, struggled to teach impulse trading. He was surprised when he learned about our approach, which turned out to be more effective. Teaching impulse trading is a challenging task, but for a good teacher, it's achievable. According to Chip and Dan Heath in their book Made to Stick, information should be simple, unexpected, concrete, credible, emotional, include stories. Trainers should use these principles in teaching trading. Just as a great trader identifies key levels on a chart, A good teacher can clearly convey what's most important to their students. But do great traders themselves possess the patience and skills for this? Laying a solid foundation. An outstanding trader can develop a complex trading system that a beginner simply can't use due to a lack of experience. A system designed for a professional may be too complicated for a novice. For example, an experienced trader can easily open a large position with 70,000 shares of SKF, but for a beginner, this would be an overwhelming task. A beginner should start with smaller volumes, like 300 shares, to learn how to manage risks. Successful traders continuously adapt their systems. They make changes daily, monthly, and even within a single trading session. Over my career, I've completely changed my trading system 6 times, navigating through the Asian crisis, the high-tech stock boom, the internet bubble, the September 11th events, and other crises. The market is always evolving, and instead of seeking the perfect system, one should develop skills that allow adaptation to new conditions. Beginners should start with the basics. Just like an architecture student first learns the fundamental principles of design, a new trader must focus on trading skills, discipline, and emotional control. Building a successful career begins with mastering simple and proven trading models. The first thing a young trader should do is learn to trade. RIM stock, learning to trade. One of the traders in our company complained that he was stopped out of a trade on RIM stock. During the morning meeting, we identified a resistance level at $82. Steve planned to open a short position at this level, and the stock was even called the best for morning trading. Steve opened the short position at $82, but he was stopped out at $82.32. After that, the stock dropped to $79. He was sure it was the market makers hunting for stop losses. My reaction, seriously? Didn't we discuss this in the lectures? It seems he missed part of the material. Trading isn't just about selling at a resistance level and expecting a collapse. False breakouts, like with RIM, require flexibility and skill. Working with levels. At $82, there was resistance. Sometimes the price holds, but at the market open, when volatility is high, breakouts happen more often. The stock may briefly rise above the level to flush out weak positions. Short positions should be opened gradually. Sell in small amounts and watch the price. If it moves higher, sell a little more, like at $82.17. The next resistance is at $82.25. If the price holds above, close the position or wait for confirmation. If the position is closed and the price returns below the level, enter again. Now the chances of success are higher, as many participants with long positions will be forced to close, creating downward pressure on the price. Flexibility in trading. Trading at resistance levels in the early session can evolve in different ways. You must master all possible scenarios. The likelihood of a breakout is usually lower than the probability of a price drop, but this requires the ability to adapt. Trading isn't about mechanically following levels and stop losses. Laziness and a superficial approach lead to losses. Trading requires preparation. At the 2009 exhibition, I saw a system where they suggested buying when the screen is green and selling when it's red. Their booth had more people than ours. This illustrates how the desire for easy solutions leads to losses. The market changes every day. To remain successful, a trader must constantly develop skills and adapt to new conditions. You say tomato, I say tomato. One of our top traders once confessed that he envied Steve. Steve can track 8 positions simultaneously like a supercomputer. However, attempts by beginners to copy successful traders often lead to failure because they lack the necessary skills to work with complex models. A true mentor helps develop skills so that a trader can find their own style. As Los Angeles Lakers defender Derek Fisher once said about Coach Phil Jackson, he doesn't try to control us, but gives us the opportunity to be ourselves. The story of Boris Stein from Stein Management, a LLC, highlights the dangers of imitation. In an interview with Traders World magazine, he recalled how he lost money trying to trade by the book. In '96, I placed a stop order to buy the S&P above the current price, and then a protective stop loss under the price, all according to recommendations from a book. When the market fell, my stop loss was triggered. I lost $5,000 in 25 minutes. I bought at the daily high and sold at the low. I still can't believe it. Most likely, an experienced market maker recognized the inexperience of the trader and took advantage of it. Stein realized that success in trading is impossible without understanding the basic principles and creating a personal system. At SMB Capital, we practice active, short-term trading. However, this style is not suitable for everyone. I have advised some traders to switch to companies focused on long-term strategies. As Ed Seykota says in Market Wizards, there is no single best system, just as there is no best car. But there is a system that works best for you. Some traders feel more comfortable working with fundamental analysis and making slower decisions. For them, the short-term strategies at SMB Capital were too complex and required instant reactions. In such cases, it's important to find a trading niche that suits your skills and preferences. The Chart Conqueror. One of the traders we had to let go from SMB Capital earned the nickname Chart Conqueror. He was very intelligent, often sending me articles from journals I missed, and discussing various political topics. This trader was very active in chats and forums, enjoying the new world of trading. When we started working, our office was cramped, and I was offered to let go of the Chart Conqueror to free up space. I refused, as it was clear to us that it is the traders who make the company, not the back office. I even stated the company should work for traders, and we will never fire those who strive for progress. The Chart Conqueror was the most optimistic trader, and his successful trades were discussed for a long time. He reminded me of a golfer who recalls a rare stroke of luck on the course. However, despite his enthusiasm, he couldn't generate consistent profits. We realized that his style did not align with our company philosophy. We allowed him to leave, but he found success as a futures trader. He continues to send me articles and occasionally stops by the office, reminding me that every trader needs to find their own niche. Looking inside. Young traders striving for success must pay attention to self-analysis. Many novice traders need to improve the execution quality of successful trade formations. It's important to enter the market more frequently based on such models and gradually increase the size of trades. They should also work on mental weaknesses and continuously expand their arsenal of trading models. Traders should remember Abraham Lincoln's words about discipline in the service of the best in us. Poor traders tend to blame everything around them: trading platforms, workplace neighbors, the tax system, transaction costs, and platform fees. They will always find an excuse for their failures. But these are often the same traders who miss easy trades, fail to battle their internal demons, and don't maintain a trading journal. They often think that if they had learned from the top traders on Wall Street, their results would be better. I disagree. For example, one of my trader friends often exits the market too early. He prefers short-term trades but lacks the skills to hold positions. After being moved to the team of experienced traders, he needed to learn how to recognize such trades and master the art of holding positions. Overcoming problems in trading takes time and patience. Even if he were seated next to Steve Cohen, the problem of prematurely closing positions wouldn't resolve itself unless Cohen forced him to hold positions under the threat of being fired. Training patience. A great trader may not have the patience to work with beginners. They might not want to be a mentor or become frustrated with a mentee's inability to quickly master the market. Sometimes these thoughts cross my mind too. One of our talented traders didn't embrace the daily loss limits, yet he couldn't hold on to the profits made early in the session. At SMB Capital, there's a rule that midday losses cannot exceed 30% of the morning's earnings. If this happens, the trader's buying power is reduced the next day. This young trader had already experienced midday losses a few times. As a result, the rule was introduced to prevent such situations. When he was informed about it, he responded with irritation, feeling the decision was unfair. He complained that he was being treated like a beginner, but the rule was put in place for his own benefit. A great trader might respond harshly to such a letter, but I prefer a different approach. In the past, at one of the companies I worked for, I witnessed an experienced trader aggressively confront a newbie who hadn't met expectations. In our practice, we applied less aggressive methods. For example, A trader who made a mistake had to do 100 push-ups. But it's important to remember that it takes several positive comments to neutralize the impact of negative ones. Every trader is unique, and it's essential to consider their personal traits. Some take criticism well, others do not. Therefore, mentors must approach each trader based on their psychological characteristics. When I was vacationing at the Outer Banks, one of our traders, Pop Trader, called me. He was a former musician who had recently completed training in Switzerland. However, his trading didn't meet expectations, and Steve closed his account. Pop Trader sent me an analysis of his trades, explaining that he thought the decision was unfair. I was irritated because his results didn't align with our standards. Pop Trader wasn't ready for impulse trading, and his approach to the market left much to be desired. I pointed out the issues and suggested he reflect on them, but I immediately realized I'd made a mistake by showing frustration. The letter I had expected from him never came. John Wooden, in his book, Wooden on Leadership, notes that the teaching process requires patience. As a mentor, you need to explain to traders why it's important to follow the rules. They must understand that adhering to the rules serves their best interests. Show toughness. A mentor must challenge their students. Trading on financial markets is complex, and a dedicated trader deserves a patient approach, even if they haven't achieved great success. However, standards must be maintained. When a trader breaks the rules, it's necessary to raise your voice. At such moments, it's important to convey to traders the seriousness of the situation. In February 2009, I was disappointed by the actions of several traders, and I held a meeting, raising my voice. Your level of preparation is unacceptable. Without thorough preparation, you won't be able to realize your potential. This was a harsh approach, but it was intended to help achieve better results. Sometimes it's necessary to raise your voice at a trader, especially if they don't understand the importance of holding positions. Young traders often close trades too early, and we draw their attention to it. Why didn't you hold the position? We explain that they must keep working through difficulties, as this is crucial for their growth. At first, young traders don't like being shouted at, but it's necessary for their improvement. Over time, they start to better understand the buy and hold model and improve their results. Costs. A good teacher can't be selfish. To improve teaching quality, you sometimes have to sacrifice part of your trading income. When you're tired and longing for rest, you have to stay in the office and engage with traders, explaining your decisions. During trading, I often comment on my decisions for beginners, which reduces my concentration and leads to missed opportunities. Sometimes I miss good trades while explaining why I chose a particular position. At those times, I finish the conversation with, "I should have bought, not talked." To make explanations easier, simpler stocks are often chosen, which also impacts earnings. The work of a mentor requires a lot of effort, and many days are spent preparing lectures and improving teaching methods. On weekends, when I would normally rest, I now stay at work, thinking about new models and strategies to pass on to my students. Setting company values. A good teacher sets behavior rules for students, defining work ethics and criteria for evaluating the workday. It all starts with the teacher. In our company, traders are taught the value of hard work in the trading room. I strive to show that the development of professional skills is the foundation of stability in the stock market. My own dedication, my work ethic, doesn't escape the attention of the traders. The training course at SMB Capital begins with a 5-week program where every moment of the 10-hour workday is planned. This is just the beginning, followed by the second phase, the trader's development. My example justifies the high standards that are passed on to the whole team. Recently, due to technical issues, we had to work in another office. A senior trader from another company asked how we managed to keep traders at their desks. The answer is simple. My partner, Steve Spencer, never leaves his chair all day, never missing a tick, and this inspires everyone around him. In one of my blogs, I shared my teaching philosophy, which is not about trading patterns, but the values I pass on to my traders. 10x equals X. Maybe I'm getting older, but every year I notice a trend among some young traders. They believe that if their performance is X, then their reward should be X. However, at the early stages of a trader's career, they must put in 10x the effort to earn X. I've seen this with some talented traders who left our company. Even great talent won't bring rewards without constant effort. The best results come from those who love trading and are willing to work hard. For example, our most progressing trader last month exceeded all expectations. In trading, attention to detail is crucial. Analyzing the market, reviewing your actions, and identifying the best trading patterns. This requires effort. Beginners face challenges, but they can improve their performance if they put in the effort to reach 10x. Otherwise, their results will worsen. After several years of hard work, a trader can expect stable results, where performance and reward gradually become more balanced. The lesson is simple. Do the work with passion and strive for perfection. If you want to make it into the Hall of Fame of traders, put your heart into your work. 10x effort is what will ultimately bring you X. Belief in the student. A good teacher always believes in their students. The story I want to share is an example of how believing in a student helps unlock their potential. When Tixter first started with us, he didn't stand out among the others, but I saw talent in him, the ability to process information quickly and a strong interest in the market. After a year, his results were decent, but not what I had expected. We talked, and I said, "You will become the next star in our trading room." Over time, his results improved, but he still hadn't reached the level I expected. I told him again, "You will become the next star." As a result, his confidence grew, and this paid off. Some traders, like Tixter, just need someone to believe in their abilities and plant confidence in their minds. They might be on the verge of a breakthrough, but they need to be sure of their readiness. There's always something to learn. Interacting with great traders is always beneficial. I constantly try to learn from them, especially by listening to their stories about their best trades. However, it's important to understand that my approach is different from theirs. Just like in sports, where I don't try to perform difficult tricks, in trading, it's essential to understand your own strengths and limitations. Walter Peters, in his article, emphasizes how important it is to choose a system that suits you best. Instead of inventing something new, it's worth improving what already works. John Netto also highlights that trading reflects our lives. To become a disciplined trader, you first have to become a disciplined person. The story of Crazy Max, disorganized in life but successful in trading, vividly shows how important it is to integrate discipline into your daily life. From Brian Shannon, I've learned vital aspects of trading that further expand my understanding of the profession. 10 things professional trader. Brian Shannon taught me. Recently, I attended a lecture by Brian Shannon, a well-known trader and the owner of the Alpha Trends website. Here are the lessons I took from his talk. 1. Brian prepares for trades more thoroughly than most traders. He pays attention to details and analyzes the market in advance. 2. Brian knows exactly how he makes money in the market and which trading models work for him. 3. He understands that his favorite models don't always work and is willing to adapt his strategy. 4. If a trade doesn't execute quickly, he reduces risks and avoids hasty decisions. 5. Brian has a clear system for choosing stocks. He tracks a list of 200 stocks and selects the best for trading each day. 6. He acknowledges his weaknesses, such as premature selling of stocks and insufficient position holding, but he works on improving himself. 7. Brian is very proficient in technical analysis, but always looks for confirmation in the order flow. 8. He doesn't give up if a pattern doesn't work on the first or second try. He continues to work with proven methods, hoping for success on the third attempt. 9. Brian gave me his book with a personal inscription. It was a valuable gift, even though his handwriting is hard to read. 10. Brian is not only an excellent trader, but also a great person who values good friendships. These lessons give me a clear understanding of what is important for successful trading. Trading is a constant process of learning and adaptation. We all continue to grow, and there's always something to learn from the best. Adaptability. The key trait of experienced traders. What sets an experienced trader apart from a beginner is adaptability. A good trader knows how to adjust to market changes and learn from their mistakes, which leads to stable results. Chapter 12. Adaptation to markets. In trading, it's important not to rest on your laurels. What brings steady profit today may stop working tomorrow. Traders need to be able to recognize current market conditions and adapt their strategies accordingly. Humility is also essential, allowing us to accept the inevitability of change and remain open to seeking and learning new trading models. My first interview in 1997 was quite an experience. My mother drove me to a New York office, and I was ready for the interview like a real Wall Street professional. When asked why I wanted to become a trader, I delivered a well-prepared answer about how trading is a perfect meritocracy, where efforts are rewarded accordingly. I was offered the job, though it wasn't too difficult. In the summer of 1997, I passed the bar exam, thinking that I could always return to a legal career if trading didn't work out. But fate had other plans. When I started my trading career, the prospects were thrilling. High incomes and even helicopter rides on weekends. However, with the onset of the 2008-2009 financial crisis, trading stopped being just a thrilling game. We faced tough times, with many losing money. Rumors of layoffs spread through our office, and I couldn't make a profit in the first few months. But over time, as the market stabilized, I began to earn. The first month I received a check for $30,000 was a revelation. It was far more than I could have made in an entire year at another job. The Asian financial crisis, a popular strategy, which I owe the possibility to boast about, was a subset of swing trading. We opened positions on stocks that performed better than the market. The main focus was on NASDAQ stocks with a high beta coefficient. Our favorites included companies like CSGO, Dell, MSFT, INTC, as well as semiconductor companies. Although we didn't have access to the New York Stock Exchange, earning $30,000 a month, we didn't mind this at all. We tracked NASDAQ futures to understand the strength or weakness of stocks. For example, if the futures rose by 5 points and CSGO rose by half a point, MSFT remained flat, and INTC rose by 1.5 points, we would take positions in INTC. These trades happened before the switch to the decimal system, so fluctuations were much more significant. At 3 p.m., we would choose the strongest stocks and take positions in them. This was called lighting up at 3. The best positions stayed until the close of the session. We worked with an excellent trading platform that gave us an advantage. It displayed order executions in ISLD, now known as NASD. This was a direct execution system, and we would be the first to know when market makers were overpaying 25 to 50 cents per share. When we saw that Goldman Sachs was buying MSFT shares for 25 to 50 cents on ISLD, and we could buy it at the offer on the internal market, we would shoot the offer at 25 cents, place our orders at 50 cents, and close them immediately. The platform showed us when large companies like Goldman Sachs were ready to buy at the offer, and we could buy shares without risk, betting on mass purchases. This brought profits in just seconds. Big money could also be made on bounces. If stocks opened at a low price level, you could catch a bounce at the session open. The key was not to buy first, but to wait for price stabilization after the fall, then start buying. When the price stabilized at a higher level, we would load up positions. Experience showed that large volumes of purchases should only be started after the decline ends and the price starts moving up. Trying to catch the bottom often led to losses, and it was more profitable to enter the market when the reversal had already occurred. I saw traders making $400,000 on bounces without trying to buy at the bottom. Steve made $100,000 twice using bounces without buying at the very bottom. The internet boom. As if the market wasn't wild enough with market maker shots and bounces at openings, it was enriched by dot-coms like AOL, YU, eBay, AMZN, KTEL, and others. We transformed from swing traders to momentum traders, adapting to the changed situation after the Asian crisis. The market in those years was much more jittery. Try buying 5,000 shares that could drop 10 points in just 5 seconds. For the internet boom, we traded pullbacks, but now we had to pay market makers a higher price, sometimes a point more. If the price didn't move, we lost an entire point in the spread, and if it went against us, we lost 3 points immediately. We traded in lots of 1,000 shares, and if we entered with 3,000 shares, a bad move could cost us $9,000 in mere seconds. These were no longer easy profits, and the market had become much tougher. Good traders worked on their own accounts, and private partnerships in our industry were almost non-existent. A lucky day could bring $10,000 to $25,000, but a lapse in concentration could make you lose $10,000 to $15,000. Playing defense no longer brought the desired results, and we had to go on the offensive, adapting to market changes. The trading floor was cramped, and the space was typical for New York apartments, 8 feet, 243 centimeters. There was only room for a chair, and just a few inches of space remained around it. There were no analysts or charts in the company. We only had a single CRT monitor, and while the trading platforms were relatively modern, they often went down for hours. When that happened, traders were stuck in their positions, unable to get technical support. I remember losing $18,000 on KTEL stock the day the company announced plans to sell music over the internet. That day, I began working on stabilizing my emotions. Instead of focusing on big wins, I started concentrating on consistent, small, but positive trading days. This philosophy is still with me today. However, good days did happen. Once, I made $75,000 on eBay and YU shares. A good streak lasted about 18 months, with almost every day bringing a 5-figure win. I remember how happy I was when I received my first $15,000 credit card. But a few months later, my accountant informed me of the debt amount, and it was so high I couldn't bring myself to write it down. The internet boom turned us from relative strength traders into momentum traders. We learned to adapt to the new market situation. At the beginning of 2000, George Soros issued a warning. Today, the market is ruled by young people who have no clue about a bear market. Hard times didn't take long to arrive. The 2001 market pullbacks, the explosion of the internet bubble wiped out our fantastic profits. Short positions weren't opening, and we weren't eager to become bears. We had to wait for a bounce and load up when it came. Despite the price drop, we could still make money. Our trading skills were sharp. We worked with quality internet stocks, and even in the face of fewer profitable deals, we quickly adapted. By using technical analysis, we found safe moments to buy, but the earnings were no longer what they had been before. In 2001, I benefited from 2 historic pullbacks in NASDAQ. On January 3rd, after a 50 basis point rate cut, I bought 8,000 shares of BRCM. After the price dropped, I quickly sold at a good price, earning more than $100,000 in an hour. On April 18th, the rate was cut again, and NASDAQ rose by 8.1%. That year, the Federal Reserve cut rates 11 times. Although 5-figure profits disappeared, this year remained crucial for us. How to trade the market bounce. My experience with intraday trading taught me that tape reading is more important than charts, but technical analysis shouldn't be ignored. In January 2009, I noticed that most stocks like GS, WFC, RIM, AAPL, IBM had fallen and closed near session lows. For SPY, the key level was $88.50. The index fluctuated between $88.50 and $88.93. And a breakout upwards was expected. However, readiness alone is not enough. First, would the bounce start above $88.50? Second, which stocks to choose for trading? Obvious candidates included GS, IBM, RIM, AAPL, PCX, WFC, but analyzing charts was necessary. Third, maybe a short position was worth considering, betting on a drop to $88.50. If the level broke down, we needed to exit the stocks and prepare a plan for a favorable move. These are the key principles for trading the bounce at the $88.50 level. But what if the bounce occurs in an individual stock? The bounce in an individual stock. When a stock like ROH drops, trying to buy at the low is akin to catching a falling knife. It's natural to want to catch at the bottom, but that often leads to losses. It's better to wait for the price to stabilize and begin rising before entering a long position. Traders often think they can feel the bottom, but it's essential to wait for confirmation of the price movement. Buying at the bottom without being sure of a reversal is a poor trade. Even if you manage to catch the low, stocks at such low levels tend to remain weak, and you could end up exiting the market without a profit. It's better to wait for the price to stabilize. For example, if ROH drops by 2.5 points and stabilizes at $50, it could rise by another 4 points. The entry should be at $50 with a sell target at $54. This kind of trade has a higher chance of success, and the risk-to-reward ratio will be favorable. While some experienced traders seek out the bottoms, I recommend trading with the trend. It's better to wait for price stabilization and then enter a long position. Don't rush to exit when the price begins rising. Let the trend develop and aim for greater profits. September 11th. In the spring of 2001, I lost $36,000 trading CMRC stock. At the time, I was studying technical analysis and decided to apply my new knowledge by buying at support levels. That turned out to be an expensive lesson. After the internet bubble burst, there was essentially no support left on the charts. I made the classic mistake of a beginner trader, not considering that support levels are formed based on the market's mood. When the situation changes, those levels are no longer reliable. Despite the losses, I decided to take a break. By the summer, I had lost about $75,000. This was a significant amount, but thanks to the profits earned during one of the best trading periods, I still had savings. Steve and I took a trip around the country. We played golf, stayed in prestigious hotels, and dined at top restaurants. I achieved my goal. At the PGA West Club in Palm Springs, I scored 90 just before returning home. I was supposed to return to work on September 11th, 2001. When I came up from the subway, panic had already engulfed the city. I saw flames and smoke billowing from the World Trade Center. Almost immediately, the second tower was struck by a plane. I turned and ran towards South Street Seaport. I lost my sunglasses during the run, but didn't stop. My thoughts were clear. Don't go back down into the subway. Stay away from the Empire State Building. Avoid using the phone due to network congestion. I had to get to the suburbs quickly. I walked towards Upper West Side about 5 miles. On 81st Street, I stopped at a cafe and ordered an omelet with goat cheese, spinach, and iced tea. I was confused, but one thing was clear. Stay away from the epicenter of the tragedy. The markets didn't reopen until September 17th, thanks to efforts from the then president of the New York Stock Exchange, Dick Grasso. At the time, there were rumors about additional attacks and air pollution. I made the decision to return to the office immediately. Just like many others on Wall Street, it was our way of showing the terrorists that they would not win. On the streets, we wore masks due to the polluted air. A checkpoint was set up outside the exchange building, where we had to show our documents. The area was patrolled by soldiers with dogs trained to detect explosives. This was the new reality. Trading became tough. I started scalping, trying to minimize risks. There was no certainty in the market, and at any moment, new shocks could happen. 50-cent trades and scalping. During one Saturday video review, an interesting question came up. In what situations should you avoid scalping? There's a common misconception that intraday traders only scalp. This is false. At the time, we rarely scalped. Some traders look down on scalping, thinking it's too simplistic. But for me, it doesn't matter how the money was made. When I deposit a check at the bank, no one asks if it was earned through scalping. The main thing is the result. Scalping only makes sense when it gives the trader an advantage over other market participants. But you shouldn't get too caught up in it. It's just one tool, and excessive focus on scalping can distract from more profitable opportunities. We should always aim to find 50-cent trades, deals with higher profit potential. Scalping can distract you, causing you to chase small moves like 7 cents while missing out on a larger trade. There are situations when scalping is particularly inappropriate. 1. Don't scalp stocks in a strong trend. In such cases, it's better to focus on entering a position that aligns with the direction of the trend. 2. Don't waste time scalping at the expense of searching for larger trades. However, scalping can be useful for determining intraday support and resistance levels. For example, sometimes it helps to feel a stock, especially during the market open. This can lead to spotting a great trade. We discussed GES stock, where the trader initially scalped from 52 cents to 64 cents. At first glance, this might seem like a missed opportunity for a larger trade. But later, he took a short position at 64 cents, understanding that he could make 50 cents. This demonstrates the flexibility of thinking and the ability to adapt to the situation. For those who lack this mental flexibility, it's better to avoid complex strategies. It's optimal to focus on simpler trades with profit potential from 50 cents to $1. In October 2001, my father and I were at the Yankee Stadium when President Bush symbolically threw the first pitch of Game 3 of the World Series. He wore a jacket with the FDNY logo, and an F-16 fighter jet flew over the stadium. It was a reminder that life had changed, but we had to continue doing what we knew best. In trading, a tough period began. The internet bubble had burst, and the market became extremely difficult to navigate. It was a turning point. Either we progressed and became better, or we left the market. Bear market cycle of the early 2000s. In a challenging market, you can learn trading faster than in one with easy profit opportunities. During the bear market from 2002 to 2003, I didn't make much profit, but I became a better trader. I started developing my trading system and learned how to profit even without important news, focusing on in-play stocks. Consistency followed. 17 out of 20 trading days each month were profitable. In-play stocks became easier to trade compared to companies like JDSU and AMZN before the cycle. From 2003 to 2006, the market stabilized, and we started range trading. I learned to short fading stocks, minimizing risks. Trades became less flashy, but I adapted and continued profiting. Some colleagues couldn't adjust and lost money, leaving the business or switching to sales. I avoided this by evolving my trading style. By focusing on fading stocks, I became an expert at reading the tape, which allowed me to minimize risk and catch the right moments to enter. Adapting by cutting out negative influences. During the bear market, my friend Josh was trading OIH, an oil sector index. His personal life, specifically a relationship with a woman who constantly distracted him, affected his trading. This led to a lack of focus, so I introduced him to my sister's friend. Their relationship improved, and Josh became successful again. My takeaway: personal problems can significantly impact trading. Adaptation in this case isn't about changing trading style, but eliminating external negative influences. From 2003 to 2006, I improved my tape reading skills, which allowed me to make profits on stocks without knowing much about them, simply by observing the tape for 20 minutes. This effort led me to professionalism, significantly enhancing my trading. Back then, trading felt like blue-collar work. We weren't aiming to make millions in a day, but focused on improving our skills steadily, with hope for better times, and those hopes were realized. Mastering new techniques allowed me to capitalize on swing and momentum trading opportunities in 2007 and 2008. Fading trade example. During a video session, we examined a trade with the stock TGT. Experienced trader NYU closed the position at $33.75 after a battle between buyers and sellers at $33. The stock climbed to $33.80, and NYU opened a short position. This was an example of a failed fading trade. Advice for new traders. At SMB Capital, young traders are not allowed to trade fading moves. Start with momentum trades. Fading trades are hard and require experience. Focus on support and resistance levels first. Why I disliked NYU's trade. The probability of success was too low. The risk-to-reward ratio was poor. The peak wasn't clear. I would have closed the trade only if the price deviated by 2 standard deviations from the stable price. TGT was still in an uptrend. The trade plan was insufficient. The tape contradicted the trade. For fading trades, profit should be 5 times greater than risk. In this case, risk was around $0.23, while profit potential was about $0.40. TGT showed no signs of the move ending, and the peak was likely higher, around $35. The probability of success was about 40%. I always enter trades if the probability is above 80%. I aim to catch peaks or troughs when the stock moves at least 2 ticks away from the stabilized price. This is determined through experience in intraday analysis. At the start of the session, it was hard to understand where the stock was going, and we couldn't precisely determine if it was at the correct distance from the temporary price. Fading trades are complex. I used to have success with them, but now the market is more suited for momentum trading. Fading opportunities exist, but young traders should focus on momentum trading, which is simpler and more profitable. Save your money. The tough trading years taught me an important lesson. Save. Every time you get lucky and hit a winning streak, put money aside for future difficulties. The market of the late 1990s ended, and the fall of 2008 was swift. Looking at my $15,000 credit card bills, I realized how crucial it was to save. When the VIX index spiked above 60, it was clear that this wouldn't last long. Today, my budget is just under $3,000, a modest sum, especially for New York. But no matter the market situation, I know I can earn enough to cover my expenses. I only allow myself to buy new things after especially successful months. In the fortunate year of 2008, I bought an HD TV after a good month, a new mattress after a big month, and a new couch after a huge month. Everything else goes into my bank account, where it stays until tough times hit. Penny spread. The world of trading is constantly changing, and many colleagues leave without adapting. Some left after the Asian crisis, others after the dot-com crash. Some didn't learn to trade fading trends. One of the challenges for Steve and me was the reduction of spreads and the shift from market making to a hybrid system. When I started trading, stocks were quoted in increments of $0.25, a system that lasted nearly as long as America itself. The New York Stock Exchange was founded in 1792. The difference between the bid and ask price was a quarter. For example, the spread on INTC in the 90s was $0.50, and a trade of 2,000 shares at that spread earned $1,000. When I entered the market in 1998, spreads started tightening, halving in a year. Eighths became sixteenths, called teenies, worth 6.25 cents. Then came 30 seconds, 3.75 cents. As spreads tightened to 1/64ths, or 1.5 cents, it was clear the old order was no longer working. The transition to the metric system meant that a 2,000-share trade now earned just $60, barely enough for dinner. The spread no longer offered the same profit. The term chipping down to 1/64 became known as chiseling. We quickly identified such traders and called them chisels. There was an unwritten rule not to chip to 1/64, but some ignored it. One time, someone tried to chip one of our senior traders, and we saw it on our screens. The senior trader immediately approached the culprit, told them to turn off their platform, and said, "Get out of the room, come back when you're ready to act like a real trader." After the switch to the metric system in 2001, many market makers left. The reduced spreads no longer covered their costs. Predictions of the end of intraday trading proved exaggerated. The reduction in spreads led to increased stock volatility. Research showed that after the switch to penny quotes, trade execution costs increased by 7%. My reaction was, make it so we can go back to eighths. But experienced traders adapted. This meant more active trading, careful stock selection, and finding better setups for the new system. Traders faced a choice: either become losers, complaining that making money was impossible, or adapt to the new conditions and master the market. The hybrid market era, the bursting of the internet bubble cleared out weak traders, and the metric system caused even more departures. After this, the NYSE introduced the hybrid market, which had a significant impact on the performance of mediocre prop traders. Until 2004, Steve and I only traded NASDAQ stocks, rarely looking at those traded on the NYSE. As a NASDAQ trader, I disliked how NYSE specialists handled my orders. They could delay orders for up to a minute, manipulating the spread to their advantage. In 2004, several NYSE specialists were fined $250 million after being accused of order manipulation. With the introduction of the hybrid market on the NYSE, as over-the-counter systems began competing with specialists, we increased our volume of NYSE stocks. By the first quarter of 2007, 82% of our volume was on the NYSE, whereas we had only traded 19% of NYSE stocks before. The hybrid market essentially turned specialists into another ECN, opening new opportunities for traders familiar with electronic trading. It made sense. The market should be transparent and fair, rewarding those with the best trading skills, not those who manipulate orders. When the flow of orders from specialist books disappeared, many traders who were accustomed to it couldn't adapt. They had spent years learning how to work with various specialists and manipulate them. For us, however, it became an ocean of opportunity. Trading NYSE stocks became similar to trading NASDAQ stocks, and a NASDAQ trader could easily switch to NYSE stocks. The hybrid system eliminated order delays, and I could buy stocks when I needed to. While this phase of market evolution benefited traders like me, it's hard not to mention those who lost their jobs. We sympathize with those who lost high-paying jobs due to new technologies. I can only imagine how difficult it was for families of traders and specialists who had relied on steady incomes when their skills became obsolete. Thousands were left jobless, especially those running family businesses established by their ancestors. Today, when we watch the trading floor on CNBC, it looks more like a museum than an economic powerhouse. However, the market can only function effectively under conditions of transparency and equality for all participants. Traders shouldn't rely on the flow of orders as their main source of income. Their earnings should depend on the effectiveness of trading systems and decisions made. One arrow in the quiver. Many traders rely on a single strategy. For example, they notice high buying volume at a particular price and place an order in front of it, or they spot significant sell orders and do the opposite. This approach is common in scalping, a strategy that flourished after 9/11. While it's useful, it shouldn't be the only weapon in a trader's arsenal. I recently met a young, ambitious trader dissatisfied with his firm. He had good results despite limited experience and had mastered the technique of spotting large bids and offers. However, his firm had only taught him this one strategy, which is insufficient for long-term success. It's essential to provide simple, understandable strategies for beginners, especially since trading doesn't just rely on one model. The technique used by this young trader was popular before hybrid markets were introduced, but it became obsolete once hybrid markets changed the landscape. A trader can't survive with just one approach. I've used similar strategies in the past, such as high bids from market makers or specific patterns like those seen with Arca and Meskio. However, these patterns are outdated, and relying on just one model can lead to failure. Bullish trend adaptation. In 2006, the market started an upward trend. I struggled with this shift at first, as stocks that seemed overbought kept rising. It was a difficult adaptation, but I eventually realized I needed to change my trading style. In previous years, trading had focused on short-range markets, but now bulls were making steady gains. I had to adjust and begin looking for strong stocks to buy on pullbacks. Buying on pullbacks. This strategy, buying on pullbacks, is crucial for any trader aiming to level up. With more practice, it becomes second nature. Here are some key points for identifying good entry points during a pullback. Trade in a clear market trend, bullish or bearish. Know which sectors are leading the trend. Look for pullbacks to support levels with low volume. If the pullback is sharp but volume is average or lower, stay in the trade. Wait for the pullback of leading stocks to key support levels, like previous resistance turns support or a moving average. Ensure the stock moves higher with strong volume once you enter. If you make a mistake, exit immediately. Averaging down will kill your career. Pullback buying can be messy, but recognizing the right entry points during an uptrend can help you become a consistent trader. Good luck. The real estate crisis. I've lived through many crises, including the Asian crisis, the dot-com crash, and the aftermath of 9/11, but nothing compared to the worst economic downturn since the Great Depression. By the summer of 2007, I hadn't traded stocks like CFC, MBI, or ABK. The market was in a heavy upward trend, but then the news about CFC came, and the situation changed dramatically. Although I wasn't a real estate expert, I knew enough from observing my father's investments. I noticed that home prices were rising faster than material costs, and while I sensed something was off, I didn't immediately sell off construction stocks like John Paulson, who made billions during the mortgage crisis. However, the split in CFC stock was clear. Dialogue. G-Man. Steve, do you see the CFC stock? Steve. Yeah, what happened? G-Man. Bad news. Steve. You think so? G-Man. What do you think? Steve. Not sure. I'll just trade it. The CFC stock wasn't bouncing back, and sellers kept pushing it lower. I shorted the stock and kept selling as long as the intraday momentum continued. That day, I remembered the late 90s market, and traders trained in our company began to make serious profits again. G-Man, who had just sold CFC, was thrilled and said, "Now that's trading." Trading became profitable once more. We were earning like in the late 90s without the hard work. When stocks of subprime mortgage operators like CFC dropped to low levels, the real game began. The oil and gas price surge. From January 2007 to July 2008, oil prices rose from $50 a barrel to an intraday high of $47.11. In the summer of 2008, G-Man and I rented a house on Barrier Islands in North Carolina, just 200 feet from the ocean. Over the summer, our rent dropped from $8,000 to $2,200, partly because vacationers couldn't afford paydays. The location was remote and hard to reach. By 2006, Americans were spending a larger share of their incomes on energy than ever before. Before this, I rarely traded oil or gas. I wasn't interested in intraday price movements of energy stocks, as they often reversed after breaking technical levels. These stocks frustrated me, and I preferred others. However, the market conditions at the time made me reconsider my approach. I had to start trading oil and gas stocks. Their behavior became more stable and suitable for trading. I focused on stocks like NK, CNK, and VLO, following the momentum and scalping, profiting from their activity. Sometimes even stocks that were previously untradeable can become viable once they become active and trend. The key is activity. Trading any active stocks or sectors is the main goal. During the banking crisis, the market became a true Super Bowl for traders. This rare event created opportunities for hedge funds to capitalize on brilliant trades. That year, intraday traders had unique chances to profit. The near collapse of the U.S. financial industry. During the banking crisis, news came in rapid fire, and I often couldn't predict how the market would react to certain information. So I chose to focus on trading rather than overthinking. Short positions on momentum patterns worked best with stocks like LEH, BSC, JPM, WFC, MER, and GS. When the market doubted the statements from financial company leaders, I would short the stock. It was a market that traders would remember for years. Initially, Goldman Sachs stocks were seen as very reliable. When Warren Buffett invested $5 billion, it was seen as a positive sign. Buffett received the right to buy shares at $115 for the next 5 years, making this price a support level. As long as this level held, we bought stocks, but once it broke, we started selling. The market began to question the bank's model, and the stock started falling. We shorted it, knowing the decline could continue. Later, when the bank bailout bill was passed, we closed our short positions and began trading long based on market changes. At one point, when Goldman Sachs stock dropped to $47.41, I thought, please let this be over. The initial fall was thrilling, but as it accelerated, I wondered if the financial market could ever recover. Crises like this are hard to predict. I remember 2 trading sessions after Thanksgiving during the dot-com bubble when opportunities were extraordinary. In such moments, traders can't afford to be distracted. They must seize every opportunity. This period became fantastic for trading, especially in the financial sector, and we adapted as the market changed. The explosion in popularity of exchange-traded funds, ETFs. As the volatility of financial stocks attracted traders, ETFs quickly filled a niche. Why trade financial sector stocks 1-to-1 when you can use 3 times leverage? This led to the creation of funds like FAS, which triples long exposure to the financial sector, and FAZ, which provides 3 times leverage for short positions. For more cautious traders, SKF offered double leverage on financial sector shorts. By the end of 2008 and early 2009, these ETFs gained incredible popularity. Some traders struggled, but by February, many regained confidence by trading ETFs like FAS, FAZ, and others. ETFs aren't companies, don't pay dividends, and aren't managed by teams. They simply track stocks, but their movements are more dynamic. Over the next few months, we successfully traded funds like FAS, FAZ, SKF, SDS, and SRS, achieving strong results. Many believe these funds increased market volatility in 2008-2009, and that using triple leveraged ETFs like FES and FAZ was reckless. However, for intraday traders, these discussions didn't matter. We weren't into politics or economics. Our focus was on making money by finding trading models. And during this period, the best opportunities were with these ETFs. Buy and hold strategy. By the end of 2009 and into 2010, we began using longer intraday trades aligned with the market's uptrend. Despite economic problems, the market kept growing. Bad news was ignored, and many stocks bounced back from sharp drops, closing positive. Every time the bears predicted a fall, the bulls pushed the market higher. We looked for technical levels to open positions in line with the prevailing trend. We focused on bullish and bearish flags, consolidations, and trades from support and resistance levels. One trader said, "I'm working on a buy and hold strategy." We relied more on technical analysis, especially in a trending market, and started holding positions overnight. Now we are less active and focus on larger positions. For example, G-Man has 30 positions open. Steve often thinks like a hedge fund. Stock XYZ is the weakest in the tech sector. Everyone is searching for effective buy and hold models, and this will continue until the next market shift. To succeed, it's crucial to stay fresh, use the best patterns, and update your trading style. Chapter 13. The Successful Trader. After all the market ups and downs, I continue to refine our trading system. We open positions at intraday levels with the highest volume, seeking moments when bulls and bears are actively battling. Our traders focus on scalping during calm markets and opening positions during times of heightened market activity, such as company earnings reports. Intraday trading has become more important over time. The possibility of changes in trading, such as globalization and the development of electronic systems, inspires me. We are also working on accessing new markets, particularly in Asia. There are moments of frustration when I face consecutive losing days. However, I always recover by reducing position sizes and focusing on the best patterns. After a few successful days, my confidence returns, and I strive for more. I've learned to adapt to new conditions, focusing on profitable trades while managing risks. My ability to regain confidence after setbacks is what makes me a professional trader. I've experienced many market changes, from the switch to the metric system to the adoption of various trading systems, always finding a way out of difficult situations. Trading requires constant adaptation and system adjustments. To succeed, it's essential to stay alert to the market, explore new approaches, and fine-tune the strategy daily. In the end, trading is a process of continuous skill development and discipline. Every challenging period makes you stronger, and every success builds confidence. Respecting the market and its rules is crucial. Small steps every day lead to significant results. Surviving through tough times and returning to trading has made me a professional. Today, I am a successful trader, and this achievement defines my life. I wish you the same success.